is 9 a.m. here in New York on this Thursday, November 19th. This is Yahoo Finance Live, and I'm Julie Hyman, along with Miles Udland and Brian Sozzi. Let's take a look at futures here this morning. We've got them pointing to a lower open, down about 0.25%, whether you're looking at the Dow, the S&P futures, or the NASDAQ. We'll be tracking them throughout the morning and, of course, through the opening bell. Other things we're watching this morning, jobless claims rise to 742,000. It's the first increase since early October and could indicate a slowdown in the economic recovery as coronavirus cases surge across the country. And the race for a vaccine, AstraZeneca and Oxford University out with their peer-reviewed vaccine data. That's just one day after Pfizer said its vaccine is 95% effective. Let's start on this news with Yahoo Finance's Anjali Khemlani for the latest vaccine checkup. And Anjali, just to be clear here, it's not apples to apples, right? The stuff that Pfizer and Moderna came out with was phase 3 data. This is phase 2, which is looking at different things than the phase 3 data.
That's correct. And not only is it a different data in terms of where the trial is, it's also a different platform. So we're definitely comparing a number of different things, but it is still positive because, as we've said from the beginning, and as health experts have said, we're going to need many different options when it comes to a vaccine because different people will respond differently to these and different age groups will respond better to one versus the other. So there are a lot of factors that go into this. So yes, very good news out of AstraZeneca. We know, of course, that company was the one that had to hit pause earlier, both in the UK and abroad. The UK trial did start up a little bit faster for phase 3, and the US did delay a little bit more. So it's a little bit further behind, even though it started out pretty far ahead. The good news from Moderna, of course, 94.5% effective, and it is the less arduous one to send out through a supply chain. So a lot of optimism for that one. Meanwhile, Pfizer with even better results, 95%. For its effectiveness, and also looking at that cold chain storage, ultra cold chain storage that's going to be needed. So that's sort of the baseline of what we're looking at right now in terms of the options that are out there. We know, of course, Novavax and Johnson & Johnson are also working on their vaccines. And so there's a lot to go into this, a lot of options out there, and that's exactly what was necessary. And it looks like we might have 2 in the US that receive emergency use authorization by the end of the year. Meanwhile, looking in China, of course, they've had multiple options that they've been working on. One of theirs from Sinovac did show robust response, but it wasn't as much as, say, someone who's recovered from COVID, but it have a quicker response time. So a lot going on, of course, and this is the time of year that we anticipated having to deal with a lot of vaccine news. So as it stands right now, that's what we've got. Julie?
Anjali, thank you. And Anjali's going to stick around because we're going to talk more about the healthcare system right now, anticipating a vaccine, dealing with the virus surge that we are seeing at the moment. We are joined now by Dr. Sharif El-Nahal. He is University Hospital President and CEO. He's former New Jersey Department of Health Commissioner as well. University Hospital is in Newark, New Jersey. Dr. El-Nahal, thank you so much for joining us. You just heard Anjali talking about the latest with the vaccine, and I know you're dealing with a surge in cases right now, which I want to get to, but I do want to ask, are you looking ahead to potential deployment of the vaccine? Are you putting in place your protocols now and trying to anticipate what that process is going to look like at the hospital?
We are, Julie, and we're very excited about it. The data that Anjali just mentioned really shows that coronavirus, COVID-19 in particular, can be vaccinated against successfully, which is excellent news that wasn't certain before. And hospitals all over the country are preparing for the deployment of the vaccine. The science is just the first step. We have to actually get it administered to people and to facilities that, of course, can store it safely and effectively so that it works when it is administered. And we're preparing for that now. We're one of several hospitals throughout New Jersey that can store these vaccines in the cold storage capacity that's needed. And we're excited to be able to be part of that process, not just for our patients, but for patients all over our region.
Dr. El-Nahal, about that being the distribution site, tell me about what that's been like in terms of coordinating with the state government and going up to the federal government. What have been the conversations, and how does the plan look right now in terms of where these vaccines can go?
Well, several key conversations, Anjali. First of all, how is the vaccine going to be distributed? We've worked that out to a large extent in New Jersey in close partnership with the Department of Health, which is, of course, coordinating with Operation Warp Speed and with Washington. But then the next most important question is who gets the vaccine first? And all of that is very important because the initial supply will dictate how much vaccine will go and to whom. It's looking like first, healthcare workers in hospitals will be the first people to be vaccinated. But the cascade downward from that is still being worked out based on the evidence and based on consensus from the expert in the state.
Doctor, talk to us about how severe the healthcare worker shortage is right now. It's been a very tiring year, to say the very least, for many healthcare workers. Do we have the workers necessary to ultimately hand out this vaccine?
Well, staffing in this next wave is one of the biggest risks that we have. We were in the global epicenter of the pandemic before in the New York metro area. We benefited from staffing that was sent from all over the country to help us deal with that surge. We won't be able to have that now because this virus is surging in almost every state in the country. We have the U.S. Army Reserves as well, a very skilled, effective, but limited resource. And of course, they're not going to be able to go to every hospital in the country that's seeing an increase in cases. So staffing is our biggest risk. We're doing as much as we can to mitigate that risk by managing our labor pool, making sure that we have childcare options and other issues that will reduce call outs. But we're very concerned about that. And that staffing is the same staff that will be used to administer the vaccine. So we have to be vigilant. We have to plan for this.
Doctor, looking at what the immediate needs are, of course, a lot of focus, the oxygen that's being sucked up in the room is from this vaccine news, but right now you have more immediate needs, obviously, at the health system, and that includes testing. There's been a lot of discussion about the strain that PCR testing is going under right now, with labs starting to see a little bit of pressure and backup, but a lot of conversations as well about what antigen tests could do in the interim and whether or not they're accurate enough to be used, as well as other rapid point of sight test. So where do you stand on that right now? And what are the other immediate needs that aren't being catered to in this whole conversation?
Testing is the most important resource constraint we have now, Anjali. When you see positivity rates like what we're seeing in Newark approaching 20% and even exceeding that, that means you're not doing enough testing, because for every positive patient, you by definition have to test almost every person that was exposed to that person. And you should really not even be seeing those positivity rates, because you should be doing way more testing that compensates for it. And you should see that percentage trickle down if you're doing enough testing. PCR testing is the gold standard for anybody who is symptomatic or has a known exposure to somebody with a positive test. That is not going to be easy with the supply chain so limited. The antigen tests are helpful for screening and surveillance, but they're not the gold standard for someone where you really suspect the disease because of the sensitivity issues like you mentioned. The other issue that we all have to be concerned about is, of course, hospital capacity. We know that hospitals aren't necessarily seeing the numbers of patients that they were seeing in the spring in the New York metro area. But frankly, Anjali, we're seeing so many people that had to defer and delay their care because of that long period where folks were afraid to come to the hospital for their care. Our hospital has been at census now at max capacity for 2 weeks. We only have about 35 patients in house now with COVID-19, but if that demand goes up on top of the folks that had to delay their care, we could be in a really tough situation.
And doctor, you talked about it a little bit there, the local situation that you're seeing in Newark, but you think about New Jersey broadly. Newark cases on the rise, Patterson, Elizabeth, these areas where I think the spread of COVID right now is certainly at a level that is unacceptable at best. How concerned are you about, you mentioned that hospital capacity, how concerned are you about that as we get into and through Thanksgiving here, and that perhaps people are not appreciating how close the state really is perhaps to that edge of what is an uncontrollable kind of situation?
I'm very concerned about it, Miles. We call it the doubling time, the time it takes for the number of cases to multiply by 2. That time has been going down and down every single day, which means that you're seeing exponential increases in cases. And the holiday season, especially with the cold weather, is a time when folks tend to want to gather, which is why Governor Murphy limited the number of folks that can gather indoors to only 10. I think that was the right move at the right time in advance of the holidays. But if folks don't heed those guidelines and take it seriously, it's impossible, of course, to universally enforce it in a practical sense, then we're really going to see a very bad winter ahead of us.
Dr. Elnahal, you talked about staffing levels, but I also am curious about the hospital budget overall, because earlier on in this pandemic, as we were seeing many more profitable procedures being delayed or canceled, a lot of hospitals were in tough straits. You're also a public hospital. So where do you guys stand right now in terms of your budget, especially at a time when, state budgets, municipal budgets are really tight?
It's a really important question, Julie, because it's not just about making money. It's about being able to sustain our operation in the midst of a global pandemic where the demand for healthcare, especially for vulnerable communities, is only going to increase. We thankfully did get a good tranche of funding from the federal government. Without that, we would have had to stop paying our employees and close our doors. That came in just in time, and we do still have funds there. But again, if we have to cancel elective procedures again, if we have to cancel a lot of the other procedures that our healthcare system pays well for compared to more routine care, then we'll be in the same situation and we'll have to ask for even more money from the federal government, and nobody wants to be there. So we really have to look in advance on what the needs are, especially for safety net institutions that serve predominantly majority minority communities and folks of lower socioeconomic status who really rely on institutions like University Hospital for their care.
On that point, how urgent is it that Congress passes another stimulus bill to help hospitals like yours?
I would say it's extremely urgent. First of all, for people's personal incomes and for income assistance to individuals, all of that ties back into healthcare. When folks don't have good economic well-being, they tend to be sicker and come in with more acute worsening of their conditions. But importantly, hospitals, I think, are going to be in a very similar situation. We've already seen reduced volumes even after we've seen a restart in our elective surgeries. People are still hesitant to come to the hospital to get them. And if that continues, we're going to need more assistance to keep the healthcare system running.
Thank you so much for your perspective on all of this. Dr. Sharif Elnahal is University Hospital President and CEO. Thanks for being here.
Thank you.
Let's turn back to the markets now and to what is going on earnings-wise. It is retail earnings reporting season, as we have been talking about. Macy's out this morning, and I know that Brian Sozzi's been keeping a close watch on it to see just how bad it was going to be. Indeed, it was pretty bad,
Really?
but not quite as bad as some analysts had expected, Brian Sozzi.
Hand over my eyes. Yeah, Julie, hand over my eyes and fingers on my nose, because this quarter stunk. And you see the pre-market move in Macy's. Stock is down about 5% for two good reasons. In a slide presentation on the site, the CFO noted that gross profit margins peaked in the third quarter. What does that mean in layman's terms? They might decline in the competitive fourth quarter, which is the holiday season. And number two, I know Macy's likes to think it's Amazon, it's a digital-first business. They also still own 700 stores. And in the third quarter, sales in those stores fell 36%. That is terrible.
Just the thing with Macy's, you look at the quarter, and we've seen a lot of retailers, obviously, they have their struggles. We've seen a lot of retailers benefit from this. We've heard from Charlie O'Shea earlier this week, was talking about the kind of K-shaped recovery you see, where the rich get richer, and a company like a JCPenney, like a Macy's, is going to continue to struggle. But there are ways to execute through a crisis, and basically none of them, Sozzi, seem to be happening at Macy's. I mean, sales, the revenue line, the top line for the company is basically a third of what it was for the same quarter last year. I mean, that's just not acceptable.
Here's Macy's strategies, Miles. They have a goal also in that presentation to cut $2.1 billion in costs by 2022. Basically, they will fire a lot of people and hopefully will turn operating profits in 2021 if sales come back a little bit. That's all there is to it.
Well, in the case of another retailer, a specialty retailer, things are looking a little bit better, although the picture seemingly was looking maybe similarly as dire. And that's L Brands. The shares are up 17% this morning. And this is a company that is shrinking to grow, in the words of our friend Simeon Siegel, an analyst who covers the company and has been saying for a long time, it can be profitable and do better, but it needs a smaller footprint. And it has a smaller footprint now. The company closed 239 Victoria's Secret stores year to date. And it was profitable in the quarter, $330 million in profit versus a year earlier loss. So sort of to Miles's point here, there are ways of managing through crises. And as we like to talk about, not every retailer is going to do well or poorly, depending on what's happening in the broader economy.
Well, Julie, I think Macy's may want to put a Bath and Body Works inside of their stores to drive some traffic, because sales in the quarter for that brand, for L Brands, up 56%. And Simeon Siegel, like you mentioned, friend of the show, you mentioned most of that gain was driven by home fragrance and body cares, 2/3 of that sales increase. Also, the other third driven by soaps and hand sanitizers. So again, Bath and Body Works playing in that, Macy's not so much.
And you know what? That was a pre-pandemic thing, right? Lotions and candles. That's been a working formula for L Brands for some time. And you talk about enduring trends. It seems like that's one. Again, it was in place before the pandemic, and certainly seems to be accelerating. To spend more time at home, and we don't want things to smell stale, I suppose, in the home.
You know what? Sweet smelling things, indeed, Miles. Thanks. Well, as we take it a break, just want to check on a couple of other movers that we're going to talk about more later in the show. One of them is NVIDIA, the giant chip maker. Those shares are down a little more than 1% today. The company's numbers last quarter look pretty good. Overall sales up 57%, record revenues in its video gaming and data center segments. It is forecasting 55% sales growth in the fourth quarter. Here's what might be a source of disappointment to analysts. It expects a sequential decline in its data center business, which has been big for them. Remember, NVIDIA is in the process of buying ARM Holdings for $40 billion. One other thing to mention, the shares have more than doubled this year. So you got to put that in context as you're looking at the action this morning. We're going to be talking to an analyst more about NVIDIA later in the show. Then there is Sonos, the speaker company, reporting an unexpected profit. Analysts thought it was going to break even, 33 cents a share in profit, revenue up 16%. And in its fiscal 2020 year, which has just ended, it was reporting its fiscal fourth quarter, its household membership, the number of households that have Sonos's, rose 20% to 10.9 million. We'll be speaking to the CEO, Patrick Spence, a little bit later this hour, so you don't want to miss that. And coming up next, we're going to dig more into the market action as we head toward the opening bell. Stay tuned.
All right, welcome back to Yahoo Finance Live, about 10 minutes away from the opening bell here on this Thursday morning. Futures pointing to a lower open. Let's talk a bit more about everything going on in the markets right now. For that, we are joined by Tim Chubb. He is the CIO over at Gerard. So Tim, let's talk a bit about something that you put right at the top of your note your concern about the state of the recovery. This morning, we see the initial claims number rising once again. Continuing claims continue to come down modestly, but certainly the weakness in the labor market that we have seen in some of the survey data and we've had economists warning about for some time appears to be showing up as the surge in the virus continues.
Yeah, Miles, thanks for having me. It's really taken a while for this, I guess, lack of stimulus to really start showing up in the market. And I guess the colder weather is now bringing some of the weaker data, especially in the labor market. But the market's been sort of juggling this two cross currents of fantastic news on the vaccine front within the last 10 days or so. And of course, this horrible looking chart when it comes to the COVID cases and deaths rising. And just as your last guest discussed, the other impacts that has on our healthcare system. And so, again, I think the market had underappreciated the amount of stimulus we had. And that's why the market is continuing to grind higher to all-time highs. And I think that to an extent, they're starting to try to look through the cases right now with the hope that stimulus is passed with obviously the expectation that we should see a meaningful growth rebound in 2021. But it's going to be a dark couple of weeks and maybe even a couple of months this winter as we struggle with COVID now that the colder weather is getting here.
Tim, I hear you. It is going to be a dark few weeks on many fronts. Do you think it's time for the market and investors to realize it is going to be a dark few weeks and we could see a market correction before year end?
Yeah, I think what we've seen this year, this has been such an unusual economic environment. And I think it's so hard to just put all companies in the same bucket. As passive investing has gotten popular and active has gotten less popular in the last 10 years or so, I'm beginning to wonder if this is going to be an environment that sort of kickstarts that trend where we begin to see active management pick up a bit further. And just due to the fact that there's a lot of winners and losers, that have become more pronounced, unfortunately, in this economy, especially in businesses where there's companies that are absolutely benefiting, much like, the business that you just mentioned, doubling in the last 12 months, and just goes to underscore, that the positive impact, unfortunately, that all this disruption is taking place. But, the market has run pretty hard, pretty fast. We have looked through a lot of the bad news and we have looked through and I guess been forward looking as far as the market's been concerned, a lot of the positiveness that I think 2021 will bring. But I would expect some bumpiness along the way, and especially if we don't get the stimulus bill that we're all hoping and expecting to help continue to support the economy through the dark period of time you just mentioned.
So, Tim, I appreciate your argument for active management, but I mean, to your point, markets have gone up this year and we're near record. So thus far, if you're passive, if you've passive and you've held on, you've actually done okay. So do you think, to be clear, do you think that is going to change the bumpiness that you're referring to? I mean, what kind of bumpiness are we talking here?
Yeah. So about, I guess the active versus passive debate, to be clear, for us, it's not really a religious argument. It's more, what areas or asset classes are most appropriate. There's a lot of research and data out there about how active managers and large caps in particular have underperformed. But I think as we look around the world and other asset classes like fixed income or even international stocks, given how those benchmarks are constructed and given how, as we've seen in the recent headlines with China, there is a lot of differences with accounting standards, with ethical standards, so on and so forth, that I think present a lot of opportunity for active managers. And if you believe that we're ultimately going to settle into this low growth, low rate environment like we saw in the last 10 years, and like Bill Gross had discussed back in 2009, and really how the Fed reiterated earlier this year with the average inflation targeting, then I think that's an environment where growth and credit continue to outperform. And so if you're an investor, even in passive vehicles, I think that should be a frame of mind that you need to focus on. So, as far as bumpiness is concerned, it's hard to say. Again, I think a lot of the timing of the positive news we've seen was unexpected. I think many of us were anticipating that we'd hear some positive vaccine news by the end of the quarter, but wasn't sure when. And, I think there's a lot of uncertainty about the stimulus bill still. But ultimately, that's going to be another catalyst higher for the market once passed. And I think there's been the commitment already there, from the Congress and from the Fed to do what it takes as far as stimulus is concerned. So, while we could see a pullback take place, I don't think it'll be anything to the extent of what we saw back in March. largely due to the fact that there is a light at the end of the tunnel, both from a healthcare perspective and I think to a large extent from a stimulus perspective.
All right, Tim Chubb, you're going to stay with us through the break. Coming up on the other side, we're going to have the opening bell here on Wall Street on this Thursday morning. Right now, futures pointing to a slightly lower open. We're back here in just 2 minutes.
This is Yahoo Finance Live. Futures pointing to a lower open here just a few moments before the opening bell. And a lot of people watching the COVID case count, which continues to climb here in the United States. U.S. total deaths related to the virus have now surpassed 250,000. New cases reported yesterday, just over 170,000. That is the second highest that we have seen reported in a single day. And of course, we've got closings and restrictions that have been increasing. New York City schools closed as of today after the city's infection rate climbed back to 3%. We did get some more positive vaccine news. A trial of a vaccine from Oxford University and AstraZeneca. It was second phase trials found that it does seem to be relatively safe. The next phase is efficacy, so we'll see what that one shows. And as we wait for these vaccines, the jobless claims are going up again, Miles.
Yeah, as we wait for the vaccines, the virus is going up again. And so I think Jay Powell and many others would tell us that following that would be a softening in the economy. Now, this is a modest softening, but it is an increase in the number of Americans filing for first-time unemployment benefits, 742,000 last week. That's against 700,000 expected by economists. Now, continuing claims, these are folks that have been on unemployment insurance for 4 weeks or more, 6.372 million, a little bit better than expected and down about 400,000 from the prior week. So making some progress there, but measured progress at best. And I don't think that anyone really believes we're going to see the labor market or the economy start to approach those 2019 type levels, certainly until there's a vaccine, and certainly, not for some time beyond that. And I think it's very important that we realize not only do we need to get the virus under control, the support we offered to the economy in the spring was extremely helpful. And there has been a lack of political will to get more of that out to consumers. And Brian Sazi, as we head towards the holiday season and we think about why the economy has performed well, it's come down to consumers. And yet some retailers are starting to paint a picture for us that consumers may not be as healthy as perhaps they seemed back, closer to Labor Day. Now we're getting, of course, towards Christmas.
Yeah, Miles, we're almost through these retail earnings this week, and you get the picture of the winners and losers this holiday season. Winners, Walmart and Target. You can go in there and buy big pieces of steak and hot dogs and Beyond Meat sausage patties, and that's all great. The losers, you have a Macy's and Kohl's, big sales declines. Macy's terrible this morning. Same-store sales down 20%. Kohl's sales down 13%. They don't sell Beyond Meat sausage. They need to. They also don't sell sanitizers. They need to do that as well, Julie.
Although interestingly, we are seeing companies like Target and Walmart that sell other stuff. The other stuff's still doing all right too. It's not just the meat and fake meat that is selling in their stores. There you've got the opening bell here this morning. We were anticipating a lower open here. We're watching those retailers, of course, among the other stock to watch on the docket this morning. Jared Blickery is taking a look at all of the initial action here as we get underway. Jared?
That's right. We're watching the heat map fill in here at the NASDAQ 100, and we're seeing some mixed action, mainly red. It looks like Apple's down about 0.5%, Amazon nearly 1%, but Microsoft slightly in the green. Just sorting by winners and losers here, because it has been an interesting week. We've seen rotation change and leadership change so many times over the last month. Pinduoduo and NetEase, I believe NetEase is an earnings story. Those are both up over 3%. Tesla's up over 1.5%, but you're seeing mainly red there. So Baidu, Activision, Blizzard, ASML, those are the biggest losers here. Let's check out the chip space, because I'm noticing a lot of these guys are in the red. That's after NVIDIA earnings, which really were pretty good. Guidance a little bit weaker than it could have been, but for the most part, we're seeing some red here. So let's take a look at the banking sector, because that has kind of been a bellwether for where the market is heading. We're seeing a lot of red here today. JP Morgan down over 1%. Looks like Citi and Wells Fargo, those are in the green. And we take a look at the retail space here. We're seeing Lowe's, that's up 2%, Target up 1%. So some of these retailers that we've been talking about not doing too badly. And I would just add TJX, which was up nicely yesterday on earnings, down 2% today. But it's not just the digital strategy that's getting everybody. It just proves that a retailer can actually get by on the old brick and mortar. So let's take a look at the energy sector, because crude oil has been holding above $40 a barrel for several days. Not much news on the next OPEC meeting, but we're seeing Chevron down about 1%, Exxon down nearly 1.5%. So the majors taking it on the chin here early. Now, in the EV space, we've been seeing a lot of these guys on fire recently. So let's sort by performance, and we can see that Tesla here is up 2%, Nikola up 4%, Ride up about 3%. So some positive love coming to those names. Now, the US dollar is up. So we're seeing a lot of these commodities in the red. Natural gas is down 6%, silver down 2.5%, and gold is down about 1%. Gold, by the way, has been threatening to take out some important lows here. So we're going to be monitoring that. Guys?
Thanks so much, Jared. We will indeed. All right, let's bring back in Tim Chubb from Gerard. He's the CIO there. We were talking about the big picture a little bit earlier, Tim. I want to dig down into where you, as an active manager, where you are seeing opportunities right now. And I know you're looking to some of the software as a service plays, enterprise software, et cetera. That's a group that's already had a pretty good run this year. So what makes you think that we're going to continue to see some momentum?
Yeah, I think it's a couple different things. One is getting back to sort of that big picture, that we discussed earlier as it relates to just this low growth, low rate environment continuing, and the premium that investors will pay, the premium multiple that investors will pay for a lot of those software as a service businesses is going to be higher in that environment. And so I think as long as we have, sort of this backdrop with negative real interest rates, and inflation doesn't necessarily pick up, and we don't see this reflationary environment, I think growth will ultimately remain in favor. And I think when you look at some of the cyclical stocks that are laggards today, and seeing this rotation take place where it's a little bit of a risk-off sentiment, those companies priced in so much good news for 2021 within the last 15 trading days. The XLE energy sector, I think, is up somewhere around the range of like 30% in the last 15 trading days, even despite the moves today, but still down 40%. And I still think that's necessary. It probably, reasonably reflects the outlook for 2021 and just how, companies will, allow employees to get back in the air and what air travel will look like. And so I think when you look ahead at 2021 and 2022, I think investors, as we maybe see some of these dark days, will ultimately find safety and certainty in some of these software as a service names. It's unusual to say when you're looking at these companies growing so much, but during downturns, you see investors flock towards these consumer staples and healthcare and telecom that are likely to be just linked to inflation as far as price increases and carry those nice dividend yields. But through the downturn this year, we've seen a lot of investors flock to these business staples. And so when you look ahead and see adoption for virtual desktops and cloud continue to grow, you look at e-commerce sales as a percentage of retail sales yesterday, report at just 16%. I mean, I don't know about you, but when we spend $100 in our household, a little bit more than 16 is going towards e-commerce. And so I guess my point is, I think a lot of these names, even that carry these premium multiples, and there's certainly exceptions, but you look at some of the enterprise security companies, as well as this sort of new iteration of customer relationship management, what we're calling CRM 2.0, as businesses try to reach digitally to their customers, and make investments in technology that will support that venture. Ultimately, I think, while again, these are premium multiple stocks, they demand those premium multiples, just like as we're seeing, with one of the big chip makers today, really not sell off after a phenomenal report. It just goes to show the sentiment around those companies. And I think overall, strong demand for those secular growth names moving forward.
And I guess, Tim, I would ask though, and it's not something that you flagged in your note to us, but I think about all we seem to hear on this program is the people liking value, people preferring industrials, materials. Obviously, home builders have already had a great run for a variety of reasons. And it's all premised on this idea that what led the last decade, what led the last market cycle won't lead the next. How do you think about that idea? And I guess, would you consider some of these SaaS plays as not part of the last cycle? Do you think it's a different part of the tech stack that can do well in the 2020s?
Yeah, two great questions. I think we're definitely entering this phase, this sort of sixth iteration of the industrial revolution, and a lot of those SaaS plays are going to be, a meaningful contributor to what that looks like. But, the reason that value didn't perform over the last 10 years was really due to, we didn't have this reflationary environment. And yes, we saw some years where that took place, namely after the 2016 election. In 2017, we saw the market, really favor value with the expectation that we would get an infrastructure bill, all this deregulation, of course, tax reform. And after tax reform came out, that next year, GDP only grew at 2.9%, when I think the president and others felt like we would accelerate further and get back to that long-term average of 3 to 3.5. And so in order for value to have a sustained period of outperformance, I think you need to have that environment where the yield curve is very steep. You have commodity prices rising. You have inflation that's more than what it is right now. And, that's to say, I guess, present. And so, when you don't have that reflationary environment set up, value is not going to have a period of sustained outperformance. And with the Fed keeping rates lower than probably they would have in previous market cycles with this average inflation targeting, again, we're trying to discount future cash flows. And when rates are very low, those stocks with high valuations or more meaningful valuations than, historically speaking, are going to look a little bit more attractive than they normally would. And so, couple that with the decline in the US dollar, it's down pretty significantly so far this year. We've seen tons of money pile into the US and prop up the dollar for the last 10 years. And these currency things, moves tend to move in 4 to 5 year cycles. I think this next cycle is dollar weakening. Well, who does that benefit? Technology stocks, because of how much exposure they have to revenue outside the US. And so I think the backdrop remains very positive for those companies despite their valuations, and ultimately they'll grow into them.
Tim, good to see you. Thanks for your time today. Tim Chubb is the CIO at Gerard. All right, coming up next as we watch stocks here at the open, in just a few moments, we're going to be speaking to the CEO of Sonos. Stay tuned.
Okay, investors are clearly tuning into the quarter just reported over at Sonos. The stock is skyrocketing 25% this morning. Let's bring in Sonos CEO Patrick Spence to get more on this one. Patrick, always good to speak with you here. Throughout your earnings release, throughout the earnings call last night, you speak to Sonos being at an inflection point. What is that inflection point, and why do you think you've arrived there?
It's great to be back, Brian. Thanks for having me. We think we've reached a point really where the power of our system has come through, and so we've really built our whole company on this basis that, we want to create great products and services which attract new customers to the family, but also that existing customers come back and add additional Sonos to their system. So that's always been the power of Sonos, is this notion that it gets better and better the more products that you add. And what we've really focused on over the last 3 years is accelerating our new product introduction cadence. So we've got on this consistent cadence of 2 new products every year. We've done that for the last 3 years, and that's really paying off in terms of attracting those new customers and really getting our existing customers to add additional products to their home. We've hit an inflection point where now you're seeing the profitability in the model as well, right? So for 15 years, we've grown, another year of great growth, but now you're really seeing it on the bottom line as well.
Patrick, I know you got a lot of questions last night on the call about some supply constraints that you guys had mentioned that you were facing. And of course, this is, your biggest quarter coming up here as we head towards the holiday season. Curious how any of those have worked out, and sort of maybe what some early returns you guys have seen with the holiday period. I know a lot of retailers are looking at this as an extended shopping period, not the kind of sprint we often see.
Yeah, I think that's fair, Miles. It definitely is an extended period. I think everybody saw a shock back in the summertime given the pandemic. And then there's been a lot of scrambling, right? So we were out of stock on, I think, 4 or 5 products in the summertime, just as we saw this increasing demand and a huge spike in demand. And we've really worked hard. Our team's done an amazing job to put us in a position where we still have a couple products that are short on supply, but we're in pretty good shape overall. And I do think it'll be more of a flat, less of a spike in this holiday period. And we're doing everything that we can at this point. Obviously, there's some industry stuff around container shortages that you've probably heard from others, and some logistics issues, just as everybody tries to really pick up from the pandemic. But we're feeling really good, as indicated by our guidance last night.
Patrick, you're one of the many companies that has actually benefited during the pandemic from people being at home more and wanting to be in a nicer environment, maybe have better sound or more options for sound where they are. What does next year's trajectory look like? What are you expecting in terms of demand as hopefully people start to get out and about in more decided fashion?
Yeah, I think, Julie, it's really interesting because, yes, we definitely, I think, have seen that people want to make their home more joyful. And so we've seen that over the past few months. But I also would point to the fact that, we've been at this for 15 years. We've adapted and we've been resilient in the face of the Great Recession, in the face of other things that have happened, in the face of big tech companies, coming in and competing in our space, in the face now of the pandemic. And so our team always adapts and is resilient in the face of anything that comes through. And what we've shown through that period is consistent growth and an ability to add new customers and get existing customers to add more. So as we've looked out and we think about the future, we think our model continues to drive really good growth on the top line and even better growth on the bottom line. And so as we looked at 21 and we're looking at the demand signals we're seeing, plus the roadmap that we have as well, we think whether we're in a world where COVID is keeping us inside or actually people are back to a little more normalcy, we're going to have a really strong year.
Patrick, we've talked in the past about how the tariffs have impacted your business over the past 12 months. What's your hope with regards to tariffs in the incoming Biden administration?
Well, the best news, Brian, is that we have actually put those behind us because of our diversification in our supply chain. So now that we're up and running in Malaysia, tariffs are not an issue for us in fiscal 21. So we've done what we can and what's in our control, and we'll let the voters decide and the government decide what they need to do on the policy front, whatever's best for the country. But the good news for Sonos and for our investors is that we've put those behind us.
Patrick, I want to ask about the streaming platform, the Sonos Radio HD that you guys have. What kind of uptake you've seen there? And I think you mentioned it's your 4th most streamed app or platform on Sonos devices, and maybe what your ambitions are there as you think about a lot of entrants into the space. We know who the incumbents are and how you're thinking about that today.
Yeah, it's complementary to a lot of what our partners do. All of the on-demand streaming services, all the great things like Pandora and Sirius and all of those. But one of the things that a lot of people don't know is that radio has been a huge part of the listening hours on Sonos. And so we saw a real opportunity to make the experience that much better. And do some neat things. So we've increased, obviously, with Radio HD, the quality, right? So you get really crystal clear quality, which is pretty cool. And you also get exclusive content. And so we're really using a lot of the talent we have in the organization, our passion around great music, the stories around music that we want to share with all of our customers. And so we just got started last week. This is a whole new world for us. We're super excited about it because services are very different. We can iterate with those. We're doing things on a day in, day out basis, whereas in our hardware business, we need to figure out what the right products are 2-3 years from now, and we're working on those today, right? So these are two very different businesses. We think they're complementary, and we think they're very tailored to the kind of customer that we serve as well.
Patrick, sort of speaking of complementary services, I have to admit, as someone who has followed your company, I'm surprised you haven't been bought, if I'm being honest, because there are so many other companies that sort of work with you, because of the growth that you have seen. I know you're constrained to some extent in what you would say about it, but how do you think about a potential acquisition at some stage?
Well, this is something I am very passionate about, which is I actually think we need more smaller, innovative companies that are trying to, build into something much bigger. I think we've gotten into a world where we have half the number of public companies we did 20 years ago. New business starts have been at an all-time low until we've hit the pandemic, actually. And so I think it's good for entrepreneurship. I think it's good for the economy if more of us actually try to, be our own business, stay independent, and try to drive more innovation at the end of the day. So I'm a huge advocate for people continuing to stay independent.
Hey, Patrick, you want to tell us your 2 new product launches before your March 21 Investor Day?
Well, that's obviously baked into our guidance, Brian. We're feeling very good about what we have planned for next year. And we're always working on some exciting stuff.
All right, I have to ask. All right, Sonos CEO Patrick Spence, have a good holiday season. We'll talk to you soon.
Thank you.
And we'll be right back.
All right, welcome back to Yahoo Finance Live. Miles Living here in New York. Let's take a quick look at the markets here about 20 minutes into today's trading session. Right now, things are mixed. Not a whole lot going on. The Dow and the S&P are in the red. The NASDAQ is slightly higher. But let's turn our attention to what's happening in overseas markets. Yahoo Finance's Kumana Ramanathan joins us for that. Kumana.
Hi there, Miles. Well, it has been a negative open for the European markets, and actually throughout trading today, a lot of the sentiment in markets, while we have good news on vaccine candidate developments, is that the fatalities around the world are increasing. We received news actually just a few hours ago that in the UK over the course of the year, 11% of deaths were actually attributed to COVID-19. So clearly some very damning news weighing on UK markets. FTSE's down about 0.8%. DAX also fell. CAC 40 down 0.6%, and the Euro Stoxx 600 also down about 0.7%. Now, sterling took a hit earlier today. That's after we received news overnight that the European Commission wants to see something published around what happens to businesses and how they should operate in the case of a no-deal Brexit. So clearly, we don't know where negotiations are going to go. Ultimately, also weighing on markets right now is that the UK could announce a trade deal with Canada to replace what it had with the EU. So again, no sense of where markets are heading, lots of uncertainty weighing into the markets overall over here in Europe.
Yes, the regular reminder that Brexit has not quite yet been settled after all of this. It's still 2016, I suppose. All right, Kumana Ramanathan, thanks for that. All right, coming up, we're going to have more here on Yahoo Finance Live. Again, mixed open here for U.S. stocks. We're back with more in just 2 minutes.
Yet another company is announcing this morning it is giving a pay bump to its employees. And this is another consumer-facing company. Brian Sazzi, you have been keeping a running tally of these companies. This time it's Starbucks.
As a matter of fact, I have, Julie. The whole article is on the Yahoo Finance site under my byline, but I encourage everyone to check that out. Yes, Starbucks. And it's coming in 3 different forms here. Starbucks is lifting the pay of baristas, supervisors, and cafe attendants by at least 10%. If you have 3 or more years of service, your pay bump is 11%, and the starting wage is being lifted by 5%. Now, let's keep in mind what this comes before. This comes before a lot of states push towards $15 an hour minimum wage over the next 3 to 4 years. 8 states are moving closer to that $15 an hour minimum wage. I crunched the numbers here using some data off of ZipRecruiter. Even with these raises, Starbucks' average wage will still only be $13 an hour. It's good to see this, but they have a long way to go, I think.
You know, it's interesting, Sazzi, to see these wage increases coming right now, because I remember 2014, 15, 16, McDonald's, Target, Walmart, they were all out raising their hourly wages. And the topic then was Here comes wage inflation. Here comes overall inflation. What does it mean for the Fed and so on? At this point in the economic cycle, where we have a lot of experts coming on tell us it's early days in a new cycle, early days in a new bull market. The Fed is years away from changing its stance on interest rates. These are essentially inflationary policies, right? I mean, I know that the reason that free market advocates hate the minimum wage is because it can be harder for an independent business to pay these kinds of wages. Starbucks can, take on the cost, but basically it sends a signal to the market what employees are actually worth. And I think we've all had a kind of a gut check on who should be paid what, given the positions that workers were put in during the pandemic. And so I just feel like we all kind of, Stasi, you and I, we kind of got into this point in life when it's like, all right, I guess we're all just screwed, right? Millennials won't have anything nice ever. But, there's a generational critical mass happening here. And if you actually want the middle-class consumers that all politicians talk about, you have to pay them some kind of a wage that gets them there. And these are the baby steps that are along what's been a years-long path now, I think, towards making that slightly more real, right? Let's not kid ourselves about the state of inequality here, but it's a step in that direction.
Well,
I mean,
go ahead, Julie.
I was just going to say, if there's one thing that maybe to sort of speak on a warm and fuzzier note that's come out of 2020, it's that there's perhaps an increased sense of empathy, right? We've all, because everybody has been experiencing the pandemic in different ways and had different disadvantages and advantages. But I think we've become more acutely aware of those, perhaps. And maybe that feeds into this trend as well. And so maybe also workers are more aware of their own worth, hopefully, and can ask for these types of increases where they feel that they're warranted.
That's a very good point, Julie. There's going to be massive competition for workers as the economy kicks into gear. What Starbucks is doing essentially today is making sure that workers don't head to Target for $15 an hour.
Well, at least they have choices, those workers do. All right, thanks so much, Shazi. Coming into the next hour, we are going to hear once again from the head of a hospital about how the pandemic is affecting his workers and his business. We'll be right back.
Hyman and Brian Sazi. Let's take a quick look at where the stock market is trading right now, about a half hour into today's trading session. Not a whole lot going on. We have a mixed market right now. The Dow and the S&P are slightly in the red The NASDAQ is slightly in the green. On the economic side, jobless claims data showing a rise last week, 742,000 folks filing for first-time unemployment insurance. That's the first increase we've seen in this data since early October, pointing towards a slowdown in the economy as COVID cases continue to surge across the country. And the race for a vaccine continues. AstraZeneca and Oxford out today with some positive peer-reviewed vaccine data. This coming just one day after Pfizer said its vaccine is 95% effective, and just 3 days after Moderna said its vaccine candidate 94.5% effective. And let's start with the surge in COVID cases here in the U.S. and the toll it's taking on the hospital system. For that conversation, we're joined now by Dr. Stephen Corwin. He is the CEO at New York Presbyterian Hospital. Dr. Corwin, thanks for joining the program. Let's begin with what you are seeing inside of your hospital system right now, and how concerned you are or how comfortable you are with the ability for your hospital staff right now to handle the amount of COVID cases and perhaps the expected number of COVID cases in the weeks ahead.
Well, we're at about 10% of where our peak was in the March-April timeframe, which was clearly horrific for us. We expect it to rise over the next month to month and a half, just given the trends that we're seeing. And we believe that we can handle it. But certainly with Thanksgiving, the Christmas holidays coming up, and what we're seeing around the rest of the country, we're certainly not sanguine about saying we've got it completely under control. I'm happy with where we are right now in terms of protective equipment, ventilators. We're still short of reagents for testing, and that's becoming a nationwide issue. And staffing is going to be a nationwide issue because if you recall, during the pandemic, we were able to get staff from around the country. Now the entire country is seeing this wave. And so we have to worry about protecting staff and making sure that staff doesn't get sick so that they can come to work.
Dr. Corwin, as of today, the New York City public school system is closed down once again. It had been doing blended learning. That's as the city's infection rate reaches 3%. This has been a very controversial decision to shut down the schools. What do you make of it, given the cases that you've seen in the hospital and given what we know about children being or not being a vector of infection?
Well, it was a difficult choice the first time around, and the mayor and the governor got heavily criticized for waiting too long. Certainly, in terms of children learning, it's a negative to close schools. There's no question about it. I think with the 3% positivity rate, the mayor felt compelled to do it. Look, the rationale for that we can debate in terms of will the kids get sick and what's the infection rate within the schools? Are they conveying the infection? But the reality is, since this pandemic occurred, we're titrating between how much opening can we withstand without creating an excess of infections and deaths. So difficult for me to criticize the decision. Certainly, there was a lot of thought that went into it at both the state and the city level. But anytime you close something, somebody is going to be injured by closing it. There's no question about it.
Dr. Corwin, as the infections have picked back up and the cases have picked back up, are you able at the same time to plan to the extent that you would like to vaccinate the public?
Well, I think that one of the problems with the current transition between the Biden administration and the Trump administration, or lack of transition, is that lack of transparency around do we understand how the vaccines, plural, are going to be distributed? How much will we get? And then what's the prioritization of that? New York State has developed an extensive plan once the vaccine is received. And we anticipate that in that first wave, not all of our frontline healthcare workers will be able to be vaccinated. So we have to prioritize various groupings in terms of where we think the risk is. I also think it's incredibly important nationally that we have an education program about the vaccine, that we insist on mass vaccination, because I think that's our way to get out of this. And I'm hoping that by the April-May timeframe, we will really have had a ramp up in production to be able to allow for mass vaccination. But we got to educate the public. We've got to make sure that people don't feel that they're being experimented upon. So we have to start that right now.
And Dr. Korn, I want to ask about the operation of the hospital outside of COVID. A major concern among the healthcare community back in the spring is that people were not able to come in for procedures that they might be termed elective, but they really are things they needed. What have you seen in your hospital over the last couple of months? Are people still reticent to enter that setting, or are you able to care for the patients that you want to and need to normally care for in addition to COVID?
We've gotten back to about 90+% of our pre-COVID volumes. The emergency departments still are shy of where they were, so we are encouraging people to seek care. We've dramatically changed our procedures for seeing patients. We've dramatically increased the amount of telehealth that we're doing so that we can provide primary care, preventive care, as well as follow-up care. So that's been good. I'm hopeful that we can continue that during this next surge. But we have levels of surge where at a certain point we're not going to be able to do what would be called elective cases, or in different parlance, anything except emergencies. In the first go-around, we were so overwhelmed, the only thing we could care for other than COVID was the true emergencies.
Dr. Korn, New York Presbyterian is a teaching hospital, is that correct?
Yes, it is.
So I'm curious what effect the pandemic has had on the incoming class and future classes. In other words, are more people wanting to enter the medical industry as a result of this? Fewer? What is the next wave of staffing and next generation of doctors going to look like as a result of all this?
Well, we actually have more people wanting to go into healthcare, and because they've seen the altruism and the importance of healthcare in general, whether it's nursing, pharmacy, physicians. So I'm very encouraged by that. And I will tell you that our residents and fellows, the trainees, did a remarkable job during the course of the pandemic, redeploying to make sure that we could care for all the COVID patients. And they did an extraordinary job, and we would not have been able to get through the crisis without our trainees as well as our attending physicians. So I'm very hopeful about the future of medicine in this country, and think that we've got terrific young men and women coming into the field.
All right, Dr. Stephen Corwin is the CEO at New York Presbyterian Hospital. Dr. Corwin, thank you so much for joining the program today. Thanks for all the work you and your staff
have
done.
Thanks as always. Appreciate it. Thank you.
All right, let's turn our attention back now to what's going on in financial markets. As you mentioned, a mixed open today. Not a whole lot going on, but it's been an eventful couple weeks. For a bit more on that, we're joined now by Dennis DeButcher. He's a senior managing director and the head of portfolio strategy and quant research over at Evercore ISI. Dennis, great to talk with you on this Thursday. Let's begin with something that you discussed right at the top of a recent note. And we talk a lot on this program about stocks, public equities, but you mentioned the bond market, the role that plays in the sectors that come into favor. What have you seen there that has changed and informed your view, and how are you thinking about the role of the yield curve today?
Yeah, it's a great question. So what's changed is obviously since the vaccine news has come out, you saw a bit of a uptick in 10-year yields, more of an uptick in 10-year yields, going from about 70 basis points to 96 consolidated some, and the yield curve steepened. But what's so important about the move higher in the Treasury yield, specifically the 10-year yield, is that it's happening for the right reasons. Post the election, obviously odds as fiscal stimulus have gone down significantly. And with the vaccine news, you saw Treasury yields go up, which means that investors are seemingly discounting a better real economic growth backdrop. And if you're discounting a better real economic growth backdrop, then the earnings should come up with that rise in U.S. Treasury yield, and it won't be a disappointment for the market, i.e. the S&P multiple shouldn't come down just because 10-year yields go up a little bit for the right reasons. And more importantly, it's very good for cyclicals relative to defensive. So the internals of the market become a lot more attractive for cyclical sectors, which include industrials, materials, financials, energy, et cetera.
Dennis, you've coined something called the human ingenuity trade. What is that, and how can investors make money?
Well, the simplest way for investors to make money on that is playing for a full reopening of the economy. So if you assume that human ingenuity in the form of vaccines, treatments, and just changing behavior, which has been a hallmark of our ability as a society to handle this pandemic since it started. If you assume that that's going to continue, which seems more and more likely given the vaccine news we've seen, then you want to be long a normalization in economic activity. And that means owning reopening type stocks. What are reopening type stocks? It could be commercial real estate. It could be airlines. It could be travel and leisure. It could be things that are related to ticket sales, et cetera. And so that's how you play that trade. And importantly, when we do reopen, and this is very important, the economy is going to be very strong, given how strong housing is, how high savings rates are, and the Fed's commitment to keep real rates essentially negative as far as the eye can see.
Dennis, given all of that, though, from what we understand, it's Julie here, by the way. Hello.
Hello.
From what we understand about deployment of the vaccines, even if we do indeed get the emergency use authorizations and the encouraging news that we've got on the vaccine front, we've got deployment to think about. And as we know, there are a lot of logistics challenges with deployment, particularly of the cold storage vaccines. We've got adoption by the general population to be concerned with. So even if we're going to come roaring out of this thing economically, do you think that we've got the timing right in terms of our understanding of how long it's going to take?
I don't think we need to get the timing perfect. I think a couple of things we have to assume. One, whatever deployment issues we have are likely to be figured out. Yes, Pfizer's vaccine appears to have to be stored at some ridiculously low temperature. Moderna's does not. And we still have AstraZeneca, J&J, and those trials coming, which could be more like normal vaccines. As far as distribution is concerned, whatever bottlenecks happen, assuming they're not catastrophic, I don't really care from a discounting point of view and thinking about your future earnings growth if normalization of the economy is in July or in October of next year. It might make a little bit of difference near term, but it ultimately doesn't make a big difference in the long-term scheme of things, which is why I think investors will look through it. It really has to be a catastrophic problem, meaning we just cannot get these deployed. And secondly, on uptake, my big catchphrase on this is I think for sure that people are going to take their freedom shots. I mean, we talk a lot about a willingness to take these vaccines, but all the data more recently has been trending in favor of, relative to about a month ago, in favor of people being comfortable with taking vaccines. This news helps. And I highly doubt that if the choice is we don't take vaccines or we actually get our lives back, that we're going to, side with not taking the vaccine.
And Dennis, you have this idea of rates being up for the right reasons that I like. I think we can all agree that not all 1.5 handles on the 10-year are created equal, but something that is related to that, I guess, is the housing market. Today, we just get existing home sales numbers. This is 2006 type stuff. 7 million homes at an annualized rate. This with a supply shortage, and I know in your note you cite your colleague Stephen Kim's recent note, which was just a tremendous outline of where the housing market stands right now. How are you thinking about the housing market in the context of the current market cycle, in the context of a reopening in 2021, 2022, and the way that buying a home changes a lot of people's kind of outlooks? And we've seen millions do that in the last few months.
I think the most important thing, the way we're thinking about the housing outlook, if you put a very longer term trend, is that coming out of the global financial crisis, you had baby boomers exiting the labor force and downsizing, and millennials were not filling that gap. Now you have millennials more or less filling that gap and starting to think about moving out of city centers and obviously buy homes, improve homes, build up homes, et cetera. So that's point number one. Point number two, there's a huge consumer net worth benefit. So when you look at how low real rates are likely to be, it implies a lot higher home price over time, which is really important for spending and driving the savings rate lower. Kind of goes hand in hand. So your home price goes up, saving rates come down, and economic growth goes much higher than would otherwise be the case. And then third, an obvious pushback, you could be like, hey, dummy, aren't 10-year yields going to go up to a place, call it 1.5%, 2%, that's going to kill the housing market? Well, keep in mind that the mortgage spread, so 30-year fixed versus minus 10-year yield, is still at the 75th percentile. So mortgage spreads are very high relative to U.S. Treasury yield. So you can afford a 1.5 or 2% 10-year yield and still support the housing market, assuming mortgage spreads continue to collapse, which will happen if U.S. Treasury yields are going up for the right reasons.
All right, Dennis DeButcher with Evercore ISI. Dennis, great to get your thoughts. Thanks for joining the program.
Thank you.
All right. Earlier today, we got unemployment data, not the most encouraging we've ever seen. Initial jobless claims, 742,000 against 700,000 expected by economists. And this whole COVID period has really brought to light the inefficiencies, the problems that exist within the current unemployment system. Yahoo Finance's Jess Smith joins us now for more on this. And Jess, I know you spoke with Senator Ron Wyden of Oregon. He has been driving the charge to update the unemployment system really since the beginning of this pandemic. And certainly that's coming even more into focus as this period drags on.
Yeah, I did talk to Senator Ron Wyden, and he says it's really time to start looking at long-term reforms, as we've seen all of these problems with the way the U.S. handles unemployment benefits throughout the pandemic. He says if Democrats manage to take control of the Senate, so if they win both of those races in Georgia, he will be the top he'll be the top lawmaker on the Senate Finance Committee, and doing this will be one of his top priorities. So here are some of the ideas that are being tossed around. I talked to Wyden and a few other experts and lawmakers about what they would like to do. First, they would like to update the technology. You remember back in the spring when we first saw these record waves of jobless claims, the state systems were totally overwhelmed. They crashed. People had to wait for weeks or months for their benefits. So now lawmakers and experts want to update that technology. There seems to be broad bipartisan support for at least addressing that problem. Next, some people say that the chaos throughout the pandemic has shown that the federal government should take over the systems instead of having this patchwork of systems from state to state. That is going to be a heavy lift to try to get that through Congress, but it's something that they might consider. Wyden says that it's time to look at that, but he is not actively supporting it yet. Next, making gig workers eligible. That's another plan. The CARES Act did include a program that made gig workers, independent contractors, and others eligible for unemployment insurance. And now some say that change, or at least something similar to it, needs to be made permanent. There's also a push to expand benefits, to establish a baseline standard that states must follow to make the benefits more generous or last longer. Not everyone will be on board with that plan because they say people in Mississippi don't necessarily need as much money as people in a place like New York. So I asked Senator Wyden what he had to say about that. Let's watch.
Differences in the cost of living, certainly it's appropriate to take those into account. But my view is, and what I'm going to be looking for, is all of the ideas for making sure there is a floor of dignity for all our workers.
Wyden said he was fully aware that it's going to be difficult to get some of these changes through Congress, but he said he's going to try and make this a priority. He did point to the battle over that extra $600 boost in unemployment benefits. He said that shows just how difficult this could be going forward. I did try to get a comment or an interview from the top Republican on the Senate Finance Committee, Senator Chuck Grassley, but his office did not make him available. And I should note, I did put in the request before he was diagnosed with COVID-19 earlier this week.
All right, Jess Smith, with the latest on all of that. Unfortunately, Jess, I fear we're going to need the unemployment system for some time to come. And I don't think anybody wanted to address the problem the way that we have been required to, but such is life. All right, coming up on the other side of this break, we're going to have more on the markets. NVIDIA shares under just a little bit of pressure here, off about 1.5% in the early going after the company reported its latest quarterly results last night. We're going to discuss those coming up right after this.
This is Yahoo Finance Live. NVIDIA shares down about 1.5% today. This is after the giant chip maker came out with earnings that were actually quite strong. If you look at how they were versus estimates, overall sales up 57%. The company's earnings per share $2.12, and they're forecasting 55% sales growth in the fourth quarter. What might be the area of disappointment? The company expects a sequential decline in its data center business sales in the current quarter. Let's bring in Daniel Newman to talk about this. He is Futurum Research with Futurum Research analyst. Daniel, is that a source of disappointment for you? Do you think that's why the shares are down? And did you see anything else in this report that gave you pause?
First of all, it was a very, very strong quarter for the company. It's the second quarter of reporting the Mellanox revenue into the overall number, which obviously showed that huge spike, over $1 billion of growth year over year in the data center business. Organically, though, it was 77%. So everyone's looking at that 160 or so percent growth, but 77% was organic. And this is really a byproduct of Jensen Huang's vision of the AI space, of addressing the enterprise and the new Ampere architecture. Companies like AWS investing in this and putting this into their cloud offerings, and of course, enterprises investing at scale. I do think, Julie, to your point, that some of the pressure and the sort of anticlimactic result after such a big earnings beat did come down to people looking for that continued huge sequential growth in the data center business. And given the fact that basically the company came out and said it's not going to happen next quarter, I think a lot of people that wanted to see that continued growth. If I can say one other thing, since you asked, the ARM deal, I feel like drove an immediate spike in value. The stock really shot up almost to the point where it covered the entire $40 billion in terms of market capitalization after the announcement. And I think people have really been looking out to what NVIDIA can be, and that has driven the price. And so it's a true example to where the price is reflective of where people see the company. And so to some extent, maybe it felt like it was maybe a little overbought, and some people sold now and said, hey, it's a good opportunity to take some profit in the company. But overall, my feeling is the company's in really good shape. It's in a great position. And this ARM deal, assuming it goes through, is going to be very, very good for the company long term.
Well, Daniel, take us through that. What are you envisioning financially? Let's assume that ARM deal is closed. How does that change the financial makeup of NVIDIA over the next 3 to 5 years?
Well, so NVIDIA really right now is very focused in that AI space, but there's a couple of new business opportunities that the expansion in ARM offers the company. First of all is the licensing revenue promise. So ARM essentially licenses its intellectual property and technology to almost all of NVIDIA's competitors, which is going to, of course, make this process of completing this deal very interesting. But all of a sudden, the company's playing in mobile devices. The company's playing in CPUs for notebooks. And these drive extraordinarily profitable revenues. You saw how profitable Qualcomm was in its earnings, in its most recent earnings result. And that's a big core to Qualcomm's business, is it's a licensing business. NVIDIA doesn't really have that revenue stream. So this is a whole new revenue stream for the company, playing in the entire space, being able to benefit more from 5G, from mobile, from CPU, IoT, areas that the company really isn't right now. I wrote a piece on MarketWatch, Brian, that I basically said the $1 trillion valuation potential lies in getting this ARM deal done. That's how ambitious I am, that this deal could be a huge winner for the company. I also think there's going to be a ton of discussions. You're going to see a lot of regulatory battles around the world. This is not going to be a slam dunk deal by any means for the company. And I think there's a little bit of nerviness in investors there as the company's hit this really high watermark. The growth has been really fast. This deal getting done is going to be really important. But the execution has been fantastic. Margin, Brian, has been great. And the results have been really good in its two key areas, which is essentially gaming and data center. And the rest of the business is moving along quite nicely as well.
So to your point, Daniel, the shares have more than doubled this year. A lot of optimism about that deal. What could go wrong in all of this scenario? Could it be an execution stumble when it comes to the deal, or could it be something else?
That's a really big question, but you have to presume that the biggest competitors of NVIDIA, so we look at companies like Intel, you look at companies like Qualcomm, even Apple, who just released their new ARM M1 architecture, are now going to have to go to NVIDIA to procure this IP or these chips. And that's going to be a different go-to-market proposition. ARM sort of had this arm's length, no pun intended, from the market where they license the intellectual property to any and all. And so NVIDIA is promising that that will not change. And I think that's going to be a big point of discussion throughout the process. I am bullish that I think the company will be able to get it done. Jensen has shown through the acquisition of Mellanox that the company is able to move big deals through regulatory bodies. You know, you're going to look at regulatory here in the US, Julie, but you're also going to have to look at regulatory bodies like the CFTC, KFTC, and across, and also Europe, which is always very, very willing to look at anti-competitive or any sort of competition issues to slow down deals. I believe the company gave themselves a nice time horizon to get this deal done, but that is, I think, the linchpin to this next massive wave of growth of the stock is going to be people feeling confident that this ARM deal is going to get done.
Well, we look forward to checking in with you as it does progress here. Daniel Newman, Futurum Research Analyst, thanks so much.
Thank you.
All right, stay with us. We'll be right back.
All right, welcome back to Yahoo Finance Live. Miles Udland here in New York. The last decade, all we've heard about fintech this, fintech that. Google has been involved in the space, and yesterday they announced some changes to their Google Pay app, and we can talk about what they are trying to compete with, who they are not trying to compete with, and where we stand in the whole cycle. For that conversation, we're joined now by Josh Woodward. He's a product manager over at Google Pay. Yahoo Finance's Dan Roberts also joins us for this conversation. So Josh, let's begin, I guess, with the macro cycle as you see it of the evolution of Google Pay and also all the other apps that are in the space, the Squares, the Venmos, the way that PayPal has changed, and how you kind of see your product fitting in there and the things you guys wanted to do with this latest release.
Yeah, Miles, great question. Thanks for having me on. So we, like you said, have been working on Google Pay for years now. It's actually live in over 30 countries, soon 40. 150 million people use it every month. And I think what we were really excited to launch the product yesterday because we wanted to see if we could bring together three different things in one app. What we've seen from our research is that people feel a lot of anxiety, a lot of stress when it comes to their money and how they manage it. And so the new Google Pay app helps you do three things. Helps you pay friends and businesses. It helps you save money with offers and rewards. And it also helps you get insights about your money so you can stay on top of your spending.
Josh, Dan Roberts here. There's a lot in this announcement and a lot of new features here. And of course, some are framing this as Google Pay's targeting Venmo, PayPal, even banks, because you are launching Plex accounts. Do you guys see it that way? Do you see it as a competitive shot at a number of these existing players? Or do you just see this as it was a natural evolution of our previous app?
Yeah, I think it's a great question, Dan. When we're developing products at Google and on Google Pay specifically, we're really focused on where are users feeling the most pain when it comes to managing their money. And what we look for as product managers, as designers, is kind of where are they finding those points where they're grumpy about using things to do with their money. And so I think for us, when it comes to how we think about the app, really, I think what sets it apart is, like you said, we're trying to pull together a few of these different adjacent use cases into one app. When it comes to competing with banks, it's actually completely the opposite. So if you see our Plex account strategy, what we're doing is we're actually partnering with banks. We announced yesterday there's 11 banks participating. And what happens is Google brings our UX, our technology expertise, and we match that up with the bank's financial and regulatory expertise. And the banking account is actually, you can activate it directly from within Google Pay, but your money's with the bank. And so we're really trying to bring those two together in a unified experience for customers.
And Josh, to give you a personal anecdote, on my Chase app, I actually often find it very, very difficult to search for specific charges or search for an account that I know I have that has a recurring charge. I saw already an analyst note from somewhere this morning that said one big appeal of these changes is searchability, and likened it to basically Gmail, but for your charges, your spending. Is that what you guys are really pushing here? I mean, can people think of this as a Gmail for your banking and your spending?
Yeah, so it's an interesting comment. We do think that one of the big challenges right now is that people actually having the information about their own money and their own finances. And so one way we're trying to make that more accessible and easier to use is actually bringing in features like search. Now, what's interesting about search in GPay, and if you haven't had a chance to try the app, or if your viewers haven't, I'd encourage you to try this. You can actually do different types of searches. So right out of the box, you can search for things like the name of a business where you made a transaction. But with your permission, you can also link other accounts into Google Pay. So again, these are optional features. They're off by default, but you can link your bank account or your credit cards or your debit card. And that's when search, I think, gets really interesting, because you can search for certain things like Mexican restaurants and find those categories very quickly. Or you can even do things, if you want, you can link in your photos of receipts you've taken. Again, another feature that's off by default, but you can turn it on. And when you do, you can search for very specific things like shirt or tent, and you can find those receipts that you've taken a picture of. So that's a way, Dan, we're trying to make just natural language search much more easy and apply it to your transactions.
Josh, you mentioned that you guys are partnering with banks right now. Obviously, being a bank is a very big undertaking for any firm. As you think about the evolution of Google Pay and those kinds of services, do you think that Google wants to be a bank? You are offering banking adjacent services, but it's very different when you're the kind of primary backer of that. Is that something that you guys talk about or think about, or is that just kind of put the company in a completely different trajectory?
Yeah, Miles, we get asked that question a lot, and we have no plans to become a bank. I think you can see that from our strategy, not only in the US, where we've partnered with banks, but other countries as well. Take our app in India, for example. That's another place where we've taken this ecosystem-centric approach, and we've worked with the National Payments Corporation. We're using the national rails to transfer money with the banks. And I think that's really another differentiating part of our strategy, is we're trying to work within the ecosystem and within the regulatory framework that exists.
All right, Josh Woodward, product manager with Google Pay. Josh, thanks so much for joining the program. Great to get your thoughts.
Yeah, thanks for your time, guys.
All right, and as we go to break, just want to have a couple headlines here. Crossing the tape in the last couple of minutes, New York City Mayor Bill de Blasio speaking at a press conference saying that he expects indoor dining in the city to shut within the next week or two. Says it's just a matter of time until that decision is made. Of course, today begins an at least 2-week-long period where New York City public school students will not be in the classroom. This as the positivity rate here in New York rising above 3% on a moving average. And I think investors focused on this not only because of their proximity to New York City, but the view that New York was the leading edge of the crisis back in the spring, and that a decent proxy for the national appetite, perhaps, for new restrictions can be found here in New York. So a story that we are watching closely at Yahoo Finance. All right, we're going to have more coming up on the program, coming up right after this short break.
This is Yahoo Finance Live. We have been talking a lot about fiscal stimulus, what it could look like, if it's still coming, when it could come. Miles, you wrote about that in this morning's Yahoo Finance Morning Brief, about given that we are now sort of expecting a vaccine to come at some point, doesn't mean we don't need stimulus, but maybe it changes what it looks like, how big it needs to be, et cetera.
Yeah, I mean, look, I don't think any of us are naive enough to believe that fiscal stimulus is magically going to happen in the next 62 days before, Joe Biden is sworn in as the next president. It seems dead right here. And I think that's very unfortunate. And the vaccine news makes that even more unfortunate, because I can understand why politicians who believe themselves to be, fiscal hawks or whatever, are reticent to write blank checks for indefinite periods of time when we do not know what the future path of the economy looks like, given what we don't know about the virus. But right now we have pretty good, to use a consulting term, pretty good line of sight on when this pandemic may get under control, may even be able to end. And that is 2 or 3 quarters from now. And it is frustrating to see politicians not view that timeline as a reason to get acting today on helping businesses that are going to be closed today. The restaurant industry here in New York City is in crisis. It's facing an additional crisis on those headlines we just mentioned. Bill de Blasio saying the indoor dining is probably going to be closed. That effectively kills seated diners at restaurants in New York City. That's happening right now. These businesses are not going to make it through the winter, but there is going to be a somewhat normal summer, we hope, and we think we can be confident in that because of the vaccine. And for politicians to not see that timeline as a reason for them to act right now is quite frustrating. And it's basically backwards, right? When you have a timeline, you should act on that timeline. I can understand arguments around, I don't want to indefinitely put plan X, Y, or Z into place. But when you can say, all right, this money is going to get you to point A, which we know is 6 months away, 9 months away, that couldn't be clearer, in my view, on why and what these businesses need.
And Miles, you know what doesn't help that restaurant in New York City that's about to close and potentially close for good, asset buying from the Federal Reserve. I mean, really, what else can the Fed do here?
Well, I mean, the Fed the Fed does what the Fed can do, right? They do monetary policy and they can help to encourage fiscal policy. Their facilities are designed for Congress to authorize all kinds of programs to support all kinds of businesses. But yeah, look, right now that means that Apple gets to come to market for even less, for even less borrow. And I mean, I guess Apple doesn't really need the help to shore up its balance sheet from the Fed. And I think it's a failure of imagination at a number of different levels. Look, we got the federal level, the local level, the state level. You see the MTA news yesterday. I know we're going to talk about that later. I mean, that's just, where's the federal government, right? The MTA has rules. The federal government has unlimited money, and we're going to, ruin a city's infrastructure based on $12 billion, which over the next couple of decades is basically nothing. I mean, I think, again, it's all a failure to really conceive what is happening and what the resources we have are to fix that. But that's been in place since March.
Yeah, I mean, and also just to keep in mind, it's all comes down to partisanship, right? And if they can't get together on this urgent issue, it's not a very hopeful view for what can get accomplished in terms of legislation to build the economy or do anything else over the next few years, it seems to me. All right, on that note, we're going to take it to break. And after the break, we're going to talk about something a little happier. We're going to talk about cake with Buddy the Cake Boss. We'll be right back.
All right, welcome back to Yahoo Finance Live. Miles Udland here in New York. As you may have heard, as we just went to break, some discouraging headlines for the restaurant business coming out of New York City. Mayor Bill de Blasio saying that indoor dining likely to shut down in the next couple of weeks. Let's talk a bit more about the state of the restaurant business and a lot more going on in his orbit. We're joined now by Buddy Valastro. He's an American baker, TV personality, owner of Carlo's Bakery, and star of TLC's hit show Cake Boss. Buddy, it's great to have you on the program today. I'd love to start with kind of your thoughts on how the shape of the industry right now, how your business has fared, what you've heard from your peers, the folks that you've known for a long time? A lot of people are hurting out there. Things are not getting better. What's kind of your overall assessment right now?
Well, I couldn't agree with you more. I mean, it's really a tough time in the restaurant, bakery, retail business right now. We're probably doing about 40% of what we would normally be doing. And realistically, especially like take New York City. New York City is probably doing maybe 5% of what it would be doing because it's just kind of, there's nobody there. There's Broadway's not there. There's tourists not going there. And my long-term worry is not only for the restaurants, but all the landlords, right? Because a lot of these buildings are leveraged. And, if you were paying, and I'm just going to use a fictitious number, but say you were paying $50,000 or $100,000 a month in rent, right? And your business is down, you're doing 40% of the business. Well, what could you pay in rent? So you're a landlord, you're getting $50,000 a month. Now you're lucky if you can get 10, and the business still can't make the money. The restaurant business is tighter than the bakery business as far as margins go. But when it's capacity. If you don't have, because I have a restaurant in the Venetian in Las Vegas in Buddy V's. It's an Italian restaurant, and we're probably the weekends are great, but during the week that business ain't coming back until the conventions are back in town. And realistically, how long is that? You sit back and you think of COVID, and I know you guys do this all day long, but just from a guy like me, when is that business coming back? Think if you're in a convention business, you're the guy who builds the booths, the stands, the people who work in the convention center, whatever. You know how many that industry is finished, basically, for how long? Or if you're in the wedding business, right? Wedding venues. Think of the DJs, the photographers, the florists, whatever. There's a spiral effect that I don't think we have seen yet.
Mm-hmm.
As a country, and honestly, I'm worried. I really am.
Yeah, buddy, let me just hop in there here. What would you like to see from the powers that be? The powers that be in New Jersey, the lawmakers. How could they make your life easier, just from a business perspective?
Honestly, it's a tough situation. And people make it about partisan politics. Whether you're on the left or the right or whatever it is, and realistically, it was something that nobody could have fixed, in my opinion, right? COVID affected the world. It didn't affect America. And, there's countries that are more advanced than, not countries that are less advanced than us that it's affecting, and it's affecting us the same way. There's certain problems that until we open up, until there's a vaccine, until people stop dying from this, it's really never going to go back to normal. I wish that I had the magic pill that we could take and then we're going to go back. We got to try to strive for a vaccine, which we're there and we're closer. And, there's a lot of people I talk to that are like, yeah, they got a vaccine, but I ain't taking it, or they don't trust it yet. So, you have that fact. If my, educated guess would be this time next year, we should be getting back to normal. But how long can other businesses sustain? Think about malls, right? I mean, we're in a mall in Florida, in Orlando. Traffic's down 80%, like in the mall, because it's a highly tourist-driven mall and stuff like that. How do you survive? And then we're one of the only surviving business. There's 10 other stores around you that it's a no-win situation.
Yeah, traffic is a big problem. We spend a lot of time talking about malls here on the show, buddy. I do want to ask about another part of your brand and your business on a bit of a lighter note and a happier note, I hope, is that you're coming back to TLC Food Network. You're going to be doing a show, Buddy versus Christmas. And one of the other things that's been interesting during this pandemic is home baking has really had a resurgence, right? I know myself, I'm not much of a baker, but I've been doing a little more baking than I had been. So now when you're doing a show like that, how do you change your approach at all? or what do you hope to bring to people who are watching at home?
Well, I mean, for me, it's always about inspiring people to want to bake at home, whether, you're opening a tub of Pillsbury, cookie dough and slapping it on a sheet and doing it with your kids and creating those memories that you'll never forget, or whether you're trying to make one of the cakes that I'll make on Buddy vs. Christmas, as long as you're doing it as family. And I feel like that's the one good thing that's come out of COVID is that, people are spending more family time and doing more of those activities, which is amazing. I just, in my opinion, really hope that we could try to, I hope that business owners out there pivoted and diversified. See, I'm lucky in the fact that I'm diversified. I do television, and then I own a production company that makes the television, and then I own bakeries, and then I own restaurants, and I own real estate. So if you're diversified, yeah, you might be doing bad here, but then you're not going to do well there. I could tell you that I had a pivot in April, and my online has went, 50 times, maybe 300 times of what it was, and it opened my eyes. I'm like, hey, listen, you know what? I'm sitting back and I'm like, my wife don't go out anymore. She gets everything delivered to the house. So if I could really focus on this, and we're on like a Goldbelly and carlsbakery.com, that's where the future is. So my advice to any entrepreneur out there is you got to pivot, man. This is the time where you make your bones. And I'm actually doing more and taking this negative into a positive and looking at business strategies that I might have not been so excited about, say a year ago. But when you take it back, it's like, hey, listen, all this stuff is coming out of one location. It's at my factory. It's easier to maintain than, say, 25 different people making it at one time. It's actually easier.
All right, there you go. Sage advice. I think anybody in any industry would be happy to receive. Buddy vs. Christmas this Sunday, 10 o'clock on the Food Network. Buddy Valastro, thank you so much for joining the program. Really great to talk with you on this
pleasure, guys. Thanks,
right,
man. Take care.
Yeah, appreciate it. All right, we're going to have more here on Yahoo Finance Live coming up in just 2 minutes.
Radio Shack might be coming back. At least if a group of entrepreneurs has their way, they might bring it back just online. Miles Udlin is eagerly awaiting the return of that famous 80s and 90s retailer, really more 80s than 90s, right?
Look, it is the holiday season. We love discussing retailers. There's a very interesting just kind of subplot here with this Retail E-commerce Ventures group. They have bought up the rights not only to Radio Shack, but also local sporting goods concern, Modell's. They also own the rights to Pier 1 Imports, Steinmart, among others, Brian Sazi. These guys are just going out. If you were a big retailer 20, 30 years ago, you went bust, you have some IP, it is sitting there, and they're like, great, we'll set up a website. We'll give it a shot.
What amazes me, Miles, about this Radio Shack story is they still have 400 stores open, operated by independent operators. Here's my hot tip of the day to those operators. Close that store down, open up a Dunkin' Donuts. I mean, let's get real here. Who is going to Radio Shack?
It's a very good question. All right. I'm looking at a new report out today that looks at the so-called Zillennials, another new word for Gen Z, overtaking millennials in income by 2031. That's according to a new Bank of America report. You know, these various money guys like to look at the rise of the next generation, the effect that's going to have. And they say a lot of these folks live in emerging markets. 9 of 10 of these Gen Z folks. India accounts for 20% of that total. And there are various trends that are going to affect investing as well as just trends globally. Majority of those folks have a meat restriction of some kind. I know your ears are perking up on that, Brian Sazi, with your coverage of Beyond Meat. Of course, they're very tech focused. So it should be interesting to watch some of these trends. Millennials were a huge investment thesis for a while. We'll see what Zillennials end up doing.
Your kids are Zillennials, right? They count?
I don't know if they're too young. I don't know what the cutoff is. It's a good question. I think they're too young to be Zillennials, actually.
They're 20 years younger than me. That's roughly what I know.
They were born between 1996 and 2016. So yes, okay, my kids are Gen Z. They eat meat. All right, keep it right here. Akiko Fujita and Zach Guzman going to take you through the next 2 hours.
It is 11 a.m. here in New York City on this Thursday, 90 minutes into the trading day. Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman. We are seeing a bit of a mixed picture here emerging on Wall Street. So far in the trading day, we're seeing the Dow now down 110 points. The NASDAQ, the only one in the green, up 51, and the S&P 500 trading pretty flat, down about 6 points there. Part of the reason we are seeing the negativity coming through here on the Dow, those jobless claims that came out today, rising to 742,000. That is the first increase we've seen since early October, indicating a slowdown in the economic recovery as we continue to see these coronavirus cases tick higher across the country. Also, the race for a vaccine, AstraZeneca and Oxford coming out with preliminary findings from its peer-reviewed trial just one day after Pfizer said its vaccine is 95% effective. So let's begin there for this hour. We've got Yahoo Finance's Anjali Kamlani standing by with the story. And Anjali, we heard from the company today saying this triggered a strong immune response, particularly in older adults, which of course is very promising news given that they're the most vulnerable.
Absolutely. And that's some of the key points. Of course, this is from their phase 2 trial, and they're looking at, moving forward. AstraZeneca, of course, we know is the company that had to pause their trials earlier this year. And so moving forward is very important when it comes to the global distribution of the vaccine. They have agreements with so many different countries across the world and are a key player in the World Health Organization efforts as well. So very key results from the vaccine company, as well as looking forward. Of course, we anticipate some of that strong result. We know that while it is a different platform than what we see with the Pfizer and Moderna vaccines, this is going to offer an alternate, especially because we know that the different types of platforms are going to sort of have different responses in different people and different groups and different age groups. And so all of this, of course, very positive news as we near the end of the year and look forward to more applications for vaccines. Kiko.
Yeah, and we are seeing Pfizer shares down, though, under some pressure in this session there. All right. Thanks so much for that, Anjali. Let's move on to our next story here. The data out this morning, the number of Americans filing for unemployment benefits rising unexpectedly last week. 742,000 workers filed for those initial jobless claims, signaling a slowdown in the economic recovery. With the federal program, we're talking about expanding and enhancing those benefits set to expire at the end of the year. Our next guest says workers could be headed for $150 billion shortfall in reduced income. Let's bring in Brett Ryan. He is a senior U.S. economist at Deutsche Bank. And Brett, the number we got out this morning seems to sort of confirm the concerns that have been emerging over the last several months, which is that the momentum in this economic recovery is slowing.
Yeah, good morning, Kiko and Zach, and thank you for having me. Part of the increase in initial claims this morning was due to the state of Louisiana, so I don't want to overstate the weakness in today's initial claims. But I think the more concerning trend that you're seeing is that the decline in continuing claims at the state level is probably overstating how robust the labor market recovery is going, because what you're seeing is an increase every week in pandemic emergency unemployment compensation, which is the extended benefits program. And there are still a significant amount of people, a little under 9 million, on pandemic unemployment assistance, PUA. Those two programs, PUA and PEUC, are set to expire on December 31st. So right now, there are about a little bit around 13 million people on PUA and PEUC. You would expect that to drop to somewhere between 10 to 12 million by the end of the year. But for those 10 to 12 million people, their income will go to zero if Congress does not reapprove these programs. That could cost you around $150 billion in the first quarter. It's not going to be offset by job creation and labor income. That's where you can get some weakness in the first quarter.
And Brett, I mean, when we talk about that, obviously we've been seeing those numbers grow. When we talk about people who have exhausted their unemployment benefits and PEUC, we've seen that grow in the last 4 weeks by about 1 million claims. So, I mean, there's more people shifting in that direction. We've seen that. But when it comes to the overall number here, I guess when you look at the broader implications, a lot of people are debating right now if this was just kind of a fluke number in terms of the overall initial claims, or if this is the beginning of a trend to show weakness is here and here to stay.
Yeah, I think that you are going to see a little bit of a pause in the near term, especially with the rising case growth that you're seeing. That's 95% of GDP is in counties with rising case growth. You're seeing renewed restrictions across the board, especially with the closing of indoor dining. So to give you an idea, food services and accommodations have accounted for about 35% of the employment gain, 4 million jobs, over 4 million jobs over the past, since April. With indoor dining being shut down again in many cities, soon to be in New York City, it's already been in other states, you're going to see definitely another wave of layoffs in that space. So it's unfortunate, but we're going to be dealing with these near-term disruptions to high contact service industries, especially like those that employ a large number of people, like restaurants and bars, until we have a vaccine, a widely available vaccine. That's what we're going to be living with.
How much worse are things going to get then? I mean, you've already pointed to that $150 billion shortfall in terms of income for workers. You said, look, this is about a 1% off of growth. So this comes at a time when we still don't have any kind of fiscal relief. How much worse do you think things could get?
Yeah, so I mean, the loss of income for those people, I mean, number one, from a humanitarian perspective, 10 to 12 million people that are stuck out of work in this environment. To cut them off like that would be wrong. The second thing, though, is you don't know what's going to happen. The knock-on effects are going to be via missed rent payments, missed credit card payments, missed student loan payments, and you have rent moratoriums that are expiring at year end, as well as student loan forgiveness that's expiring at year end. These are all things that Congress needs to get done now, sooner rather than later, and you can't leave it until the next president comes in, because then you're going to have a gap over a month. Those knock-on effects, auto loan defaults, credit card defaults, that could send, have a bit more of a risk-off tone that feeds into negative sentiment, and that's I think the broader concern.
Yeah, when you talk about negative sentiment, I mean, is the broader concern there that it would finally start to trickle into, consumer spending? I mean, we got the retail sales number that was weaker than expected heading into holiday shopping season. That's going to send some tremors there and fears that might continue. I mean, when you look at the largest chunk of the economy here and the state of the consumer here, how is that held up, and where do you put it here as we prepare to kind of get ready for 2021 when there's hopes that vaccine is going to be coming through to help those industries you're talking about that are hardest hit?
Without question, the consumer has been much stronger than most have anticipated. The savings rate, nonetheless, still remains high, but the savings is concentrated amongst those that have the lowest marginal propensity to consume. Those that still have jobs and they aren't able to, they're consuming just fine. But what we're seeing now is that the pent-up demand for goods is going to start to slow. Vehicle sales have spiked higher. I think they're going to see them slow going forward. And as that, what you need to see happen in terms of consumer spending is services come back. That has really been the biggest hit to overall consumption, has been services, particularly healthcare services, surprisingly. And so what we need is, it's going to take more time. Again, it's vaccine that's going to be able to allow a full normalization of services, especially healthcare services, going to the doctor's office, dentist's office, allowing them to return to full capacity, as well as hotels, accommodations, restaurants, and travel, like we talked about previously. And that's still going to be some time away. So in the near term, you're going to see goods spending start to revert back to its pre-virus trend, because you've had the overshoot from pent-up demand from the lockdowns. So that begins to slow a bit. And I think it's really important because we're expecting weakness in the next 2 quarters for consumer spending. I think, significantly below consensus. We see real PCE growing about 2% versus consensus of closer to 4%. And just for these reasons, good spending is set to slow. We have income set to a potential hit to income if Congress doesn't do anything. At the same time, we have rising restrictions on services. So, we're kind of left with a weaker forecast near term.
Yeah, an indication of more pain to come, as you point out, until the vaccine does come to market. Brett Ryan, senior U.S. economist at Deutsche Bank. It's good to talk to you today.
Great. Thank you for having me.
Well, sticking with the issue of unemployment, Senator Ron Wyden of Oregon, one of those senators who demanded reform to the unemployment system for a while now, certainly those calls for change elevated by what's playing out right now. Let's bring in Jessica Smith, who spoke with the senator. Jess, what did he have to say in light of what we're seeing right now, and especially the delay in the fiscal help?
Right. Well, Senator Wyden says that the pandemic really highlighted problems with the way the U.S. handles unemployment benefits. And he's not alone. I talked to several experts who said the same thing. They say now is the time for long-term reform. Wyden, who is the top Democrat on the Senate Finance Committee, said if Democrats manage to control the Senate, win both of those races in Georgia, and he becomes the chairman, this is going to be one of his top priorities. First, he says you have to update the technology. You'll remember back in the spring when we saw those record waves of jobless claims, the systems were overwhelmed. They crashed. People had to wait for weeks, even months to get their benefits. So that's something they want to tackle first. And there is bipartisan support for that idea. Next, there are some people who say that all of the chaos throughout the pandemic shows that the federal government should just take it over. There should be one federalized system instead of this patchwork of programs from state to state. That idea is going to face some tough opposition in Congress. And Wyden says it's time to consider it, but he's not supporting that idea at this point. He also does want to make gig workers eligible for unemployment insurance. The CARES Act did have a program that allowed gig workers and other independent contractors to get unemployment benefits. And now there are some people who say that change or something similar needs to be made permanent. Finally, there is a push to expand benefits to create a floor that makes benefits from state to state more generous and last longer. Wyden told me he knows that all of this is going to be difficult because you just have to look at the fight over that $600 boost in the CARES Act for unemployment insurance. Let's watch.
I have no illusions about the challenge of trying to get support across the aisle. I always try to work in a bipartisan way, but I want it clear that the history here is that we had to battle senior veteran Republicans every step of the way from the White House on.
I did try to get a comment or an interview from Senator Chuck Grassley. He is the top Republican, the chairman of the Senate Finance Committee, but his office did not make him available. Akiko.
Okay, thanks so much for that, Jess.
I want to spotlight some stocks on the move right now as earnings season rolls on. Of course, we've been watching a lot of those retail names this week. Macy's out with their latest quarter revenue beating estimates. The retailer posted that. They only lost 19 cents per share in the quarter. That was better than what Wall Street was expecting. Same-store sales dropped by more than 20% there too, better than expected. But investors a little hung up on the slowing e-commerce growth as coronavirus cases could keep shoppers from malls this holiday season. The retailer's e-commerce growth rate was just about half what it logged in Q2. On the flip side, though, we are seeing L brand shares pop today, up more than 15% after reporting its own blowout quarter. The parent company of Victoria's Secret and Bed Bath & Beyond, Bath & Body Works, there posted revenue of $3.06 billion. That was up from $2.7 billion a year ago. Same-store sales also rose 28% in the quarter. And on the flip side, to Macy's, Victoria's Secret actually showed continued strength in its digital sales. E-com now makes up 42% of the brand's total haul, at least when it comes to Q3 sales numbers there. We're going to take a quick break here on Yahoo Finance Live. We'll be right back after this. Welcome back to Yahoo Finance Live. Right now, we are seeing stocks mixed today with the NASDAQ, the lone index in the green, up by about 0.4%. The Dow still off by about 0.5%. But the theme continues to be much of what we've been talking about the past couple days here. The question of this continued rotation away from growth stocks into some cyclical names. Let's break that down a little bit more here with our next guest. Brian Krauez is Sharp Investment President, and he joins us right now. Brian, thanks for taking the time to chat here. I mean, we've been talking with all of our guests, repeatable question here on the show about their thesis around this rotation, because of course there have been a few names that have been hard hit in 2020. You think about cruise lines, airlines, retail we've been talking a lot about. What's your thesis here in where we go over the next couple months and what this recovery looks like when you break that down in growth versus value?
Yeah, I mean, you know, the market's really reminiscent to us a little bit of the late 1990s tech bubble. It's really been driven by just a few top tech names, as I know everyone's been talking about. You know, the top 5 names are up 45% this year, where the median stock is barely up. So we really see on the horizon a rotation similar to what you saw in the early 2000s. And we're continuing to find compelling opportunities outside the scorching hot tech names, you know, especially when you compare the fact that we've got near zero interest rates right now.
I mean, Brian, when you talk about the late 90s, early 2000s, a lot of people are going to say, we all know how that ended. Is there a reckoning waiting on the other end, just given how frothy some of these big tech names have become?
Well, you know, possibly there is, yeah. I mean, if you look at the extended run of some of the big tech names, it's starting to look, you know, it's not the same, but it rhymes with the 2000s. And in fact, when you think about a company like Berkshire Hathaway, we've started to see plenty of articles within the last few months talking about how the Oracle of Omaha is dead, and he's getting no credit for his Apple ownership. You know, year to date, Berkshire's bought back $18.5 billion of stock, so he's bullish on the stock. The last time I remember distinctly in 1999, there was a Barron's article, "What's Wrong with Warren?" A big cover story at the end of '99, and they basically top ticked it. The Nasdaq 100 collapsed 80% from there, while Berkshire went up 30%. So, you know, we really like a stock like Berkshire that's trading one of the most attractive valuations in nearly a decade. And if he's bullish on his stock, then we are too.
Yeah, let's talk about another one of those opportunities out there, because CVS Health is one that you're watching here. And that's interesting considering the fact that we saw that stock under pressure when Amazon announced its pharmacy push with the unveiling of Amazon Pharmacy, going to let people buy medications on there with or without insurance. What kind of pressure does that put on a CVS, and why would you be enthusiastic about that name as they face Amazon?
Yeah, well, a lot of people say the same thing. How can you be, you know, enthusiastic when Amazon's coming right at you? Well, you know, first of all, this is not new. In 2018, they bought Whole Foods, they bought PillPack, and there was a lot of talk about them getting into the pharmacy area that is Amazon. So CVS has been preparing for this for a while. They just announced Karen Lynch is going to become the new CEO in February. We think her background at Aetna will help the company with its strategy to become the front door of healthcare. And remember, they didn't own Aetna before. CVS is not just retail, it's insurance, it's PBM. They have 450 health hub locations already across 30 states. They're planning to open another 1,300 by the end of 2021. They've been selected by the CDC as a primary outlet that's going to do flu vaccinations. And we think the COVID-19 vaccinations alone could add an additional $1 billion in revenue to CVS. So we actually think this is a tremendous opportunity. The selling pressure we saw the last few days puts them now at under 9 times earnings with 60% upside to their median high and below their median lows.
Yeah, you think about the push here to get a vaccine out when it comes available to hundreds of millions of people here in the U.S. It's a lot of stops to make here. If it's going to be at a CVS, you can think about the revenue that can come from there. Obviously, as you put that target on it. Brian Krauez, Sharp Investments President, appreciate you taking the time to chat today.
Yeah, thank you very much.
Coming up, growth in its gaming and data center business, propelling NVIDIA to another strong quarter, but the company warns a slowdown is coming. We're going to break down that quarterly results coming out from the big chip maker after the break. Welcome back to Yahoo Finance Live. Just a week away from Thanksgiving, but a lot of people looking to the next day on Black Friday, especially given the deals that could emerge. Not too early to begin your shopping trip. And who better to turn to than Dan Howley, who is going to give us all the deals we should be looking for. Dan, of course, you're very focused on the tech side of things, but it's going to be interesting to see how things pan out this year, because you've got Black Friday and then Cyber Monday, and yet everything we've heard from retailers this week is that it's all about the online experience right now.
Yeah, that's right, Kiko. It really is going to be kind of an online experience. I don't personally think I'm going to be going to any real retail stores, but I will be smashing the add to cart button several times for Amazon, Walmart, Target, the whole, like Best Buy, probably a whole bunch. But if you are like that and you are going to be shopping this Black Friday or Cyber Monday or anytime during the holiday season, there are some tips that you should follow if you're going to be buying tech gifts specifically. And the number one thing is probably to start off with TVs, because Black Friday, Cyber Monday has become kind of an unofficial TV buying holiday. Everybody likes to go out and get the TVs that they want. But before you do that, there's some tips that you need. So the first is to recognize that some of the TVs that you're going to look at are specifically built for Black Friday. So they might not have all the features of the big TVs that you see in stores. So think maybe missing some HDMI ports. It might not have 4, it might have 2. If you're the type of person that plugs a lot of things into your TV, that can be a big issue. The other thing to look at is you're going to see a lot of TVs advertised as having 4K, but if it's below 55 inches, that's basically just dressing on the box. It doesn't mean anything. A 1080p TV versus a 4K TV, they're virtually the same as far as resolution goes and quality when you're below 55 inches. Above 55, go nuts with 4K. Don't go to 8K. That is just throwing your money in the garbage. Outside of that, HDR, that's a big game changer. You're going to want to look for with TVs, but you're going to have to look at the type of backlighting that they have. So make sure that you get full array backlighting. Edge backlighting is fine, but it's not going to be as great as full array. And make sure you know what you want to buy before you go in. Look at the specifications that you're interested in. Just don't see a deal and then grab the TV, because you might regret it later. After that, there's laptops and Chromebooks. You're going to see a lot of laptops and Chromebooks on sale during Black Friday. Laptops, some of them will be like $300. I used to work at Best Buy. Every Sunday, the ad would come out. People would line up out front, get a $300 computer, and I tried talking them out of it. Not because I worked on commission, I didn't, but because the $300 computer is basically trash. I'm sorry to say, you're going to have to upgrade it in about 2 years. That's $300 that you just wasted. They're not going to have the best processors. They're not going to be the best build quality. Your better bet is to go with something a little more expensive that you know is going to offer better quality. So look for a newer generation Intel or AMD processor and at least 8 gigabytes of RAM. Anything below that, it's going to be slow even running your web browser. So avoid those. As for Chromebooks, they're basically great no matter what. Just again, make sure you have a newer generation Intel or AMD processor and look at the reviews for the products that you are interested in buying. Don't just go in there and say, oh, this looks pretty cool, I'm going to buy this. You're going to regret it right away. After that, smartphones are obviously a big deal. There's tons of Black Friday sales, tons of Cyber Monday sales. A couple of things to keep in mind. If you're buying someone a smartphone, make sure you get it for the right carrier for them. If you get someone who's on AT&T, a T-Mobile phone, it's going to be a headache for them to switch everything over the right way. The other thing is to make sure that they can port over their own phone number. So you might want to tell them that you're buying them a smartphone so they can keep that old phone number and they don't have to deal with transitioning and getting all those texts, you know, new phone, who's this, things like that. And if you're buying a phone for someone you're dating, sounds out there, but some people do it, don't. Because if you break up with that person, you're still on the hook for that bill. The bill might last longer than your relationship. That's a bad idea. Up next, there's video game consoles. This is my last tip. Very special, close, near and dear to my heart because I love video games. There are 2 new consoles out this year, the Xbox Series X and the PlayStation 5. There are 2 versions of those consoles. There's the Xbox Series X and Xbox Series S, PlayStation 5, and PlayStation 5 Digital Edition. The Series X is more powerful than the Series S. It's also more expensive. Both versions are great of both consoles. But if you're going to the store, make sure you're getting the right console, because Microsoft, for whatever reason, decided to release the Series X after releasing the One X. So don't be that parent or that significant other that buys someone an Xbox One X when they specifically wanted a Series X, and don't buy someone a PlayStation 4 when they want a PlayStation 5. The rule of thumb here, just make sure you get the right console, for God's sakes. And those are my excellent shopping tips for Black Friday and Cyber Monday.
And we appreciate the research, Dan. There's a lot of tips to digest right now. So you can all go to our website, yahoofinance.com, and look through Dan's shopping tips as we count down to Black Friday. Coming up, we're going to be refocusing our attention on the market, specifically looking at NVIDIA. That stock under pressure today, despite the company posting strong results in the third quarter. We'll break down the numbers for you after the break. Concerns about declining sales in its data center business weighing on shares of NVIDIA in this session. We're seeing that stock down about 1.3% right now. The company did post strong results in the third quarter, record revenue for its gaming and data center business, driving overall revenue growth of 57%. But CFO Colette Kress warning those numbers for its data center business are expected to fall this quarter. Let's bring in Vijay Rakesh. He is an analyst at Mizuho. And Vijay, I'm looking at your notes here. You've got a price target of $605 on the share. It's trading at $529. How much of these moves that we saw initially in the after hours, that stock was down as much as 3%. How much of this you think is justified given the strong quarter that the company still posted?
Yeah, I think thanks for having me on. So especially in NVIDIA, I think the reaction is kind of expected. The stock's up 100% year to date. It's had a pretty strong run here. But if you look at the core business for NVIDIA, as you mentioned, gaming up strongly, data center. The guide on the data center was modestly down, but that's primarily because a segment within data center called Mellanox was supplying to Huawei, and Huawei had pretty much stopped ordering since September 15th, the U.S. restrictions. But outside of that, the hyperscale data center side continues to grow into the December quarter. So we see NVIDIA having a pretty strong long-term roadmap here. You know, they dominate AI and training in there. They probably have 95% share of that market. And they've talked about 100 billion TAM in AI for the data center, just into hyperscale, enterprise, all those markets. And if you look at where NVIDIA's revenues are today in that market, it's about 6 to 7 billion. So they're just scratching the surface, and you still have a long way to go there. So some of it is probably a mixture of high expectations, but shouldn't be unexpected given how the stock has run this year.
And Vijay, I mean, as Akiko's highlighting, record revenue, obviously, clearly, there's a lot to focus on the positive side here for NVIDIA. But when you look at the flip side, and you mentioned the issues there with Huawei and the data centers in the current quarter and how it might be softer than they expected. I mean, that's something we saw out of Intel as well. That stock got shellacked after their data center group, which, you know, the revenue comes from enterprises, government customers. That was a 7% drop that they reported for the quarter. So how much of this is really industry specific and kind of, you know, struggles across the board when we think about data center revenue versus NVIDIA specific and what they may need to be improving upon?
Yeah, sure. I think specific to NVIDIA, this was primarily a Huawei issue. Huawei had the US restrictions that went into effect September 15th, and so they probably ordered well ahead of that. And so post September 15th, you just had an air pocket. So that's basically what's affecting their outlook. And as long as those US restrictions remain on Huawei, you know, you probably won't see them coming back. But that said, the core data center business, like I said, continues to grow into the December quarter. Where they had the exposure to Huawei was the interconnect side of the business with Mellanox. Intel is a slightly different horse. I think what's happening there is obviously they have the exposure to enterprise and government, which saw some declines, but they're also behind on the technology roadmap, especially with 10 nanometer and 7 nanometer. And they've been trying to play catch up to AMD. And so they've been losing some share there as well. So they really got hit, not just the data center guide, but, you know, with lack of clarity around their manufacturing roadmap, with lack of, 10 nanometer product coming out to market on time. So there are some multiple things that they took hits on. NVIDIA seems to be by far a much cleaner story, much stronger roadmap, much stronger market share. Really not a lot of competition there. So.
Vijay, you've got a buy rating on the stock, so clearly you believe there's more upside. How much of that, though, factors in this $40 billion acquisition of ARM and the potential risk around regulatory approval? If you look at Chinese regulators, they seem to have already indicated they may not be comfortable approving the deal, largely because they're worried that if, in fact, NVIDIA acquires ARM and that goes through, that could fall under U.S. export controls.
Yeah, you're right. I think when we look at the price target and where what NVIDIA is doing today, it really doesn't incorporate a lot of, or any of ARM, I should say. ARM definitely opens up a whole market for them. Obviously, there'll be challenges in integrating the two roadmaps between GPU at a very high processor and performance and energy versus where ARM is with considering more of a low power TAM there. But I think your points are well taken. I think there are some very strong, big regulatory challenges there. There are a lot of industry participants who don't like the acquisition, who have to share their roadmaps. And so we do think it's going to be a challenge to get that to the finish line. They obviously have to go through a lot of regulatory hoops as well. So.
What kind of timeline are we talking about then? When you look at something like a Qualcomm NXP, that took about 18 months. Is that the kind of drawn out process you're factoring in?
I think they have laid out more of an 18-month process. Obviously, there were a lot more unknowns going into this in terms of the U.S. elections, the change in administration, how hawkish is the new admin versus the prior one. We'll see how those play out. But, I think we have seen kind of more of a bipartisan stance in terms of dealing with some of the IP theft or technology partnering, etc. So we'll see how this plays out. But they have to fight on multiple fronts, not just regulatory approvals from China, but there's probably some entrenched other OEMs who probably are not willing to share their roadmaps with the competitor as well. So.
Yeah, we'll see what happens on the U.S. side. As Akiko mentioned, there's still going to be the same questions on the Chinese side here when we think about that deal. But shifting over to the gaming side of the business, we've been talking a lot this year about pull forward and demand, as we saw more purchases tied to the chip space here earlier in the year. What's your take on that, and what kind of demand going forward looks like into, I guess, the December quarter and well into next year?
Yeah, for sure. We definitely saw a pull in across the work from home names on the data center side, as you saw both, at least in the first half of the year, you saw both the cloud and the enterprise sites start to spend to develop their online channels, shop from home, study from home, work from home, etc. So, and you're seeing a pull in into 2020 for sure. I think going into 21, there's probably, there might be a little bit softer in terms of that demand. But I think on the flip side, you probably start to see a lot of broadcast sports come back on. You start to see the Summer Olympics come back on. I think as you see ad spending come back, that'll drive much bigger cloud capex. So we actually see cloud capex just top down continue to increase into next year as just globally you see a recovery across multiple industries. And not just that, I think today the demand seems to be in the cloud, with the enterprise side, which is primarily, let's say, airline, retail, travel, restaurants are all weak. If we get through this, this COVID with some sort of vaccine, you probably see next year a recovery across that enterprise market from retail, airlines, all those leisure markets that got hit. That will drive, again, data center demand and associated, demand for all the infrastructure that goes with it. So.
All right, Vijay Rakesh joining us from Mizuho Securities. Good to talk to you. Thanks so much for your time.
Thanks a lot. Thank you.
Taking a look at where the markets are right now, the Dow now trading 160 points lower. The Nasdaq still in positive territory, up 54. Let's head out to Jared Blickery, who's tracking the very latest for us. Jared, what are you watching?
Well, we have a mixed market here in the U.S., but over in Europe, which just closed a few minutes ago, let me go over those numbers. Well, in London, the FTSE is down 0.7%. So is the DAX in Frankfurt, and the CAC 40 in Paris is down just over 0.5%. You can see in the U.S., I'm going to pull up a chart of the S&P 500. Very choppy, low-range day here. Very similar situation for the Dow, which didn't even manage to get it into positive territory, except for a brief second there after the open. And then the NASDAQ is really the story of the day. We do have some growth there. So let's take a look at the NASDAQ 100 heat map. And we can see the big guys largely in the green, but not by a whole lot. Microsoft is flat. Alphabet up just under 0.5%. One of the bigger, stronger names is Tesla. That's up 3.85%. And just looking over the last 6 months, we can see now it is impinging on its record high that it had in August. And nice breakout there after reporting earnings. And let's take a look at the winners and losers in the NASDAQ. To the downside, Baidu is down about 3.5%, followed by Walgreens after getting smashed yesterday, absolutely smashed because of that Amazon news entering the prescription drug business. You can also see Starbucks down about 0.5%. And then let's just get to the sector leaders, and we can see communication services, tech, and discretionary are the only ones in the greens. Those house the FANG sectors. To the downside, we got utilities off about 1.4%, followed by real estate and industrials. Guys?
Yeah, tech still leading the way, at least in this session, even after all that talk about rotation out of the sector. Thanks so much for that, Jared.
All right, we're going to take another break here on Yahoo Finance Live, but coming up, we're going to be focusing in on small business and how one app has been helping local pizza shops focus in on fueling their deliveries here in 2020 as more restaurants shift their focus over there. We'll have that coming up right after this. Welcome back to Yahoo Finance Live. This year we've been focusing a lot on the pain being felt by local businesses as lockdown measures took effect earlier this year, and now a lot of fears around some of those coming back here as we approach the winter months. There is one app out there helping some of those restaurants, specifically pizza shops, weather that storm with a focus on helping them roll out their goods in delivery. That would be Slice. The tech platform has now signed up more than 14,000 independent pizzerias on their app and their network. It's set to surpass a total of $2 billion in sales by the end of the year when you rack all those local shops up. And joining us now to focus in a little bit more on that is the CEO of Slice, Alir Salah, joins us now. Alir, thanks for taking the time to chat here, man. I know you've been focused in the pizza space for a while. This is a family thing for you. Your grandpa had a pizza shop. It's been going on for a long time. So talk to me about what you're hearing when you chat with these restaurant owners, family businesses that are weathering the storm, and how you're helping.
Thank you so much for having me. I come from 3 generations of small business pizzeria owners. I see firsthand the impact that COVID is having on these businesses. I see firsthand the challenges that they face when they lack the technology, the marketing, and the data resources in order to make the best decisions for their business. And so we've come forward with an all-in-one solution that leads the digital transformation for these businesses. And what we're seeing is a lot of grit from this industry. Across every town in the country, there's a small business pizza shop serving its community. But we're also seeing consumers really want to have a more convenient experience. They want to leverage technology in order to place those orders. And what we're seeing is the locations that adopt our solutions have a really successful time in making sure that they meet those consumer needs.
Let's talk about those solutions then, because what we've seen throughout the pandemic are these small businesses that are being squeezed on both ends. On the one hand, they're signing up with these bigger platforms like a DoorDash or an Uber Eats because they want to go to where the customer is, but they're also getting that 30% commission tacked on, or in some cases, a little more, a little less. What's the proposition you have for these smaller businesses on why they should be going with your platform?
Absolutely. We are a first-party partner, and we're in essence converting this really fragmented independent pizzeria industry into a community. And we're realizing economies of scale that way. And so we operate under a premise that independents should operate for themselves, not by themselves. And when we bring that community layer forward, it really helps them succeed and not necessarily hit their bottom line. So we come forward with a very low fair price that is merchant-centric, that is small business friendly. And our entire solution is that covered under that very simple fee, which is $2.25 per order. In essence, it amounts to about 7% take rate on a per order basis.
Yeah, that'd be much lower than what we've seen in some other businesses. But when we talk about pizza specifically, that's been one of those cuisines that's just levered, quite frankly, to delivery. I mean, it holds up in a box. People are familiar with it. I was a pizza delivery boy myself back in high school, actually, so I know that well. But when we talk about, I guess, that opportunity, to Akiko's point, lasting longer than just the pandemic, how do you sustain that growth? And maybe once eventually that resumption of indoor dining comes back, how do you keep those customers, those businesses on your platform?
Absolutely. Look, we're seeing a real shift to digital, and that's not temporary. That's actually going to sustain beyond COVID because it's a much better experience, not only for the consumer, but also for the small business owner. Remember, the alternate is that they're having to answer 3 or 4 phone lines in order to take your order. The consumer doesn't want to wait on hold. And we can leverage this technology in order to drive more efficiencies, not only for the business, but also for the consumer, better value, a more rewarding experience. So the result of that, we see a sustained and continued growth across the digital channels that we power. And we're excited for that, for the businesses that are part of our network, and we'll continue to invest there.
So even with those solutions in place, we've seen a number of independently owned restaurants close because of the restrictions that have been placed on their business during this pandemic. When you talk specifically pizzerias, what have you seen over the last 6 months or so in terms of the amount of restaurants that used to post on your platform who are no longer operating?
Yeah, look, we're seeing two categories of restaurants. One category that is struggling and another category that is thriving. The struggling segment is a traditional sit-down restaurant for whom pickup and delivery was a nice to have. And making that transition to, pickup and delivery as a primary aspect of their business is still a challenge. And the main reason behind that is because they are partnering with the DoorDash, Uber Eats of the world, and the economics just are really challenging. For the locations where pickup and delivery has been part of their, operating rhythm for decades in some cases, we're seeing them really step up. We're seeing consumers really adopt the digital channels, and they are absolutely thriving. And that is reflected in our growth.
Yeah, Alir, when we talk about your growth, that does raise the question. We talk a lot about companies who are, chasing these opportunities, looking to focus on just going after it at all costs, maybe putting profitability, farther out when you think about the opportunity at hand. So talk to me about that, because I know you raised money from KKR. Where are you looking to go here, and what does profitability look like to you guys?
Yeah, for us, it's all about continued investment in growth. Again, we work with 14,000 locations nationwide today. We're now introducing a program we call Accelerate. And what Accelerate does is it's our ability to come in and invest up to $15,000 in an all-in solution, including a point of sale system, including brand marketing, all with the purpose of digitally transforming these small businesses. We have introduced 10 locations to this cohort in a very short window of time. It is our goal for 2021 to accelerate this to 1,000 locations. And so in essence, while we continue to grow the number of locations on our network, we will evolve 1,000 locations from a more traditional offline model to a world-class digital-first model that will be comparable to a Domino's location today.
Interesting stuff. And out of the box, perhaps an out of the pizza box solution here on the table here as well. Alir Salah, Slice CEO, appreciate you taking the time to join us. Congrats on the progress you've made there and helping out those pizza shops.
Thank you so much.
Coming up, we've got a lot more coverage ahead on the markets as we see the Dow slide about 135 points. We've got much more coming up ahead. We'll be right back. Welcome back to Yahoo Finance Live. A bit of a split picture emerging here in the markets today. We are seeing the Dow down more than 100 points here. Looking at the top movers right now, Salesforce and Walmart seeing the biggest gains on the Dow, followed by Intel and Walgreens and United Health continuing to be under pressure, down about 2.5% or so. Let's bring in Inez Ferre, who's been tracking all of the big movers today. Inez.
And Akiko, let's start out with the NASDAQ because that's where we are seeing some action. We're looking at the big cap tech names. Those are relatively flat right now, but we are seeing some of the leaders being Pinduoduo, NetEase up more than 4% after its better than expected third quarter earnings. Those were a beat. And then just taking a look at Moderna, that's up more than 4%. Baidu is down more than 3%. And Walgreens for a second day in a row, down more than 2% today. Over the last 2 days, down almost 7%. If we just take a look at some of the trending tickers, we're looking at Sonos up more than 25% after a better than expected quarter, beating on the top and the bottom line with its forecast also coming in better than expected. Year to date, the stock is up 37%. You're looking at NVIDIA, which I know you guys have spoken about today after its latest quarter. And we are also seeing AstraZeneca after the news of some positive responses for its COVID-19 vaccine in older adults. A late-stage trial is ongoing right now to try and confirm those results. And I just want to show you also what's happening with oil. WTI down about 0.8%, but still being able to maintain above that $41 a barrel level that it's been maintaining over the last 5 or 6 sessions. Akiko?
Yeah, Ines, I'll pick it up there because you mentioned oil, and it's one of those things that is increasingly playing a smaller and smaller part as we see the excitement around electric vehicle companies continue to grow. I know you've been watching NIO's shares as well following their earnings. Tesla gets all the hype, but NIO's up almost 1,200% this year. So what do you see out of their earnings report?
Yeah, really strong earnings, beating on the top and the bottom line. The day that it came out with its earnings, the stock was down a little bit. But look, overall, as you mentioned, a lot to say about this stock. It's more than 1,000% over the last year to date. It's planning to expand into Europe. There's a lot of bullishness on the street about NIO. And speaking of the EV space, today we're seeing that that's in the green. Tesla, as you mentioned, it gets so much of the hype. Tesla today up more than 2%. Yesterday, it was up 10% after Adam Jonas upgraded the stock. And the day before, it was up another 10% over that news that it will be included in the S&P 500 index. So if we just take a look, at the last 5 days, up 20%. But of course, Tesla year to date, 494%. But also looking at XPeng, this is another company that went public over the summer. If you take a look at the 1 month chart, I just want to show you over the last month, we've just seen so much movement with these stocks. XPeng up 130% over the last month. And Nikola, let's not forget this one because over the last couple of days, we've seen quite a bit of movement with Nikola. Up 4% today. It was up yesterday about 14% on speculation, anticipation that GM deal may go through. 2-day chart right here, up 20%. Akiko?
Yeah, and it's interesting to see just how all of those names have gained. It's not sort of that one or the other trade that we've seen in many ways in the EV space, but this certainly speaks to the growing market. And Tesla, you're right. It feels like we kind of have that on repeat every day with the gains for the stock. Thanks so much for that.
Yeah.
All right, we're going to take another break here on Yahoo Finance Live, but coming up, digging deeper into that latest unemployment report as it shows an unexpected jump higher in weekly claims. We'll dig into that. Stay with us. Welcome back to Yahoo Finance Live. We have reached 12 p.m. noon here in New York City. I'm Zach Guzman alongside Akiko Fujita. And right now, stocks maintaining their mixed picture. The NASDAQ still up by about 0.5%. The Dow off by about the same margin as the S&P. Trades lower by about 0.1% right now. Of course, we've been watching the moves play out as we get new updates on the vaccine front. AstraZeneca and Oxford coming out with a peer-reviewed vaccine data showing that it's slightly around the same effectiveness as Moderna's vaccine at 95% efficacy there for AstraZeneca. That, I guess, is not doing the same to boost the markets like we saw out of Moderna's update and Pfizer's. We'll continue to track that in just a little bit. Also want to highlight the fact that we got initial jobless claims as well, unexpectedly rising to 742,000. That was the first increase we saw in that data since early October, perhaps stoking fears that a slowdown is coming as this economic recovery looks shakier and shakier heading into the winter months as coronavirus cases surge across the country. But to kick off the back half of our hours here, I want to focus in on that report here with Yahoo Finance's Emily McCormick. And Emily, that is the big question, is how this recovery might be losing some steam here when we got this unemployment update.
That's right, Zach. And just taking a look at this latest Labor Department jobless claims report, that did show signs, or at least early signs, of backsliding here in the labor market's recovery. As you mentioned earlier, jobless claims unexpectedly rising for the first time in 5 weeks last week. Those coming in at 742,000 versus the 700,000 that had been expected, and the upwardly revised 711,000 during the prior week. Now, on a state-by-state basis, some notable standouts here, both in terms of increases and decreases last week. We saw Louisiana adding by far the greatest number of new claims, those rising by nearly 33,000 on an unadjusted basis. We also saw Massachusetts, Texas, and Virginia each also posting notable rises. Now then, on the flip side, do you want to note that Illinois saw the largest drop in new claims last week, with those falling by more than 20,000 on an unadjusted basis. So interesting to see one of the states that has been grappling with a rise in COVID cases, at least for now, posting decreases on those new claims. We also saw Florida, New Jersey, and Washington State posting large drops and improvements in new claims. So geographically, still a patchwork of improvements across the country. Now, turning to those continuing jobless claims, those did improve to the lowest level since mid-March, but they are still more than 4 times above the weekly average that we saw throughout 2019. Now, for last week, over the data from last week, we saw those coming in at 6.372 million, slightly below the 6.4 million expected. But as we've noted over the past couple of weeks, this drop in continuing claims has also come because more Americans are actually joining longer-term unemployment programs. Today's data showed that more than 233,000 Americans were added to the Pandemic Emergency Unemployment Compensation Program for an acceleration over the number that we saw in last week's data. So again, Zach, it is going to be interesting to see where things shape up as we head into the winter months. We are still seeing these COVID-19 cases rising across the country. That's something that could put downward pressure here on the labor market going forward.
Yeah, and then the other thing that we like to highlight here too is just kind of looking at the states and how these unemployment claims, when you stack them up, what their economies look like. We've been highlighting the fact that Hawaii has been leading the nation in terms of the insured unemployment rate. That would be the ratio of people on jobless benefits here versus the labor force. And that continues to be the highest, but it's tied now with California, both states at about an 8.3% insured unemployment rate, followed by New Mexico, Nevada, and Georgia, which again is very interesting because Georgia is one of those states that we saw not necessarily improving relative to the nation heading into the election. And we know that that state's now heading for runoff races. So very interesting updates in terms of a state-by-state recovery there. But Emily McCormick, appreciate you bringing us the latest on that front. Let's break down the trends, though, in terms of where we are seeing recoveries perhaps hitting Americans a little bit harder than others with our next guest here. Jed Kolko is indeed chief economist, and he joins us now. And Jed, I highlight Georgia because it was interesting to see how that state went. Of course, it's one of those that we saw flipped here. But you have been looking into kind of this red and blue breakdown in terms of where this recovery is at as well. Talk to me about what you've been seeing.
So what we see when we look at which places have been doing better this year and which places are struggling is that this recession has been worse in blue places. And that's mostly because of the types of industries that exist in Democratic and Republican-leaning places. Democratic-leaning places tend to have more jobs in the kinds of service sectors that have struggled most in this recession: arts and entertainment, hospitality and tourism, but also in places where more people can work from home. So tech hubs, finance centers, those are the sorts of places where local businesses like restaurants and services are really struggling because people are staying home rather than going to their place of work and going out for lunch, picking up things, and so on. So it's really the blue places that have struggled more in this recession, even though bluer places are better set up for the future, given a mix of jobs that's more likely to grow, higher education levels, and fewer jobs at risk from automation.
Jed, what about some of the agricultural hubs? You know, we've been talking a lot about how this most recent uptick, while we are seeing a surge across all the states, the Midwest has been particularly hit hard. And that's not an area that, as you point out, is sort of very service heavy as much as it is just more rural areas. What do you see as the economic impact there as we continue to see restrictions placed on some of those states?
Well, the reasons why some places are struggling economically are different than the reason why some places are struggling in terms of cases and deaths. The most important factors for the economic pain is the local job mix. But right now, the strongest factor that helps explain why some places are having a bigger case surge than others is actually temperature. The places where temperatures tend to be more extreme, places that were hotter in the summer, places that are colder in the winter and fall months, that's where we've seen bigger increase in cases. And that's consistent with it being harder to do things outside and greater risk of people gathering inside. So we've seen throughout this pandemic a pretty consistent pattern of where the economic pain has been greatest, even though we've seen a wildly swinging pattern of where the virus has been most severe. First, New York and the region around it, then the Sun Belt, and now the upper Midwest.
And Jed, also, I mean, when we think about this, the latest report that Emily was just breaking down, I know you at Indeed, you guys have been tracking job postings for quite some time, looking into that data. And the big question now, I suppose, is this recovery and whether or not this was a fluke kind of one-off unexpected increase in jobless claims, or if this is the beginning of what we're going to see as a second peak here in unemployment claims. Talk to me about what your expectations are, putting in all of what you're just talking about in terms of the weather becoming a huge factor here to consider.
I expect that we will see continued but slow recovery in the labor market. What we see on Indeed is that job postings continue to recover. Job postings pick up. They continue to inch closer to levels that we saw a year ago, but at a much slower rate than during the summer, where there was a much faster rebound off that low point. I expect as some people who were temporarily laid off get recalled back to their jobs, but other people find that their temporary layoff becomes permanent, the remaining unemployment will be more stubborn. Those will be the sectors, the places where recovery comes less quickly, where it's not just about reopening and a rebound, but starting to do some of that more chronic pain that the acute crisis caused.
And Jed, how much of those losses do you think are going to continue to be in the services and hospitality sector? We've sort of seen it expanded into government jobs as well because of state budgets really getting increasingly tight. Are those the sectors you're going to be looking to, or do you think this next wave, as Zach described it, is likely to expand beyond those who have felt the most pain so far?
I think the sectors that will continue to struggle most are those that depend on air travel and large groups of people gathering together. Hospitality and tourism, arts and entertainment, and sports. Those have been consistently far down in terms of employment. Some other sectors have been able to rebound. Clothing stores, dental offices, hair salons, places that shut down but have been able to reopen and have been enjoying some pent-up demand as people deferred their teeth cleanings and their haircuts. Not me, of course. I did go to the dentist, no reason to go to the barber. But it's really those arts and entertainment, hospitality, tourism, sports that depend on bringing lots of people together. They're in for the longest struggle.
Yeah, we're continuing to watch those numbers as they come in. But Jed Kolko, Indeed chief economist, appreciate you joining us to break that all down.
Thanks very much.
I want to dig into that issue a little bit deeper here as we continue to see some states instituting restrictions and moving backwards here. We got the update here in New York City yesterday from Governor Cuomo, New York City Mayor Bill de Blasio, that New York City would be closing down schools again after the city's positivity rate here in terms of coronavirus testing hit a 3% average over the last 7 days. It also comes as the Centers for Disease Control and Prevention quietly removed a disputed document that it had posted earlier in the year after President Trump had been pushing for more reasons as to why we should be reopening schools this fall, despite some concerns that coronavirus still would be able to be transmitted by students and younger children as they return to schools. I want to break down that issue as well as the latest vaccine updates here with our next guest. That would be Dr. Barbara Pahoud, Research Director of Pediatric Infectious Diseases at Children's Mercy in Kansas City. Alongside, also want to bring into the conversation here, Yahoo Finance's Anjali Kamlani. And Dr. Pahoud, I mean, when we break this down, that is one of the big question marks that had been there when we talk about faith in the system, in the CDC, perhaps some pressures coming from President Trump to perhaps overlook some of the scientific concerns here. What have you seen when you specifically look at schools, children, and the risks around coronavirus?
Listen, when we started working on this at the very beginning of the pandemic, trying to get kids back to school, it was crystal clear to us pediatricians that the best spot for a child to be is at school. But we were unaware of what the risk would be for the child and for the teachers to open up schools. We now have data to show that those that have opened up have been able to go back to school as long as they continue to observe measures like wearing masks and cohorting their patients. My daughter is in school right now and she's doing face-to-face and things are going great. Unfortunately, the schools are at the mercy of the community. So if the community is not doing the correct thing, they're not wearing masks, and there's ongoing transmission within the community, there's going to be cases in school, but not because the transmission is happening inside of the school. So if I ruled the world, which I don't, I would say community spread needs to stop by putting more harsh measures by maybe closing some restaurants or businesses and ensuring mask wearing, but not necessarily closing the schools.
Yeah, on that point, we've seen Mayor Bill de Blasio here in New York City really getting hit hard by critics who say, why is it in fact that bars and gyms are remaining open when schools are being closed? He's consistently pointed to this 3% positivity rate as the bar for closure when the WHO, for example, said 5% is okay. When you look at what's playing out here, is the city being too conservative?
I mean, I am not in New York City. I used to live there, so I understand they're trying to close everything. But I agree with you that if it was my decision, I would limit the spread of disease in the community, not in the schools. There are children that require those lunches, that they need to be in school to avoid being exposed at home to a concern for child abuse. Parents are stressed, communities are stressed. We should be thinking about this backwards, in my opinion, and closing, like you said, gyms before we close schools.
Doctor, we just heard from the CDC on several points dealing with Thanksgiving guidance. On one hand, going back to the point that schools are closing and the guidance that had come previously from then, but also looking now for Thanksgiving and restrictions on travel, or at least the idea of it or the suggestion of it coming down from the CDC is probably one of the first times we've seen any kind of national strategy, coming from them. Can this really be enforced? Is this something that we should be taking into account, or is it just too broad and too much for the CDC to enforce?
I think it's too much and too broad for the CDC to enforce. As you know, in this country, everything goes down to a very small level. Even if the governor of Kansas imposes, for example, wide range use of masks, it's up to each county to decide if they want to enforce it or not. So that is one of the problems we're facing in the United States, that everything is decided at a local level, and there's pretty much nothing that happens at a national level. And remember how hard it was for us to get seatbelts approved. But it's not until that happened as a law that we were able to start preventing deaths in cars. So unfortunately, at some point, if we really want to take care of this pandemic, it's going to have to be something that everybody agrees to do as a country, not case by case, state by state, county by county.
Yeah, and that's the big question here too. I mean, we talk about New York so much just because we're here, and also it's the nation's largest school district. So obviously it's big news when they reverse course. But also on that front, I mean, you have the mayor coming out and saying, look, indoor dining, writing's on the wall. That's probably going to shut down in the next week or two as well, just a matter of time. So maybe splitting hairs here when we say, all right, well, which one's going to close first? If the overall trend is going backwards and shutting more things down. So when you look at it, what's been your take here as we've seen renewed discussions? It sounds like Biden's task force discussed the idea of a nationwide lockdown, but has swept that aside, not necessarily something that President-elect Joe Biden wants to do here. But what is your take on maybe some of those restrictions and how much farther we should be going as cases continue to rise?
Well, again, I think we should be, I mean, it's my understanding in New York that the school closure came way before the idea of closing restaurants or gyms or anything that makes money. So I guess this is what we should be talking about in this type of media. Things that make money, people are afraid of locking down the economy, right? Well, my job is not, I'm not an economist. I don't work in that field. I'm a pediatrician. So I'm more worried about the kids than I am about the economy. And of course I worry about the economy, but my point is, if the kids and the schools are not driving this pandemic up, why are we starting there? Because it's the easy thing to do politically speaking. I don't think that's the right thing for us to do as a nation to curb this pandemic. And we should be going with the data, not with the finances.
Doctor, one of those things, of course, that the financial industry and really all sectors in the business world are looking at is the vaccine and the good news that we've received. But of course, we won't see that reach the general public until next April at earliest, according to many officials. So going off of that, there has been a lot of focus, and I know something you're passionate about diversity in those clinical trials. We've seen some results coming out with the diversity of the demographics of the trial participants. Has that been satisfactory? And I know that the children and toddlers that are going to be entering the trials, it might be a little bit harder to get the diversity there. I wonder what your thoughts are on that.
So many thoughts on that. Number one, let's start with the kids. We need to start doing pediatric clinical trials. The only company that is currently doing it is Pfizer. They started with teenagers, and other companies are going to start doing that as well. And that needs to happen because, again, speaking about the schools, if you had a vaccine for children and children were immunized, parents and teachers would feel more comfortable about going back to school, even though the data shows that schools are not the major driver of the pandemic. Now, for the other vaccines, of course, it's very reassuring data we've been seeing. I would not focus too much on the 90 versus 95%. From the very beginning, we knew the data were going to be comfortable. Because when Pfizer released their results 2 weeks ago, they said 90%, that was 1 week post second vaccination. Moderna released 95% 2 weeks post vaccination. So when you normalize those two things, obviously the data is going to be very similar. They use similar technology, messenger RNA. It's very reassuring to know that the vaccines are working. And
so
the diversity.
If that efficacy rate is not the one we should be focused on, what should we be looking to?
Well, what I mean is the details of 90 versus 95%. I mean, we're splitting hairs. They're both really 95% at the end of the day. They were just reporting at different time frames. One was reporting efficacy at 1 week post second dose. The other one was reporting efficacy 2 weeks post second dose. And then when Pfizer realized that's what Moderna did, the 2 week post, they came out with their new results this week of we are also 95%. Of course, what I'm saying is they're all over 90%. They're both great. That's fantastic in the vaccine world. I think all the other vaccines, as we continue to finish clinical trials, are going to continue to show good efficacy. But a difference of 90 to 95, they're both great. And it's fantastic news. And from a diversity perspective, we are doing our best to try to enroll African American and Latinx populations. But there's still a lot of distrust among these communities of joining these clinical trials, but we are doing the best we can. And there's been more enrollment of African American and Latinos in this type of study with the COVID vaccines than ever before in clinical trials. So it is definitely a step in the right direction, but we need to do more.
Yeah, and to your point, I mean, we saw that threshold by the FDA being set at 50% efficacy. So you're right, splitting hairs at 90, 95. The market seemingly agreeing with that as well, as we're not seeing as big a pop on the AstraZeneca news as we did earlier. But I appreciate you coming on to chat with us today, Dr. Barbara Pahoud, alongside Yahoo Finance's Anjali Kamlani. Thank you both.
Thank you.
We're off for another break, but coming up, we're going to be looking at the outlook for the Fed under a Biden administration. Our next guest says, don't expect a significant shift in monetary policy. Mike Tiedemann from Tiedemann Advisors will join us on the other side of the break. Welcome back to Yahoo Finance Live. We are seeing Treasury yields slipping today on the back of disappointing data out this morning. Jobless claims rising to 742,000, the first increase we've seen since early October, and the 10-year right now at 0.84 and the 30-year trading at 1.56 for the yield there. Let's bring in Mike Tiedemann. He is with Tiedemann Advisors. And Mike, as we talk about all of this, of course, we're looking ahead to where policy is likely to shift under this incoming administration. You've essentially said that, look, as it relates to monetary policy, not a whole lot is going to change because we've seen the Fed very clearly indicate that rates are going to remain low for a very long time.
Yeah, for a couple of reasons. And if history's any guide, if you look at Japan over the last 30 years and obviously what's been occurring in Europe, that will remain the case. But their stated inflation target of above 2%, an unemployment target of below 4 gives them a huge amount of coverage to wait and to do very little. So there's going to be more stimulus. The risk of rising rates would actually pose such a huge budgetary issue that we really don't see any reason and really any room for the Fed to change their policy.
Michael, I mean, when we think about where the Fed's at right now, I feel like if we hear Fed Chair Jerome Powell come out and say that that Congress needs to do more here and that they're running out of options for the Fed to do these things, I think he's going to pop because it's just constantly putting the pressure back on Congress to get that stimulus bill done. What's your estimate, though, in terms of how many tools the Fed still has to play their part in really keeping this recovery going?
Well, I think we've all learned that when we think the Fed is done creating new tools. I mean, no one would have expected them to be buying corporate bonds and high yields through, at the depths of the crisis. But what we're seeing right now, and what's really a key differential, is the health of the banking system. And I don't mean the large multinational banks, but really a lot of the community and regional banks. For now, they are actually in a much better shape, certainly than they were in 2008. So low rates with a banking system that is lending and a banking system that is generally pretty healthy actually has and that's what you're seeing in the housing market. You're seeing you're seeing credit available, and that is a huge flow through that didn't exist coming out of 08, 09, 10, all those years, the banking system was in reverse. So that's a very big difference that the Fed has to benefit their own efforts. But in terms of other creative measures, what they're really saying is they've done enough for capital markets. They've done arguably too much for capital markets. But now the small businesses, a lot of the cyclical industries, the ones that have been really damaged, will need two things. They'll obviously need continued low rates, and they're going to need investor capital. They're going to need restart capital. And that's an area that, a lot of the interesting strategies that we focus on are really beginning to gear up, because they think the pressure will continue for the next 6 months, for many industries at least. And then a lot of these great brands that have done everything right and nothing wrong, but have been severely damaged by the pandemic, will have an opportunity to raise capital and sort of not so much it is distress, but it's more of a sort of a restructuring of sorts.
Yes. So Mike, what does that low rate, low yield environment mean for you from an investment standpoint?
Well, you've never had to take more duration risk to earn as little as you have in history ever. So we are at the low end of our quality bond holding levels. We think there are opportunities, as I was just mentioning, in sort of what we call diversified. And that includes assets like gold. And for those who want to own Bitcoin, we don't tell them not to. But the less liquid portions of the credit markets have only begun recovering. The liquid portions that were linked to ETFs would have you recovered very quickly, and higher quality corporate bonds, and that was due to the Fed's involvement. So we still think there's some interesting stuff within that space: structured credit, mortgages linked to the housing market and the health of the housing market. And then within equities, our focus continues to be really high quality businesses. You're obviously seeing more recently a rotation into cyclical or assets that have been left behind. And in terms of a valuation standpoint, mid-cap equities, we think there are a lot of good businesses that have been really left behind this very narrow equity market recovery.
And when we talk about the risks, the unintended consequences of some of that arguable overdoing it coming from the Fed here, Michael, when you look at some of these zombie companies that are now just piling on the debt, and we were already at record corporate debt levels heading into the pandemic now, and you see companies like Carnival Cruise Lines coming out and issuing more and more debt. You have AMC doing the same thing. Talk to me about some of the risks there as rates stay low and what that will do to growth here as these companies just sit there, I guess, surviving, but not really growing.
Well, there's always a tipping point for industries, and obviously the aggregate level of debt and relative to their equity valuations and the health of their business. There's a duration in which that naturally can tip over. So without focusing on one industry like Carnival or in business like Carnival Cruise, I would say the dynamic of low rates and the ability to refinance at lower and lower rates has enabled businesses that are being disruptive to last longer. It has confused a lot of value investors who see this free cash flow that's being generated today, and by any measure, these companies look cheap. They're generating free cash flow, but ultimately they are being disrupted. And what changed in 2020 in a dramatic fashion is investor appetite for the prospect of future cash flow has traded at a premium we've never seen before, and obviously growth. And the recognition that these businesses are not only disrupting in the future, they're disrupting today and will continue to do so. And so that's been a huge dynamic. You have to sift through value, cyclical, and businesses. And depending on the industries that have been most impacted by COVID, you've got to understand, you've got to ultimately make a choice whether or not how to project a recovery and ultimately how to structure an investment into that business.
Mike Tiedemann, CEO and founding partner of Tiedemann Advisors. It's good to talk to you today. I appreciate your time.
Thank you.
All right, coming up, focusing in on the pain in the restaurant biz. We'll chat with a one-star as to why he's opening a new restaurant in the face of all this and what he's seen with those restaurants he works with. You know him well. The star of Bar Rescue, John Taffer, will join us right after the break. Stay with us. Welcome back to Yahoo Finance Live. We're going to be discussing restaurants and the pain being felt by that sector in just a second. But first, I want to spotlight the fact that our own editor-in-chief, Andy Serwer, was able to catch up with an actor in another sector that's seen its own impact here in 2020. That would be actor and film star here, Matthew McConaughey. Andy got a chance to ask him about the impact to the filming industry and how it's changed here this year. Take a listen.
What we're doing right now is going to remain, to some extent, the new normal. Even if the vaccine, which is coming out soon, so they say, and if that becomes successful and more people get vaccinated, there are millions of people who are going to say, no, thank you. I practiced remotely doing business and having interactions this way. I prefer it. So how does this experience become more exclusive, more intimate, more customized? Because in many ways, I myself prefer this. Not with everybody, but in many ways I have. And then I have to look at my productivity, which I know many companies have looked at their productivity. And some of the companies, the productivity has gone up to see how adaptable their employees can be. So, but then I have to look across even my industry of acting. What's the future of theaters? What's the future of all these communal events? What's the future of my home city of Austin, which is a big hospitality town, which means you got to do it hand to hand. And then, there's a version that I see that of the world turning into of go live wherever you want on the planet. As long as you got 5G, you can be anywhere. We'll see how much that's the new normal, how much now is the future.
Have you talked to people in Hollywood much about how things are going to go from here and maybe starting up production or anything like that?
I haven't really. Most of my friends are still working, and they're telling me that it's going safely, and then there's all the rules and regulations of how they do it. I've been more conservative with our quarantine. I've got my 88-year-old mother with us. I've got my family, 3 children and my wife, and I'm also in a privileged position to where I've saved my money where I don't have to work today to pay my rent tomorrow. Right. So I'm in a privileged position to say I'm going to be more conservative with my quarantine. But I've also noticed that I've been quite productive through this. I've employed my children now to be part of my production team when we're shooting photo shoots and shooting ads. And they're starting to get adept with cameras and editing, et cetera. So who knows, I may come out of this and a couple of years and go, I'm a one-stop shop. I've got McConaughey kids in my production team. Let's, what do you want done? We'll shoot it. We'll make it.
McConaughey Family Productions.
That'd be fun.
Yeah. Hey, so getting back to the book, there was a moment in there where you talked about one of your films that has a strong business slant. And you had a part in that, which really resonated with people as well, which is The Wolf of Wall Street.
Mm-hmm.
And I'm wondering, did that change your thinking about Wall Street, or did you research the financial services business when you were doing that part? I mean, that was pretty epic when you just came in and did that soliloquy, right?
Well, that character's soliloquy was awesome. I mean, I try to find what's called a launch pad line with every character, meaning it's a line that you read and you go, oh, if that character means this, then there's an encyclopedia I could write. And I'll make a whole rap on that character, meaning like in Dazed and Confused, there was a character, Wooderson, I played where he's hanging out in front of the pool yard, checking out the high school girls going by, and his buddy says, you got to cut that out, Wooderson. You're going to end up in jail. And Wooderson goes, no, man, that's what I love about those high school girls, man. I get older, they stay the same age. Well, I remember reading that line and going, well, who the heck is that? There's a book on that guy. If that guy believes that, if he's not saying that as an attitude or to be cool or anything, if he believes that, there's a book on a person who goes through life believing that. Well, with Wolf of Wall Street, I remember reading this line where he's telling the Belfort character that Leonardo played, the secret to this business is cocaine and hookers. And I went, who is that? I go, what if this person really believes that? Well, there was a rap. So I just started writing and interviewing different brokers about how it was then, and how, you sort of create a mirage and you just kind of keep it going. And I wrote a lot of that rap, and luckily, I pitched it to Scorsese. He was all for it and went and just laid it down in that scene. It was a wonderful classic scene and so much fun to do.
Yeah, it was an awesome part of an awesome movie too.
Yeah.
Let's switch gears a little bit, Matthew, and I want to talk to you about some brand stuff because that's interesting, and it seems, to sort of fit with the road that you take, which is sticking to who you are. And, you know, the Lincoln commercials and your brand ambassadorship with Lincoln, part of Ford, of course, has been very high profile. It's been, you know, Ellen's done it, Jim Carrey, South Park. I mean, it's been all over the place, but it seems to have really worked, and you seem really comfortable in those commercials, and I think Lincoln's comfortable with you. Is that the case?
We're selling cars, we're selling automobiles, we're selling SUVs. Indeed. I mean, look, Lincoln and I and the Ford company have had a great relationship since the beginning. Hudson Rouge, the ad agency, we're still working with the same people there, John Pierce over there. So myself, Lincoln, Ford, and the ad company, we're all very aligned in what we wanted to do. And so we came out with the first ads, and I was coming off of True Detective. And so I riffed on a bunch of those things that I say in the car, and those got parodied, Saturday Night Live and Ellen. And that's like, okay, great. And some of the parodies were actually very good. Some were better than others, but I don't mind impersonation. Me, just be really good at it. And some of them did some damn good work. Well, that sort of got attention and eyeballs on it. And we said early on, look, there's so many loud commercials out there. All the ads are like, who can turn up the volume the most? Well, what if we make such an intentional and deliberate commercial that's so quiet that it actually cuts through the noise? And I saw it happen. I was in sports bars on Sunday afternoons with loud males and females screaming over the game, and then the ad would come on and they'd go, and their head would turn to the TV to see the ad. So it worked. And we've maintained a very consistent tone, where what we've gotten to is where you want to get to, I believe, is where I've become synonymous with Lincoln and Lincoln has become synonymous with me. So we're feeding each other, and we continue. We just made some ads here recently that we're putting out, and the SUVs that are coming out of there are doing well, and it's helped some sales, and they've got a really good product. I'm particularly fond of that Navigator that I've had, which is a really good product.
Was there any connection to Lincoln Lawyer?
Not really.
Just a coincidence.
It's just really a coincidence. I mean, there was a connection. I had driven a Lincoln before and had one and owned one and drove one in my own life. But that was really just a coincidental callback that I'd done Lincoln Lawyer as well.
Welcome back to Yahoo Finance Live. Restaurants and bars across the country looking at the possibility of new restrictions as we look to the peak of this most recent wave of coronavirus infections. Here in New York City, we did hear from Mayor Bill de Blasio earlier today saying he expects indoor dining to shut down in the next week or two. Mayor saying it's just a matter of time until he imposes those new restrictions. I want to bring in John Taffer, somebody who's, of course, very familiar with the business. He's a founder of a Taffer's Tavern, and you also know him as a star of Paramount Network's Bar Rescue. John, it's great to have you on today. Let's start by those restrictions, because there's no question a lot of those businesses that you have been speaking to are looking at those announcements saying, are we going to have a repeat of what we saw in March and April? How demoralizing do you think that would be for these businesses who are just now getting up and running after the reopening?
It's unbelievably demoralizing. The process has taken away morale every step of the way, but this second hit really hurts for three big reasons. One, there's no PPP plan in place now. There's no payroll provision. So this shutdown means we're probably losing our employees because we can't afford to sustain our team. There's no added unemployment benefits for the employees when we do lose them now. And then when you hear de Blasio saying we'll probably close in 2 weeks, and you're not making money over these 2 weeks anyway, when you think about that, where is your motivation to open tomorrow? You might as well close right now and cut your losses and hold your cash as much as you can. This is a tough, tough hit for the industry.
Yeah, and John, I mean, it's not just restaurants trying to figure out what they're going to do in the short term, but also what's going to happen, perhaps some permanently closing down as well. We've seen estimates out there that as many as a third, perhaps 40% of restaurants across the country will permanently close due to all this. What's your estimate as you see these restaurants struggling as they deal with stop, start, stop again? What's your estimate?
I think there will be a direct correlation with closures, length of closures, and statistics of restaurants and bars that are permanently closed. There has to be, because unrestricted areas have figured out ways to at least sustain themselves. Even with 50% capacity in outdoor eating and delivery and curbside pickup, we found certain ways to sustain ourselves. We've adapted as an industry. We're barely surviving. But the second hit is extremely powerful. We're out of money. And when I interviewed President Trump 3 weeks ago or so, right before the election, we talked about the fact that a round of PPP had to cover debt going back 6 months. And that was critical. There are three things we need to do to keep this business stable. One, we have to provide some type of debt relief because many of us are behind 6, 7, 8 months in rent. So there has to be some chunk of dollars to relieve a bad debt. The next issue is payroll for a period of time. We don't want all of these employees to lose their jobs. And then there needs to be an ongoing provision to jumpstart us in the spring post-vaccine, which I, by the way, think this summer will be boomtown for the restaurant industry. But we have to survive to be able to participate in that.
Yeah, I mean, to your point, there's no question there's going to be some pent-up demand waiting on the other end. The question is just how much more runway do some of these restaurants and small businesses have to get to the other side? What about your business? How are you adjusting right now? And what are some changes that you have had to make over the last several months in order to adjust to the demands in the market and the restrictions?
Well, we, believe it or not, just opened Taffer's Tavern 3 weeks ago in Alpharetta, Georgia, which is a major suburb of Atlanta. And people say, how could you do that in the middle of the pandemic? But we got to this place in a fascinating way. Think about this. 2 years ago, the restaurant industry was greatly challenged because we couldn't find employees. Unemployment was so low. The biggest problem in the restaurant industry 2 years ago was finding employees, particularly back of the house employees. So 2 years ago, we said, let's design the kitchen of the future using computers, robotics, because if we can't find a labor pool, let's replace it through automation. So we did, and we worked in test kitchens for 2 years and had technology partners and transactional technology partners and bar equipment partners and kitchen equipment partners. And for 2 years, we worked on creating this a model with less human participation due to the lack of labor pool. Well, we did it, and the food is great, and the systems are great, and the computer systems run wonderful. As we're doing it, we realized, son of a gun, this is the safest kitchen in America. So when COVID hit, coincidentally, with less human contact, less counter space, less raw product and cooked product, all of these physical changes and human contact reductions, son of a gun, we wound up with the TAFR safe dining system. So our processes are extremely unique in the restaurant industry in the way our food is handled, a lack of human contact and preparation, the consistency, the quality. It's fascinating where we landed being so COVID safe, because our beginnings were reacting to the economics of the marketplace 2 years ago.
And John, I mean, you talked about your interview with President Trump, how surprised you were at his grasping of the issues that these restaurants were going to fail if they didn't get additional PPP support here. Obviously, it hasn't happened post-election. You guys spoke before the election. Now that we moved past it, there was hopes that it would come through here. I guess, are you surprised that someone could have an understanding that these restaurants aren't going to survive? And then we sit here after the election and it still hasn't come through if it is going to wipe out a third of America's restaurants permanently.
Well, you know, that starts to become a political answer, and I try to avoid going there. I would only say that the amount of proposals sent from the White House to Congress to facilitate that stimulus package was a very large amount of proposals. And I would say if you look at, and I'm not picking either side, but I would say if you look at Democratic internal discussions which have been published, there are many Democrats who are a little angry at their speaker for holding back those bills because their constituents have been hurt as a result by it. So it's all where you choose to place the blame. But I would say I'm a numbers guy. When you look at the amount of proposals that came out of the White House to Congress versus Congress to the White House, it's like 11 zip. So I'm not sure placing that blame on the White House is a reasonable assertion, candidly, and I'm being non-political in that statement.
And John, I want to get back to what you said about your tavern, your restaurant that you just opened, about this focus on automation, really, how that has somehow worked out in terms of timing. Is that where the restaurants are headed? And this is something that we've heard increasingly from some owners who say, we're trying to make things less with less contact. We're trying to make sure things, they're able to address the concerns about the virus spreading. Does that ultimately lead to more automation and less jobs in the sector?
Well, you know, it's interesting. In medical sciences, almost every checkpoint where we protect ourselves has some type of a scientific basis to it. So in our restaurant, we have things like after you wash your hands, you put your hands under a scanner. If there's any viral or bacterial content on your hands whatsoever, you get a red light, you go back to the sink. If your hands are actually sanitary and clean, you get a green light, you get to go to work. So little hand washing alone doesn't do it without that scientific check. So I think we're going to see a lot more scientific checkpoints within restaurants. For example, in food manufacturers, they take temperature along the assembly line, and there's all these devices and computer systems and paper tapes that track the temperature and the treatment of every product. When it gets to a restaurant, those things really don't exist. I think we're going to see much more science involved in kitchens. But there's another side to this, and it's driven by the economics. The restaurant industry typically can afford to spend 30% of its revenue on labor. So 30 cents of every dollar goes to labor. They can't afford to pay 35% labor because there's only 10 to 12% margins. So the only way they can spend more dollars in labor is to raise revenue, because you can't let the percentage go up. You won't make money. So if a restaurant has to achieve a 30% labor cost, and certain states or federal government move payroll to $15 an hour, and in some states with tip credits, that's almost a 600% raise. And at the same time, they try to unionize, and at the same time, other costs go up, then restaurants can't survive. So their only option is to automate everything, because the human cost becomes too great. Because again, we can only spend 30%. So if I can spend 30% and I have 10 people working, and you raise payroll by 50%, well, I now have 7 people working. So I still have to hit that 30%. So there has to be a way to step up payroll increases, to do it over a period of a time in a plan, because I'm all for it. I want people to make as much money as they can. We all do. But how do we get there in an intelligent way? So when you look at automation, It's driven by the finances of the industry as well as COVID. And there are many burger chains now and many companies now that have installed automated equipment that takes that raw product, puts it on a grill, flips it, drops it on a bun, and there's no human involved. So it all comes down to business economics and safety, and they're both calculated in the mix.
Yeah, I mean, it speaks to the challenges a lot of these restaurants are having to weigh right now, looking at the human cost, but also looking at their finances, saying, you know, how am I going to move forward in order to survive? John, it's good to talk to you today. I really appreciate your insight. John Taffer, the founder of Taffer's Tavern, of course, a star of Paramount Network's Bar Rescue.
Thank you.
All right, coming up, we're going to stick with food here. If you're salivating after the idea of a robot flipping a burger onto the bun here, we're going to discuss why Thanksgiving has gotten a bit cheaper this year. One silver lining as we worry about what that celebration might look like. It's at least going to cost us a bit less. We'll have the details right after this. Welcome back to Yahoo Finance Live. The NASDAQ remains the lone index in the green here. And for more on those moves, I want to get to Yahoo Finance's chartmaster, Jared Blickery, with the latest. Jared?
Yeah, just looking at the Wi-Fi Interactive, lots of red on the screen, except for Asia, which closed 12 hours ago at least. And then the NASDAQ, which is up 0.3%, as you were saying, Zach. And just looking at the NASDAQ 100 heat map here, Apple is now in the red for about 0.25%, but the other big caps pretty much in the green, but not by much. It looks like Microsoft is up 17 basis points, Alphabet 27, Tesla up 2.15%. This is good enough for a record high, up 12% over the last 2 days. And over the last month, it is up 15%. Finally broke out of that trading range that it was in. Looking at the travel space here, we have a lot of red except for Southwest. That's notably in the green for about 0.5%, and Carnival up over 1%. Then looking at the software space, which was doing nicely today. Actually, we have quite a few breakouts from consolidations and some nice leadership here. So these may be some of the leaders that we see if we are to go higher. Twilio is up over 6%, Okta up over 4.5%. Lots of household names here, well, maybe corporate household names. And then looking at the sector action for today, communication services and tech are the only ones in the green right now. And then we got utilities to the downside off 1.5%. Guys?
All right, Jared Blickery bringing us the latest there. Appreciate that. It is, of course, Thursday, which means Thanksgiving is now just a week away, and perhaps a silver lining here coming from the American Farm Bureau Federation, which has looked at the annual cost of Thanksgiving dinners here in America over the last 35 years. And this year's report shows that the cost of a Thanksgiving dinner is down by about 4% here in 2020. That's the lowest that we've seen that the AFBF has reported since 2010. So Akiko, I mean, there's a silver lining there, including the cost of a turkey. It costs less than last year too, at $19.39 for a 16-pound bird. Perhaps at least one reason there, Akiko, to be excited for Thanksgiving this year.
Yeah, I mean, that's a 7% decline, right? That seems pretty significant. It is surprising, I think, because we've been talking so much about how supply chains have been hit hard, and that has led to inflated food prices. But one of the other good things here is that in addition to the turkey, the Farm Bureau says the price decline includes whipped cream and sweet potatoes, which of course, we all like to eat, right? One thing here in terms of the food increases, we're talking about dinner rolls and bread stuffing and pumpkin pie mix, which may not be good news for a lot of other people. I do wonder, though, if families are spending less money this year, because we've heard so much from doctors about not holding these sort of big dinners, family dinners, and you have to wonder if that leads to some cost savings too.
Yeah, I mean, well, we talked about that. Obviously, the cost savings. So I'm always surprised. Every year, I'm surprised to see that the Thanksgiving dinner only costs, $46.90 this year. That's what it's going to be, less than $5 per person. It never seems like that when you go out and buy all the fixins, but it's relatively cheap. Really, the costs come down to travel, I guess, if you're going to be doing that. And we know fewer people are doing that this year. You look at AAA's travel forecast for Thanksgiving 2020, down 10% versus last year. We know that airlines are suffering with traffic falling as well. I mean, there's a lot here to point to. Even Siri has something to weigh in here on it too. I mean, there's a lot of reasons to point to Thanksgiving getting cheaper here, and at least I guess this year it's so hard to find any silver linings. At least one there, in the bird being cheaper, put on the table.
And Jared highlighting very importantly, I say this as somebody who doesn't drink, that it's cheaper because people aren't drinking, right, Jared?
Yeah, I think that's not included in the cost. I didn't have a chance to read the report, but that was my take. And guess what? I'm getting oysters. I get into oysters over the last 7 months. They're fun and actually not cheap.
Oysters are always fun. There's nothing wrong with bringing oysters to Thanksgiving as well. Perhaps actually even more historically accurate as well. But for that, we'll leave that there. We'll leave you with the one positivity of it being cheaper there. For Jared Blickery, Akiko Fujita, I'm Zach Guzman. That'll do it for us here on Yahoo Finance Live in our hours. But stay tuned. Got much more coming your way right after this.
Welcome into Yahoo Finance Live Markets right now. Are digesting news of the surges of the coronavirus as well as disappointing figures on the jobless claims front. The S&P 500 and the Dow right now are in the red. Now, the NASDAQ is the only major index right now in the green, up roughly 0.3 percentage point right now. And this kind of trend that we've continuously seen as the markets digest this news about the virus. We see investors essentially running right back to tech stocks, which have largely led this market over the last 6 to 8 months throughout this pandemic, becoming a bit of a safe haven for investors as the markets dip. We do have a vaccine candidate, another one from AstraZeneca. It's shown promising efficacy in the elderly. And unlike what we had seen with Moderna and with Pfizer, they actually released their data in the respected and peer-reviewed scientific journal, The Lancet. Moderna and Pfizer have released their results through essentially press releases, which of course has caused some questions about the data that is going to be there. Looking over on a sector basis right now, we see that tech, energy, and communication services right now all in the green. Tech leading the way today, up about 0.25 percentage point, while utilities, healthcare, and real estate right now are lagging in the market. Utilities down almost 1.5% right now. Taking a look over at some stocks, let's take a look over at AstraZeneca right now, down 0.25 percentage point. Again, the healthcare sector is one of the major laggards on today. Do you want to take a look, however, over at some of those tech stocks? As I had been mentioning, we see investors tending to flood right back into that sector when the markets dip. Amazon right now up almost 0.25 percentage point. Zoom up 1.8% right now. We see Facebook and Google also in the green. Apple, however, is in the red, down about 0.1 percentage point right now. Want to get to those jobless claims. We did see initial jobless claims a little bit more disappointing. 742,000 people filed for unemployment for the first time. That is compared to 700,000 that were expected. That is for the week ending November 14th. Continuing claims. 6.372 million people continue to file for unemployment. A little bit better than was expected, which was 6.4 million. So we are seeing some of those continuing claims come down. However, more than 6 million people still needing to file for unemployment. That is for the week ending November 7th. Now, this is the 12th straight week that new claims have come under that 1 million mark, which presents a psychological level here in this, as we've been dealing with this pandemic. But it does represent the first time in 5 weeks that the jobless claims have actually risen. So a worrying trend there. We'll be talking about that a little bit later in the show. On the coronavirus front, yesterday, positive cases of coronavirus when I was starting this show stood at nearly 11.4 million. Well, they are now up over 11.5 million cases in the United States. This is all, of course, according to the Johns Hopkins University tracker. And we have officially passed a very tragic milestone. More than 250,000 Americans have died from the virus. And just yesterday, we hit a new record, more than 170,000 cases in one day. But we're going to start the show with more details on this pandemic. We're joined now by Yahoo Finance's Anjali Khemlani with the latest. Hi, Anjali.
Hey, Kristen. Yeah, to your point about, unfortunately, those continuing rising numbers with coronavirus cases, we're seeing positivity rates in Wyoming and South Dakota remain very concerning, more than 50% positivity in the last 14 days. And so that's really, what we're looking at in terms of the potential for those same numbers to spread across the country. And that is where a lot of the health systems are feeling very under pressure. We're seeing the impact already on testing, with labs warning that they could start seeing delays very shortly. Now, on the AstraZeneca news, of course, very positive news from its phase 2 trial, important to point out, and that is going to be, of course, a delay from when the actual study is done and the results are available, similarly to what we will see with Pfizer and Moderna, who have already indicated that they will be submitting their phase 3 trial results for peer review. AstraZeneca, meanwhile, saying that it will also have its phase 3 trial results by Christmas, likely. And of course, we know that we've heard the positive news from both Pfizer and Moderna, waiting on that filing of an emergency use authorization. So all eyes there for right now. Kristen?
All right. Thank you so much, Anjali. To continue this conversation, we're joined now by Dr. Daria Long, an ER physician in both Georgia and Tennessee, and a clinical assistant professor at the University of Tennessee School of Medicine. Dr. Long, thank you so much for joining us today. As I just mentioned, 170,000 cases in one day. So we are sadly breaking records all the time when it comes to this pandemic. Wondering if you had a sense about what the source of these new infections are. Is it just a matter of the fact that we're going into the colder months, that no one seems to be wearing masks as much as they should? Or is there, perhaps, was it Halloween? What is it?
Hi, Kristen. It's good to be here. I think it's kind of multifactorial. I think in part it is, yes, we are going into colder months. People are more likely to go indoors. I think there's some degree of kind of mask and COVID fatigue that, coupled with the fact that people are getting very mixed messages, lead people to not be following the same kind of protective guidance that we wish they would follow. And that's why we are seeing this continue to spread. And yes, potentially the holidays can, of course, contribute to rising numbers as well.
So I didn't hear you mention schools as a part of that reason. And we keep seeing headlines that schools are not super spreader areas. And yet, of course, we now have this news that we are seeing schools close, especially here in New York City. I'm wondering what your thoughts are on that. Are we being a little bit too hasty in shutting down schools, given all that we know about the virus as it affects young folks?
Yeah, Kristen, I'm glad you asked this. I'm actually working with a number of schools, consulting for them to help them on their back to school protocols, and looking at the data in terms of testing. And what we are finding is, yes, the schools, when you can follow the protocols and when you can couple that with testing, then we are seeing much less risk from schools, as opposed to things like, we know, bars and restaurants. So let's get our priorities straight. Like, let's make sure we're closing the highest risk things first. And then let's make sure we're protecting our schools so that we can keep them open longer, which we're starting to show is indeed possible.
Okay, so to that point, are we getting our priorities wrong? Because we are hearing schools are closing, right? Children have to stay home. And yet when it comes to bars, restaurants, gyms, even, for example, it's been a patchwork response around the country. And it largely seems to be, hey, okay, a restaurant has to close at 10 p.m., a bar has to close at 10 p.m., but it's still allowed to be open throughout the day, which seems to be a little bit of a disconnect when it comes to policy. Wondering what your thoughts are on that.
Yeah, I think you heard the underlying context in my comment there. Yes, we're getting our priorities incorrect if we are shutting down schools and then we're letting these restaurants and bars open, or in these sort of patchwork schedules. I think the biggest problem, Kristen, is there is a lack of centralized nationwide guidance. And from the schools I'm working with, we are requiring heads of schools to make decisions on protocols. We're requiring restaurants and bar owners to make decisions. They're stressed about just trying to stay open and how they can serve people safely. Let's have a centralized guidance for this. We can give everyone guidance on what to do, give them the rules so they can follow that and get back to what they do best, which is educating or feeding people and doing it safely.
And now I keep reading the news that we are seeing the virus surge all around the country. We now have 170,000 cases in just one day. And I know I'm not alone, because I'm getting a lot of text messages from friends who know that I've been on a plane just throughout this pandemic. Hey, I want to travel for Thanksgiving. I don't know what I'm doing. Should I do it? What was it like when you were flying? I'm hearing this a lot. My friends talking about this generalized anxiety over the coronavirus cases that are surging. And yet we keep hearing, okay, we actually don't need to go into a lockdown. Schools can remain open. So, I mean, I guess to talk to that fear, do we need to worry? And does everyone need to stay in their homes and just wear a mask if they're going outside? I guess I'm trying to really get a sense of how bad this could get in just 1 month, for example.
Yeah, you know what, Kristen, as an ER doctor, there's a lot of places where you could get anxious or get concerned about things. And what we try to do is, instead of doing that, instead of being anxious about something vague, we try to put in systems in place. So we say, what are the risks? Let's put in the protocols in place, and then we don't have to be anxious. And that's what I want people to have. I think if we put in some guidelines, say schools can stay open, but no, that you shouldn't be doing a lot of traveling for Thanksgiving. In fact, the CDC just released new guidance about an hour ago saying they don't want people to be traveling for Thanksgiving at all. So no, minimize your travel for Thanksgiving, minimize your socializing. If we do these things, then we wouldn't have to do a global large scale lockdown, and we wouldn't have to be anxious about an uncontrolled outbreak. If we could do the smart things, be testing well, then we could be much more measured about it without being anxious.
I want to get to the holiday in a minute, but I want to ask you first. We see these daily case counts, they are essentially ahead of the hospitalization counts and the hospitalization figures that we eventually see. If we are seeing 170,000 people being testing positive for the virus in just one day, which leads me to think, although you are the expert, but leads me to think that we could be seeing 200,000 before too long. What does that say for hospitals, especially hospitals? I think some people say, listen, the hospitals that are overrun are probably in smaller areas, smaller communities. We don't need to worry if it's in a big city. I'm hoping you can maybe do a little bit of myth busting there. What do you see coming, especially since you work in the ER, down the pike for those hospitalization figures?
Yeah, I think anybody who's not worried about hospital capacity, they just need to come work a shift in the ER with me right now. Whether you are in a big city or a small city, I mean, our hospitals run at capacity on a daily basis, Kristen. That's a separate issue that we should get to being able to fix that better. In my ER and many ERs that I know, our hospitals are so full, they are boarding patients in the ER that are inpatients, which means that we're seeing our ER patients out in the waiting room. So just to lay that out there. So now your ER doctor, we're running back and forth to see patients in the waiting room. That is before we've seen a real flu season. That is before we've seen what could be coming in terms of a peak of COVID. So we need our nation needs to start planning right now for what we're going to do about hospital capacity. And it's not just, Kristen, about having more beds and medications. You only have so many doctors and nurses as well. So we need to start planning now because we are already in shortage. And I hate to have to ring that bell, but we really are. It's bad already in the ER.
So I know what you were saying. Everyone needs to stay at home for Thanksgiving and we're running out of time. So I'm going to move on past that. We all hear your advice. Stay home, see your friends and family through FaceTime. I want to ask you about these vaccines. We now have Pfizer saying 95% efficacy rate, Moderna 94.5 efficacy rate, AstraZeneca. Our vaccine is safe in the elderly. That is the only one, however, that has actually published their results in a peer-reviewed scientific journal. As people are hearing these news, should they be saying, okay, I want the AstraZeneca vaccine when they become available? Should I want the Pfizer vaccine because it's 95% efficacious? How are you squaring them all together? Is one better than the other?
So for one, we can't make decisions based off of press releases. That's for certain. And that's what we have with the Pfizer and Moderna vaccines. I think they are promising. And in terms of being in stage of the game, I think Pfizer and Moderna, we are seeing them ahead of AstraZeneca. This mRNA technology is promising. But what we don't know about them is this immunity actually sterilizing? Meaning, do you actually not get COVID? Pfizer and Moderna know that they reduce symptomatic COVID, but we don't know if they actually reduce total COVID. So that's a really big question. And we also need to know, how long does that immunity last? We don't know that. And of course, for none of them, we don't know the long-term effects. But what I'm telling people right now, especially if you're in that high-risk group, you're going to be wanting to get a vaccine. And it's just probably going to come down to which one is available to you first, because we have the technology and then the risk of being able to distribute it to people. There's a lot of variables still there.
All right, a lot of questions out there. I'm really thankful that you were able to join us and answer some of these questions, at least put some of my anxieties to ease. Dr. Daria Long, ER physician in Georgia and Tennessee and clinical assistant professor at the University of Tennessee School of Medicine. Thanks so much for joining us.
Thanks, Kristen. Take care.
All right, well, coming up after the break, we will be discussing the financial implications of closing schools to children. That's next. Welcome back to Yahoo Finance Live. Checking market action. We are still seeing the S&P 500 and the Dow in the red. The Dow, the laggard on the day, down over 0.3 of a percentage point right now. The NASDAQ, the only major index right now, in the green, up roughly 0.4 of a percentage point, as we are seeing the tech sector leading on the day, up over 0.25 of a percentage point right now. But let's first talk about school closures. According to the Penn Wharton budget model, closing schools impacts children and their future earnings. So all the parents are going to want to listen into this. By the beginning of October, the model estimated that children lost between 4 and 5% of their future lifetime earnings. That's roughly between $43,000 and $57,000. And each month beyond that schools are closed, costs that children are going to be incurring is between $12,000 and $15,000 in projected earnings. So joining us now to discuss, we're joined by the leading author of that report, Efrem Berkovich. He's the Penn Wharton Budget Model's Director of Computational Dynamics. Efrem, thank you so much for joining us. I think parents at home are pretty deeply concerned about this, given that, all the school closures that we have been hearing about lately. And I'm wondering, do these losses happen if all learning is canceled and children aren't going to school at all? Or will children still face these losses to their future earnings if they're still attending school, however, at home and through a laptop, doing so distantly?
Hi, Kristen. Thanks for having me on. And those are great questions. So this is a study that I did with Madison Rababian and Yaron Wu. And the trouble right now is that this is a giant experiment that the world is conducting on our children. We actually don't know what the effects are going to be. So for this work, we did the best that we could. We looked at other work of things like Hurricane Katrina, school strikes, things like that, to try to get an idea of what sort of massive and long-term loss of schooling does for people, particularly children, obviously. And in our review of the literature, we found that, a month of school, as you said, when we did the analysis, and I should say this is a month of lost school, so no schooling at all, will give you these kinds of losses. So we don't want to be alarmist here, because children are in school to some extent. Some people are doing virtual, some people are doing homeschooling, others are going hybrid. So these are really on the high end of what we would expect. Now, that being said, this is still an unknown measurement. We know that the world economy is moving more towards a knowledge-based economy, which means that schooling potentially could be more and more important. So this is not something to take lightly, but at the same time, I don't want to raise alarms that suddenly, you're losing that per month. You can kind of see your children getting poorer and poorer as they sit at home.
I don't have any children, but I know that a lot of my coworkers who do have kids are, understandably very worried and very concerned about the impacts socially in terms of development and their education. So just to double make sure that I want to clarify here. So between $12,000 and $15,000 of losses each month is on the high end. But where we sit right now, for the large part, where some children, even when schools are closing, are still going to school through their laptops, will they still face losses? Because I know that the report highlights that there is still a diminished impact, or rather that the education that they are getting is not as good as when they are attending in person, in class, in school. So there will still be some losses, correct? Even if children are at home with a laptop.
Absolutely. And we went and we talked as much as we could, because, as I said, the data is just not there. There's not been a mass study of this kind of learning on children. Ask me in 30 years, I'll give you a great answer as to what this was. The feedback that we're getting anecdotally is that this is not working as well as it should, in particular for more disadvantaged children. There's some heartbreaking pictures. I don't know if you've seen them of, inner city kids like sitting on the curb next to a Taco Bell, trying to get some free Wi-Fi so that they can access, Khan Academy online. Right. So the students, I think, that are less able to have the resources to take advantage of this are hurting more. On the higher end, out in wealthier suburbs, you have a lot more resources. Everyone has broadband. You have parents at home. So this is really meant to just give a ballpark estimate. I really want to emphasize this is not some hard number that we're putting out there. We're putting something out so that people start to have an idea of where the trade-offs might be. I also want to add that this is just the measure of education loss, meaning that there are other things that are going on here, which I think are also important in terms of students' mental health, as you said, socialization. Those things also are going to impact children's future development and their earnings down the road. So those are things we didn't look at all. And then that would be something you want to add on to your estimate of what we're hurting our children by leaving them out of school.
All right. Well, it is an absolutely fascinating study. I wish we had much more time to really dive into some of the ways that you achieved those figures, but we're going to leave that there. Efrem Berkovich, Penn Wharton Budget Model Director of Computational Dynamics. On your website, you have that study. We also have a write-up of this study on yahoofinance.com. So I encourage everyone to go and check out some of those resources. Thanks so much for joining us.
Thank you.
All right, well, coming up after the break, we're going to be discussing the student loan crisis. That's next. Welcome back to Yahoo Finance Live. The student debt crisis currently sits at more than $1.6 trillion in the United States. And it's something that all of the Democratic presidential candidates promised to tackle, from partial to full erasure of student loan debt. So we're going to talk about this now. We have joining us Kevin Carey, Vice President of Education Policy and Knowledge Management at New America. And we're also joined by Yahoo Finance's Arthi Swaminathan. Thank you both for joining us for this conversation. Kevin, starting with you, we heard a lot throughout this election cycle about canceling student loan debt. I'm wondering, as you're seeing it, does that solve the student debt crisis, or is that just putting a Band-Aid on a much bigger wound?
It doesn't solve the crisis long term, but of course, a lot of people are having debt crises short term right now, particularly if the legislation that currently allows people to suspend their payments expires and they have to start making payments in January, even as the economy is still in a tough shape and we have a lot of unemployment, rent bills coming due. At the same time, I think everyone acknowledges that if we don't change the underlying system that produced that debt in the first place, whatever debt we forgive, the total amount will just start to rise again.
Kevin, just taking a step back, is student loan debt a macroeconomic problem? We've all had this discussion about whether it's a bubble, is it going to burst? But to you, is it a macroeconomic problem we need to address right now?
It's not a bubble in the same way that the housing bubble was. So we don't have like lots of people who are speculating on debt that's going to go bad, where it could destabilize our financial institutions, primarily because the vast majority of all student loans are held by the federal government, which has a, shall we say, expansive capacity to owe money to people. There are questions, however, whether or not the burden of student debt, particularly for this new generation, is an inhibition to family formation. People having children less often, or waiting, putting off buying a home, and so a lot of carry-on effects of people being unable to launch their financial lives because of this debt burden.
Kevin, I was looking at Betsy DeVos being questioned by Senator Warren a couple of years ago, and she was like, do you have any experience running a bank? And she was like, no. So I guess my question is, even if we have to erase all the student debt and we rebuild the system, what is the biggest weakness? Is it the system doesn't work? Is it higher education system itself is flawed? I mean, what is it the incentive structure? What is the biggest weakness to you?
I mean, in some ways, the system works a little too well. It is designed to provide access to higher education. Anybody who is an American citizen and is enrolled in pretty much any college has a right to borrow money. There's no underwriting, there are no credit standards. And that's as it should be. That's to give people a chance to make that investment in themselves. But it also means that the whole thing runs on autopilot. It's just the federal government printing money and lending it out based on what colleges choose to charge. And so I think the longer term solution is going to have to involve some stronger federal role in perhaps controlling the prices that colleges charge, because that ultimately determines how much money students borrow.
Kevin, I'm wondering, as we see this pandemic, we've heard a lot of folks talking about how this pandemic is providing a pretty unique opportunity to tackle a lot of the problems that we see throughout this country, not just in education, but in, for example, the healthcare system. I'm wondering if you're seeing that this pandemic is also providing an opportunity to create some changes, structural changes, even inside the education system. And have you seen any schools or school systems adapting best to some of the challenges that teachers and students are facing right now?
I do think that there's more of a desire for fundamental higher education reform than probably in 50 years. You know, Bernie Sanders rode the idea of free college almost to the Democratic nomination twice. And, you know, that used to be a radical idea, and now it's basically just conventional wisdom on the left and among the Democratic Party. And that would be a huge change, the likes of which we haven't seen probably since the late 1960s, early 1970s. At the same time, the pandemic has forced technology adoption across the sector in ways that no one anticipated. I don't want to say that that's been a great thing. It's been a huge struggle for a lot of students and a lot of teachers, because it was unexpected. We see a real decline in enrollment in community colleges right now, which is a terrible problem. It is going to push down the overall educational attainment of the workforce. So that's not good. That said, I do think people are learning a lot about online learning and teaching with technology, and hopefully we can use those lessons in a more constructive way once the pandemic has passed.
Kevin, looking at the enrollment data, like you mentioned, community colleges enrollment is way down, but for-profit colleges enrollment is way up. And they also had a kind of a head start. They've done distance learning for a while. So do you think they're sort of going to benefit from this sudden rush to enrollment?
Yeah, I mean, the for-profit college sector has struggled quite a bit since its peak in the late 2000s. There was, pardon me, a lot of regulation under the Obama administration, which I think will probably come back now under, pardon me, a Biden administration. At the same time, for-profit colleges are very good at enrolling people. You know, they are convenient and focused on signing people up in ways that traditional colleges sometimes aren't very good at. And they are also heavily in the online sector. And so if you're home, you've got some time, you're unemployed, and you see this as a chance to get a new credential, they're right there with programs for you to enroll.
So Kevin, last one for you here. I know that you were talking just a moment ago about some of the biggest weaknesses in the system and some of the difficulties moving forward if we wanted to change it. And it seems like the education system is a behemoth and some of the problems are kind of overwhelming. How would you suggest, shifting this whole behemoth of funding the system? And do you think in your mind does it require just structural changes, or do you think it also requires perhaps societal shifts in how we are approaching education and how we think we should be paying for it?
I would say two things. I think we need to do a better job of supporting both the people and institutions outside of the traditional 4-year graduate from high school, go to college, get a bachelor's degree sector, because that's only a small piece of the higher education sector. Those traditional students are actually non-traditional on a percentage basis. Most students are working, they have children, they took a few years off after high school, maybe they're getting an associate's degree or a certificate. We don't fund that part of the system all that well. We don't really support those students as well as we could. And we don't provide pathways into the labor market that are cost effective and teach students really well. So I think we need to shift away from the elites. We're always talking about Harvard and MIT and what all those institutions are doing, more toward the sector and the students who really need our help the most.
All right, we will leave that there. Kevin Carey, Vice President of Education Policy and Knowledge Management at New America. And of course, thank you to Yahoo Finance's Arthi Swaminathan. Thank you so much to the both of you for joining this conversation.
Thank you.
All right, coming up after the break, markets right now, still a mixed bag with the NASDAQ up roughly 0.5 percentage point. We will be talking jobless claims and today's market moves right after this. Welcome back to Yahoo Finance Live. Checking market action, the NASDAQ remains the only major index right now in the green, up roughly 0.5 percentage point, while the Dow and the S&P 500 are in the red. The S&P 500 down roughly 0.1 of a percentage point, with the Dow down roughly 0.3 of a percentage point. On a sector basis, we are seeing tech right now, the leader on the day, up almost 0.4 of a percentage point, followed by energy, utilities, healthcare, and financials remain the laggards on the day. I want to talk more about today's market action. We're joined now by Kara Murphy, Chief Investment Officer at Goldman Sachs Personal Financial Management. Kara, I want to start first, however, on the jobless claims. As a reminder for everyone, for the week ending November 14th, the numbers came in at 742,000. That is compared to the 700,000 that were expected. So still lower than that 1 million mark. But this is the first time in about 5 weeks that those jobless claims have actually risen. So I want to start there, Kara. I mean, these figures were disappointing, higher than they were expected. I'm worried. I'm interested to know if you are concerned or worried, not if anyone thinks I'm worried or concerned, but if you are, about this trend here that we're seeing, this reversal in those jobless claims that now they're going up.
I think it's important to remember that these numbers tend to jump around from week to week. They're a great kind of contemporaneous view of what's happening in the economy, but there can be a lot of noise in them as well. And so this negative number, or higher than expected initial jobless claims, is coming, as you said, on the back of several months of actually much better than expected jobless claims. So I think I don't think this is a break in the trend. We will have to watch it very closely. There are some other economic indicators that are suggesting a plateauing of economic growth. And so it's not something to be completely dismissed out of hand. But I think in general, what we've seen is a remarkably resilient labor market despite these economic challenges.
Do you still maintain that, I guess I'll call it optimism in the face of the fact, and I know you heard a little bit earlier when we were chatting, 170,000 cases of coronavirus just yesterday. That is a new record. We're seeing them surge and spike all over the country. And of course, now we have the holidays coming up. When people are expected to get together. And so folks are largely expecting that those numbers are going to increase. Do you have any worries going forward? I know what you were just saying about the jobless claims and the economic data, but looking out ahead, how worried are you about this headwind of the virus to not just the market, but also the economy, at least in the near term?
Well, it's hard not to be worried, right? And I say that both as a CIO and also as a mom of 3 kids, and I have a family. But I also think we need to take this in context. We knew that this period of time we were likely to see a second wave of the virus. That's exactly what's happening. We also know that we're likely to have a vaccine sometime this year. Our current estimates are that by the mid part of next year, much of the US will have access to a vaccine. So what that means is, even though this period might be rocky going forward, we do believe it will be relatively short-lived. And as you know, the market is a discounting mechanism. They're going to look out past 6, 12 months to where the economy is going to be then. So I don't want to dismiss the very real human costs that we're facing right now, but I think in a broad macroeconomic perspective, we're going to be able to look through a lot of that volatility.
How are you advising your clients to be approaching their own portfolios, both just in the near term, of course, with coronavirus hanging over everyone's head, but also in the longer term, because everyone's expecting that we are going to be having this vaccine next year and it will start to roll out. And largely everyone's expecting and hoping that the pandemic is going to be over.
Yeah, you're right. It's a lot of push and pull. And so what we're advising clients in a nutshell is stay the course. So if we back up a little bit from the very near-term concerns that we have, we think that the economic expansion that we've had over the last couple of months is actually just the beginning of what will end up being a multi-year economic expansion. And when we have a growing economy, looking back at history, 80% of the time the S&P has positive returns for that year. And then if you put a number of those years together, the cumulative expansion in the S&P 500 can be quite significant. So even though we've had a really strong rebound from the bottom earlier this year, we still think that there's plenty more for the market to go in the latter years of this economic expansion.
So I want to look in specifically at the tech sector. The NASDAQ right now, the only major index in the green. And we have been seeing investors rotating out of that sector a little bit. However, tech did lead the market for actually this entire pandemic. How are you approaching specifically just the tech sector? As you see it, at least in the near term, should folks continue to keep their same level of exposure? I know you're saying stay the course, but are you advising anyone perhaps to trim a little bit of their exposure, especially to some of those big tech names?
It's interesting because we've looked at, if you can sort of like expand that, strict tech focus a little bit more broadly into the growth sectors overall, what we found is that as there's more optimism around a vaccine and the end of this pandemic, we actually see growth stocks, tech stocks in particular, underperforming, and then value stocks starting to outperform. We've only seen little glimpses of that so far, but as we get closer to the end of this pandemic, that could be an opportunity for a bit of a rotation out of growth into more value-oriented areas. So the types of areas that we see a lot of opportunity are those where expectations have been quite low, valuations are low, and we think there's an opportunity for those companies to outperform those low expectations.
Last one for you here. We're talking about stimulus, it feels like, repeatedly over and over again. And now that we have the vaccine, and now we have these cases surging, it almost feels as if we've forgotten that there are stimulus talks that are supposed to be happening again, at least in the coming weeks. How important do you see stimulus to the markets? And do you still think that this economy really needs the economic aid?
I do think it's still really important that we get a fiscal stimulus. I think given the results of the election, we do expect there to be a stimulus, but smaller than what we might have had if it had been a completely democratically controlled White House and Congress. But I think there's clear acceptance on both sides of the aisle that we're in for some rough roads over the next few months until we get to the other side of this, and that we're going to have some sort of government funding to sort of make up for that economic pothole that we're going to have to get over. So we do think that eventually we'll be able to have an agreement. What the ultimate number will be, it's unclear, but I think it will be important for the market.
All right, Kara Murphy, Chief Investment Officer at Goldman Sachs Personal Financial Management. Thank you so much for joining us today.
Thank you.
All right, coming up, we will be diving into all the drama going on in Wayne County, Michigan in the certification of their election results. That's next. Welcome back to Yahoo Finance Live. Well, after voting to certify the election results in Wayne County, that concludes the city of Detroit, the Republican members on the board wanted to rescind their vote. So we're going to be digging into some of this drama. We are joined again by Jonathan Kinloch, Vice Chair of the Wayne County Board of Canvassers and one of the Democrats on the panel. So Jonathan, I'm so glad you were able to join us again today. I want to start with the Republicans on the panel seeming to want to flip-flop and change their vote. Can they rescind their vote? Can the county decide to, I guess, uncertify results that they already certified?
And it is unfortunate that we're actually having this conversation because you have two individuals who are members of this board who know that we took that action on the 14th day in the canvas and certification process. We absolutely are out of time. We absolutely cannot even reconsider or take any action associated with the general election results. This election is certified. This is now in the custody of the Michigan State Board of Canvassers for them to act and to certify all of the other offices and proposals that is before them.
So, Jonathan, I want to ask you about some news that we just heard coming out. This being reported in the New York Times, that President Trump right now is trying to essentially invite Republican state legislators to the White House tomorrow, so Friday, in an attempt, I'm assuming, to try to overturn the results within the state. I'm wondering for some of your comments on that. And if on a state level, I know you just mentioned that it has now moved to the State Board of Canvassers, if on a state level, we could see some more drama there and choosing not to at least certify the results in Wayne County that you guys have already certified.
Let me just say this. It would be a grave error for any individual to try to impede, to disenfranchise, to play politics with the vote of over 800,000 voters in Wayne County that were ballots that were cast. There is the whole what I'm seeing here is a lot of noise being made when individuals know, both at the county level and the state level, the certification of the election is ministerial. It's not a discretionary power placed upon us. So where the difference is, where there is relief at the county, if the county, had we not certified the election, it would have just automatically went to the state, and the state would have certified. And if there is ever this sort of issue where the state Board of Canvassers became deadlocked, then they would have, then the citizens and other individuals would be able to go into the courts and get a writ of mandamus. So because there was a relief in that the county, had we not certified it, would moved up to the state for it to certify. The state is the final arbitrator in certification. And so had they not done their job, if they don't do their job, then you could go to court and get a writ of mandamus. To force them to do their job. I don't know. I'm sure that the legislative leaders in Michigan have had that conversation with the Republican Party officials who are trying to create this air of confusion out here. But the election is certified, and according to Michigan law, it is to be the action of the State Board of Canvassers is to do exactly that: certify the election on Monday. I mean, it's just too much confusion, unfortunately, that this White House has been causing from the moment that President Trump came down those escalators.
So I'm glad you mentioned confusion, because I too am confused. In Michigan, the lawsuits have been dropped. Rudy Giuliani, one of the president's attorneys, saying that essentially the lawsuits were dropped because they received the relief that they wanted in terms of at least Wayne County with the election results there, which confuses me because the election results have been certified and it did not go their way. We saw Trump tweeting out today, quote, "Voter fraud in Detroit is rampant and has been for many years." I know that you were just touching on the confusion that the Trump campaign has been essentially creating and causing throughout this election. I'm going to ask you again, you answered this yesterday, I'm going to ask you again. Has there been any evidence of voter fraud in the city of Detroit or Wayne County at large that the president has been able to prove, or that you guys have seen?
Not at all. Kristen, the lawsuits were going to be dropped anyway. The lawsuits were going to be dropped anyway, as all, if not many of the lawsuits have been dropped across this country. They have not produced evidence in any regard as it relates to demonstrating fraud in any fashion. We didn't find it. They know it don't exist. That's why they're using some of these other tactics to try to interrupt the certification of our election. It will not work. Donald Trump will be out of the White House. Thank goodness, thank God, on January 20th at 12:01 in the afternoon. I am just tired of this Freddy Krueger nightmare we've been going through. It's just so unfortunate. It's amazing. Every day since the election, we have been inundated with lawsuits and all of these claims of fraud. And then the judges, listen, the judges have asked, okay, bring us the evidence. Bring us the evidence. It's just amazing that we're still dealing with this today. Like you said, after the election has been certified here in Wayne County.
All right, well, we will leave that there. Yesterday, you said it was reckless and irresponsible. Today, it is a Freddy Krueger nightmare, always with some strong words and opinions. Thank you so much, Jonathan Kinloch, Wayne County Board of Canvassers Vice Chairman, one of the Democrats on that panel. Thanks for joining us today.
Thank you.
All right, well, coming up after the break, we are going to be talking about the possible long-term changes to unemployment insurance after this pandemic is over. That's next. Welcome back to Yahoo Finance Live. I want to talk now about unemployment insurance, about the possible changes coming down the pike after this pandemic is over. We have Yahoo Finance's Jessica Smith here with some of those details. Hi, Jess.
Hey, Kristen. Some lawmakers and experts say that the pandemic really highlighted problems with the way the U.S. handles unemployment benefits. Now, some of them are looking at ways they can make long-term changes when this is over. Senator Ron Wyden is currently the top Democrat on the Senate Finance Committee, and he's told me if Democrats manage to get control of the Senate and he becomes chairman, this is going to be one of his top priorities. So some of the ideas that are floating around, first, updating the technology. You'll remember back in the spring when there was that record wave of unemployment claims, the systems across the United States were just overwhelmed. They crashed. People have had to wait for weeks or months to get their benefits. Those systems need updating, and there is bipartisan support for that idea. Some people say all of the chaos in that showed that the federal government should actually take over the system instead of having all of these different programs that vary from state to state. Now, Wyden said it's time to examine that issue, but he's not ready to support that just yet. He does want to make gig workers eligible for unemployment. The CARES Act did have a program that made gig workers, contractors, and others others that weren't typically eligible for unemployment. They were able to receive those benefits. And now he and others think that those changes or something similar need to be made permanent. There's also a push to expand benefits and establish a baseline that all of these states have to follow for how generous and how long these benefits actually last. There will be some opposition to that. Opponents say, people in Mississippi don't necessarily need as much money to get by as people living in New York. Wyden said that he would consider the cost of living differences from state to state. Let's watch.
And what I'm going to be looking for is all of the ideas for making sure there is a floor of dignity for all our workers. If, for example, you're talking about somebody who's trying to survive on $200 a week, and that's the average benefit in some states, that's just not something that should be acceptable in America.
Now, I did try to get a comment from the top Republican, the chairman of the Senate Finance Committee, Senator Chuck Grassley, but his office did not make him available. Kristen?
Jess, I quickly wanted to ask you what the chances are that all of these changes are going to be made in the next Congress.
Well, I think updating technology is something that everyone agrees on. We'll see if it actually gets done, but everyone agrees that is a problem that needs to be addressed. As far as the other changes, I did ask Wyden about that. He said he acknowledges this is going to be difficult. And he said, look back at the fight that we had over the $600 boost to unemployment benefits, that fight that is really still going on. He says that shows just how difficult this is going to be going forward.
All right. Thanks so much, Yahoo Finance. Jessica Smith. Sorry about butchering your name there. You can read her report on yahoofinance.com. Quick look at the markets right now. The S&P 500 has flipped into the green, joining the NASDAQ. The Dow right now down roughly 0.1 of a percentage point. Yahoo Finance Live continues, and Alexis Christoforous will be talking to John Katzimatidis. He is the CEO of Red Apple Group, which owns the Gristetti's market and some of those D'Agostino supermarkets, on the growing supply shortages. That's next.
Good afternoon, everyone. I'm Alexis Christoforous. Welcome to Yahoo Finance Live. Stocks are mixed after some fresh data showed an economic recovery that is still uneven at best. The number of Americans applying for unemployment benefits rose for the first time in 5 weeks, rising to 742,000 as coronavirus cases march higher in all 50 states. Continuing claims were a bit more upbeat, falling from about 6.8 million to 6.4 million. And while the labor market struggles to regain its footing, the housing market is running on all cylinders, fueled by those record low mortgage rates. Existing home sales rose for the 5th consecutive month, up 4.3%. Now, annually, home resales are up a whopping 26.6%, and that is despite tight supply and surging home prices. Here's how all of this is playing out on Wall Street. We've got the Dow Jones Industrial Average off about 63 points, but the NASDAQ Composite is higher. In fact, at its session high right now, up about 78. The S&P 500 moved into the green column just recently, up just about a point right now. We've got Jared Blickery joining us with the day's big tickers. And Jared, looks like a bunch of them are brand new tickers, right? Because we had no less than 4 companies IPO today. How are they faring?
That's right. One on the NYSE and the other 3 on the NASDAQ, and they're all popping big. I want to take a look at the Wi-Fi Interactive here, and we can see Olema Pharmaceuticals is up 143%. We'll go to an intraday chart, and you can see that huge pop there. Now, Olema operates as a clinical stage biopharmaceutical company, and they focus on discovery, development, and commercialization of the next generation targeted therapy for women's cancers, and also NeoGames. Now, this is not a gaming company per se in terms of computer games. They provide services to state lotteries, and you can see they're off their highs here, but still up 18%. Then we also have Yatsen Holding. That is up 59%. And just rounding out today's leaders here, we also have Telos, that's ticker TLS. That's up a modest 12%. But all in all, IPOs have been doing very well. We can take a look at the Renaissance IPO ETF, and on a year-to-date basis, it is up 84%. And you can see once it found its lows in March, really never looked back. So as a sentiment indicator for IPOs, doing very nicely today.
All right. Also want to highlight a big story that's hitting pretty close to home for us here. Our parent company, Verizon Communications, going to take a stake in BuzzFeed, which is buying HuffPost, if you can follow all that. What are the details, Jared?
That's right. BuzzFeed is buying HuffPost from Verizon for stock. So basically, Verizon is going to get BuzzFeed stock. And in return, Verizon is going to make a cash investment in BuzzFeed. And this is so that they can syndicate content on each other's platforms and also look to explore advertising opportunities. Now, Jonah Peretti actually was one of the founders of, he's the BuzzFeed founder and CEO. He was also one of the founders of HuffPost. And he's saying in some remarks that came from the press release that he's really excited to be doing this, kind of coming full circle. And our own CEO of Verizon Media, Guru Gorapin, said, from the get-go, I was pretty clear that BuzzFeed was a right partner. And he's saying that after a meeting that the two had earlier in this year. So this has been in the works for some time, and this is just the fruition of this combined deal, which is expected to generate lots of synergies for the two companies here.
I would imagine it will. All right. Big gains we're seeing here in the software space today. And I know you've got your eye on Twilio. What's going on there?
That's right. If we could go back to the Wi-Fi Interactive, it's a pretty powerful move today in the entire industry. There you can see only Oracle in the bottom right is down, but we're looking at some nice gains. Twilio is the leader for the day, up 6.5%. And there's really not a lot of news moving the sector here. But if we take a look at a 6-month chart, we can see very similar patterns in a lot of these software stocks. So I'll just go over a few. And that is they have been consolidating for several months and just beginning to break out here. So Twilio breaking to the upside of that negative trend line. Teladoc, now it is at the bottom end of its range, but it might have just had a false breakdown here. So we'll be watching to see if that comes, anything comes of that. And then Shopify here still needs to break out of its consolidation range, which is going back all the way to about June, July here. And then one more, we'll just take Coupa Software. And we can see that it is trying to break to the upside too, but still has a couple of resistance lines. Now, software has been very instrumental to the rally that we've had since March. And in addition to the chip stocks and also those big FANG names that we talk about, sometimes software kind of takes a back seat, but very important to the rally.
For sure. And it usually takes a back seat to the semi stocks. I want to talk about them for a minute because NVIDIA beat on both the top and bottom line. Sales up 57%. Are you surprised the stock isn't rallying more today?
You know, I was watching the earnings when they came out yesterday and the stock reaction, and the initial movement was down. And you can see by the chart today that it was off a few percentage points. And I really didn't find much in the report that could have been interpreted as bearish. Maybe their outlook, expecting a little bit of a dip in sequential quarter growth here. But Raymond James, for instance, many analysts, in addition to Raymond James, positive, but they're raising their price target to 600 from 550. And they're saying this was a strong quarter in guidance due mainly on the back of very strong gaming revenue associated with their new product ramp. And a lot of eyes were on their data center as well. That was up 162% year over year. And in the prior quarter, it was up 167%. A lot of Wall Street analysts didn't think that they were going to be able to match that kind of performance, but they were able to do it. So finally climbing into positive territory here, we have them up about 0.2%. And then year to date, just taking a little bit of a longer term view here, up 128%. And like a lot of those software stocks, still kind of consolidating in a multi-month range here.
Just incredible growth, though, for NVIDIA and stocks like it. All right, Jared, thank you. I want to stick with the markets now and bring in Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, always good to see you. I'd like to start by getting your reaction to that jump in jobless claims that we saw. I mean, 1 week does not necessarily break the broader downward trend that we've been seeing, but what do you make of that jump?
Well, I think it was inevitable that we would start to see the numbers go up again. And unfortunately, because we are seeing some new restrictions in certain places, and we knew that as the winter weather came on, that we would probably see some decline in service sector activity. Some of it's due to layoffs in some of the bigger industries that had been postponed, like the airlines, et cetera. So it's not a terrible number, but it's going in the wrong direction, and that's the problem.
But now on the other side of the equation, you've got the housing market, absolutely gangbusters, which is, it's interesting to see that at a time when you have high unemployment and jobless claims rising. Do you think that the boom we're seeing in housing has maxed out or is very close to maxing out at this point?
Well, existing home sales are near record highs or 15-year highs. So probably the pace isn't going to continue to accelerate at the rate it has coming out of the onset of the pandemic. You've had a lot of increase in mobility, people moving to get more space, and because it's a virtual workforce now, there's a lot more options for them. So I think that we've had a big rush. It'll probably slow down a bit, but the housing market in general benefits from very low interest rates. Obviously, the mortgage rates are near record lows, and this sudden jump in mobility, which is very unusual actually in a recession or a downturn in the economy. Usually it's the other way around. The worry we have is on the other side of the equation, some of the moratorium that have been in place for mortgages and forbearance, that's coming to an end. And so we may indeed see the housing market get really even more divided, where in some places you have people getting evicted, and in other places housing prices are rising.
If we do see that wave of evictions and defaults, what will the cascading effect be for the markets, particularly the fixed income markets, as you are in that area there at Charles Schwab?
Well, there might be a little bit of a concern in the, the non-agency mortgage-backed security market. I don't think that the rise in defaults will be too serious at this stage of the game, although it's really hard to measure. But I think the mortgage-backed securities market will be okay, especially the agency-backed market. But I do think that in general, it tends to be a depressant for interest rates because you suddenly have a weakness in a part of the economy that has been really quite robust.
I want to hone in on the bond market and get your outlook for 2021. The Federal Reserve has kept interest rates very low as they basically throw the kitchen sink at this struggling economy. What are your predictions for where we might see yields in the new year?
Well, we think that there's room for them to move up, for long-term rates to move up. We think the Fed's on hold for a couple of years, as they've indicated. There's no way that it seems likely the economy is going to recover enough for them to start hiking rates anytime soon. But we do think longer-term yields can move up, especially in the second half of next year, as we get towards maybe having a widely distributed vaccine. Some of the hard-hit industries can come back. You're thinking about airlines, travel-related, cruises, hotels, and many of the restaurants and the very service sector-oriented parts of the economy can start to bounce back. And that can lift growth and inflation expectations and get rates to move up maybe in the 1 to 1.5% area on the 10-year Treasury. But we have a bit of a struggle to go through here in the winter months before we get to the other side of this crisis.
I want to touch on the municipality market for a moment, because we know municipalities across the country are hurting. Just this week, the MTA here in New York City came out and said they're going to issue nearly $3 billion in bonds backed for the first time by a payroll tax to help replenish revenues that are being sapped because of the pandemic. Are you surprised by that move, that they're doing it in that way? And do you think demand is going to be there for these bonds?
Yeah, it's a little bit of an unusual way, but look, everybody's had to be creative in this economy. So I think that they're going in the direction they have to go, because at this point, it doesn't look like there's going to be any aid to state and local governments anytime soon, maybe in the first quarter, but it's all very much up in the air, and the Senate's gone home. So the legislation that could go through can't go through now. So I think they need to shore up their finances, and this is a relatively creative way to do it. In terms of demand, look, there's been good demand for municipal bonds. The MTA issued some bonds a while ago with a 4% coupon, and they're trading roughly around 3.5% now. So it seems to be an appetite out there in the market, particularly if they can come at a yield that's significantly above where the rest of the market is.
Yeah, hard to find yield like that. Comes at a risk, but hard to find it. Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Thanks for being with us.
Thank you, Alexis.
Macy's may be forced to close more stores as the coronavirus surges. Details straight ahead. Things have gone from bad to worse at Macy's. The department store chain was struggling before COVID-19 hit, and now it is trying to stay alive. Same-store sales at Macy's plunged more than 20% last quarter, and the CEO said it may temporarily close more stores as COVID cases climb and threaten the crucial holiday shopping season. Here to talk about the retail landscape is Simeon Gutman. He is equity analyst at Morgan Stanley. Simeon, good to have you here. I know that you follow quite closely Walmart and Target. When you look at those retailers and their earnings this week, absolutely, crushing it when it comes to expectations. What are they doing right that a Macy's or department store chains like it are not?
Yeah, I think as you described, this was almost a perfect quarter for Target. It was a great quarter for Walmart. I think it continues this theme of these scale winners in retail, consolidating even more share and leveraging these big e-commerce platforms that they've built over time. If I think big picture, what's distinguishing Walmart and Target from, let's say, the department stores broadly, a little bit of it is accessibility, convenience, a little bit of it is value. I think both of those chains are serving their customer bases, and they have different customers. They're servicing them well. I think they've done a great job with omni-channel. And value doesn't mean just pricing. It means good quality product, differentiated product. And I think we've seen this shift happening and playing out for a long time. You're just seeing it exaggerated. And physically where, it's just harder to do buy online, pick up in store outside of the mall. And less people are likely to go there, especially if they're not selling the consumables, which you're picking up at Walmart and Target. So I think that is some of the factors that's accentuating some of the market share shift.
I think people get the Walmart, Target, Costco story because, like you said, they're selling some of the essentials and the groceries. But you take a look at a company like L Brands, right, the parent company of Victoria's Secret and Bed Bath & Beyond, and they posted blowout quarterly earnings. Stock is up better than 14% right now. Why is somebody like an L Brands doing so well, do you think, in this environment? I understand you don't cover L Brands in particular, but speaking more broadly, why would a brand like that, what are they doing right? Perhaps it has to do with their e-commerce strategy, but what are they doing that a Macy's is not doing?
So I think maybe I'll turn it into a broader answer of how investors are rotating into what I would call names that are being perceived as winners in a vaccine environment, names that have suffered because of the lack of traffic, because traffic to a mall, or because the products that they were selling are not just as the in-demand product. And I think investors are looking to figure out the bottom tick in the fundamentals for some of these businesses. And as long as they're seeing the rate of change improve, they're willing to jump in. So, I don't know the specifics within this with L Brands and the company you mentioned because I don't cover them, but I think there's a general move towards some of these names that have suffered, some of these companies that have suffered, and just ironically, as good as Walmart and Target are doing, actually I think there's a little bit less interest in these equities looking into 2021 from investors because of how well they've done and the need for portfolio managers and investors to find the relative growth, the rate of change growing growth stories for 2021.
So these are not these are not growth stocks in your mind. Do you think that they've peaked, at least for the time being?
I mean, it's a funny word you use, peak. It feels like we're getting peak sales growth on peak margins. And we haven't seen this. This is the best of times. Make no mistake about it. These are phenomenal results in a very difficult time. And what's amplifying the results, not just this consolidation of share, the margins are phenomenal. Promotional environment is low. Companies are selling out of all their goods. So you got everything coiled up and amped up at the same time. And so, yeah, we are in this massive growth mode, and we will likely decelerate from there. I think on the other side, people are looking for the relative growth, the accelerating growth stories, and that's going to be probably some of the other names that's not in my coverage, some of the names you mentioned.
Costco, one of the companies that you cover, again, earnings there pretty spectacular, and they also had that special $10 dividend they're paying out again. It's the fourth time they've done it in 8 years. Do you think it's a smart way for Costco to deploy that extra cash?
It's a fine way. I mean, it's the Costco way of deploying cash. I think they make a joke. It's their regular, irregular form of payment, something like that. And so, look, Costco's great as a retailer. It's obviously been great as a stock. What's interesting about Costco is that their business trends, yes, they benefited during the stock up phase of this pandemic. Their trends have actually sequentially improved, and their traffic is slowly getting better, which is interesting for a consumables retailer and someone who's been doing well at the earlier part of the pandemic. But back to your point, yeah, it's the way that Costco deploys their cash historically, and it's very consistent with what we expect them to do going forward.
All right, Simeon Gutman, equity analyst at Morgan Stanley. Thank you.
Thank you.
A new potential COVID-19 treatment that targets the immune system. We'll speak with the CEO of Immune Bio next. The biotech firm Immune Bio has a unique approach to coronavirus, treating it as a disease of the immune system rather than a neurologic or respiratory disease. Their new treatment, Quelor, is now in clinical trials, and Immune CEO Dr. RJ Tesi joins us now. Good to have you on the show, Doctor. This is exciting news for your company and also for all of us suffering with this virus. Tell us about the clinical trial right now and how's it going?
Yeah, thanks for having me, Alexis. And you're right. The clinical trial is open, and we are focused on the patients that get to the hospital. That is 20% of patients who get to the hospital or who get COVID-19 end up requiring hospitalization. And those patients are a little different. What people don't understand is by the time you get to the hospital, your immune system is actually winning the battle. I mean, the amount of virus in your body is going down. So in fact, it's not an antiviral therapy you need. It's a therapy to treat what's making you sick, and that's the immune system. The immune system, in its quest to get rid of the virus, has gotten completely out of control. You get this, what we call a hyperinflammatory state. It's like, inflammation on steroids. And it's what's killing us or killing patients or hurting patients. So what you need to do is control that inflammation in a way that doesn't compromise the ability of the body to get rid of the virus. And that's what we do with Quelor. We go after one of the cytokines of the cytokine storm. Cytokine storm is that overwrought immune state. We chop the cytokine storm off at the knees, and that should allow the patient to calm down, the immune system calm down, and hopefully they'll be ready to go home in days. And that's what we're doing in this clinical trial. We're testing our drug against what the standard of care is, and we're pretty excited, and so far so good.
Where is the trial taking place? I would imagine you have a few going up simultaneously, and how large a pool are you looking at?
Yeah, so thank you. So the trial will ultimately enroll 366 patients, and I want to give a strong support to the FDA here. The FDA has really gone out of the way to help companies like ours with promising therapies against this pandemic get their drug quickly into the field. And they helped us design this study. Their fingerprints are all over it. So it's a 366 trial where half of the patients get Queller and half don't. So that's a big trial, at least for a small company like ours. And right now we're focused in, the South, Tennessee, Arkansas, Mississippi, Florida, and we're reaching into the upper Midwest. I mean, we're basically going where the patients are. Now, unfortunately, it's not like you can hear about, there's a lot of admissions in Salt Lake City tonight. Let's have a trial open there by 3 days from now. It takes some time. But, because of as you mentioned, because of the way the pandemic has rolled out, you can just about open a site anywhere in the country, and there's patients that need help.
Sadly, you are right. What about a timeline? I know that can be difficult, that you're still in clinical trials, but when might you seek FDA approval, and when might we actually realistically see this hit market?
Well, yeah, once again, a shout out to the FDA. I mean, the FDA has been very open-minded. They never promise anything, but they've used this technique called emergency use authorization to help drugs get to the market very quickly. You saw that with things like, hydroxychloroquine, with convalescent plasma, with dexamethasone, with the Gilead, Lilly, and Regeneron drugs. Now, sometimes they give it and then take it away as the data changes, and that's okay. So we expect to fall under that kind of emergency use authorization. So the faster we can get enrolled, the faster we have data to present to the FDA, and we know that they're going to give us a solid listen to. I think fingers crossed, and maybe I shouldn't say this, but ultimately the vaccines are going to bail us out of this whole thing. And we've had a lot of good news on the vaccine front, but there's going to be a while before everybody gets vaccinated. There's going to be some people that don't take vaccines, which are always going to need drugs for treating the disease in the hospital. So, we believe there's a big need and will continue to be a big need for a while.
I want to talk about this treatment briefly and as it relates to your bottom line. If it were to hit market, is this something insurance would cover? Would it be given to patients for free and the government would be paying for? Because I'm just curious, and I'm sure investors are too.
Yeah, we don't do free. I mean, we're a small company, unfortunately. I admire the companies that have done that, but admittedly, they've gotten tremendous support from Operation Warp Speed. So free, it's a relative free. No, we would expect this to be available through insurance companies. I was a clinician for a very long time, and I understand the payer situation. And one thing that's great about American healthcare is that if you walk in the door of a hospital or a clinic and you're sick, they take care of you, and then they figure out how to pay for it. There's a lot of unfunded care. The bottom line, we're not concerned about patients, at least in the U.S., not having access to the drug. That'll happen. But ultimately, it will be a drug covered by insurance. I can tell you, if you look at our business plan from 3 or 4 years ago, COVID-19 wasn't on the radar screen. So if we are successful in getting this drug through the clinical trial onto the market, we're going to be a couple of years ahead of where we thought we were going to be. But we'll be doing a good thing because we'll be making a difference in patients that have COVID-19, which they need help. There's really no good drugs out there yet.
Aside from, I'm looking ahead and staying optimistic, and post this pandemic, what could a Quelor be used for? What's the use case?
So you're asking what we can use beyond COVID-19. Well,
Right.
because this treats a cytokine and it's called soluble TNF. Soluble TNF is involved in a whole bunch of different inflammatory diseases, chronic inflammatory diseases that, they're the who's of problems. For instance, we have an ongoing phase 1 trial in Alzheimer's disease. Neuroinflammation causes Alzheimer's disease. We have about to open a phase 2 trial in treatment-resistant depression, another disease that's caused by neuroinflammation. We have an interest in NASH and cancer. This drug really can treat a lot of different things. Right now, we're very focused on CNS, Alzheimer's, and treatment-resistant depression. And this COVID thing, like I said, wasn't part of the master plan. But in March, we kind of looked, the board, and I looked at it and said, this is a problem, and we may have something that'll help. Let's throw our hat in the rings. And so we've been working hard to get where we are today.
All right, Dr. R.J. Tesi, CEO of Immune Bio. Good luck with the clinical trials. Thank you.
Thank you, Alexis. It was a pleasure.
Up next, the owner of Manhattan's largest supermarket chain, John Katsimatidis, joins us to talk panic buying at the grocery store. It's been quite the week for crude prices, rallying big, but looks like very close to the flat line here as things settle out. Jared Blickery has got a wrap up for us. Jared?
That's right. We settled a whopping 8 cents down, so basically unchanged on the day. Not a lot of news, except we did get some positive news potentially for OPEC Plus. Now, yesterday, the UAE, United Arab Emirates, said that, or at least there was a report that they might be pulling out of OPEC Plus, and that would mean more supply coming online. OPEC Plus had a key ministerial meeting on Tuesday. In that meeting, not much advancement on the talks to potentially extend those production cuts by 3 to 6 months into the new year. So we're still waiting for that meeting, which is supposed to happen later in the month, and we'll probably get some movement from there. But let's take a look at the price action. Pretty choppy day, but we did end up closer to the highs than the lows. But looking over the last 3 months, we're going to see that we are in the upper end of this range here. Now, $42 has served as a kind of sticking point to the upside for crude oil, but we've had a nice rally in November, and it kind of looks like a lot of these stock charts that we're looking at, the S&P 500, the Dow. So just waiting on that next catalyst, but not having it today here, Alexis.
All right, thanks, Jared. As the coronavirus surges across the country, consumers are rushing back out to the supermarket to stock up on essentials again. But should they be? Joining me now is John Catsimatidis, CEO of the Red Apple Group, which owns the Gristedes and many of the D'Agostino supermarkets in New York City. John, good to see you again. The last time we spoke was a few months ago, and people were out hoarding. What have you been seeing in your business the past few days and weeks?
Well, in the last week or so, there has been some active buying in certain categories. And we have been on several television stations and saying to them that it's not necessary. We have ample supplies. And the only time there's going to be a problem when customers lose control and they just go out and hoard and just take stuff and buy stuff for no reason at all. But I did warn our customers that we have ample supplies of Thanksgiving Day products. But if they hoard, buy early so you don't take a chance. You don't take a chance on ruining your Thanksgiving that you can't get cranberry sauce or something like that.
Right.
But if everybody stays calm, we have ample supplies of everything.
Have you had to put any limits on items? I remember during different times in this pandemic, I've seen, only 2 hand sanitizers per person or 2 paper towels per person. Have you had to do that?
As of this time, no, but we are monitoring the situation very carefully, and we will if we have to. At what point do you do it? That's the problem.
Mm-hmm. What are you hearing from your suppliers, and are there any potential hiccups you see down the road, especially with certain kinds of products, with those paper products, which have been really difficult to find?
Well, the A brands, Charmin, Bounty, they're still in short supply for some reason. But we'll always have toilet paper. You might not get the toilet paper you want to get. You get the B brands.
All right, we have to make do with the B brands. You have a very diverse portfolio of businesses there at the Red Apple Group. It's not just supermarkets. It ranges from energy and shipping to real estate and even media. I know you bought WABC Radio last year, but I want to hone in on real estate. You're a landlord many times over in the city. All this talk about an exodus, people leaving the city in droves. Are you personally seeing that right now?
It is horrible. I've lived in Suffolk County during the pandemic a little bit, and our beach house out there. And Suffolk County had as many as 500,000 New Yorkers there. Right now, there's still, in the middle of November, there's still 300,000 New Yorkers out there. And a lot of them have registered their children in schools in Suffolk County. And a lot of them are not necessarily come back. They're not selling their apartments necessarily, but they feel safer out there. And it's not because of COVID, Alexis. It's about feeling safe in the streets. Because of the new laws that were passed in Albany with the bail laws, police officers, the NYPD arrest people and they get a parking ticket. I call it a parking ticket, whatever they call it, ACD ticket. Nobody used to carry a gun in New York unless you had a license. And because it was a mandatory 1 year in jail if you got caught carrying a gun. And I had the deputy commissioner on one of my shows the other day, and there was 1,400 gun arrests in the last 4 months. And you know how many of them are in jail? None. They got desk appearance tickets. They got parking tickets. How many of those people do you think are ever going to show up to report to the court? None of them.
John, what I'm hearing from you is that you're talking about the crime rate in New York City. You're talking about quality of life issues. A lot of that has to do with the governor. A lot of it has to do with our mayor de Blasio. You ran for mayor back in 2013 on the Republican ticket. Are you going to run again next year, John?
I'm being urged to do so, and I haven't made up my mind. I'm enjoying my life, and I'm enjoying my children. I'm enjoying showing my children how to run our companies. And see me in January.
We will do that. We will definitely come back and ask you. I want to stay on politics for a moment because you're a prolific campaign donor. You're a vocal supporter of President Trump. What do you make of him still not conceding, not working with President-elect Biden in terms of national security and briefing him? I mean, is it time for President Trump to concede this presidential race?
No. It's the Electoral College doesn't meet till the middle of December. I had Joe Lieberman, Senator Lieberman, on my show a week ago. And Al Gore and Senator Lieberman didn't concede till mid-December. Let's go through the process. Let's go through, let the Justice Department do their job, let the FBI do their job, let the lawsuits, let the Supreme Court do their job. And whoever is elected president of the United States on December 14th, I will salute him as Mr. President.
Okay, if that person is indeed President-elect Biden, he has promised to raise corporate taxes on day one. John, as a billionaire businessman in a high state tax like New York, do you agree with Biden's tax proposals?
I do not agree with it. I don't think giving the government more money to spend the government way is pretty dumb. I don't think the government has been spending money the right way in the last few years. And I believe low taxes has attracted companies to come back to the United States. And all we're going to do is they're going to find a way to leave again. And high taxes in New York State, Florida, come on down.
Right. But I mean, look, New York and basically every state in this country is having a problem with a revenue drain because of this pandemic. How do you deal with that? If you're not going to raise taxes, how do you replenish the coffers, John?
Well, when you're a CEO of a company, you raise the taxes a little bit, or you raise whatever you have to, gross margin a little bit, and you reduce your belt a little bit. Politicians have not learned how to do that. All they know how to do is raise, and that's the problem of American politics right now.
I want to get back to the supermarket business for a moment. Are you hiring more people? What have you been doing throughout this pandemic? Because your store your stores are essential and they've been very crowded. So what has the workforce been like for you?
We're making sure our employees stay safe because we supply most of the food for the borough of Manhattan, New York, which is the center of New York City, and getting the product in, making sure our employees stay safe, and making sure our customers are taken care of. That's the basics.
And finally, just as a longtime New Yorker, having built your business there, raising a family there, how long do you think it's going to take to have New York City go back to pre-pandemic levels?
I am very concerned about New York City. If a lot of big companies, I've talked to Cushman & Wakefield, I've talked to other people, a lot of big companies, if they have 10,000 employees in Manhattan or in New York City, they're looking to cut it in half. So I think New York could have a permanent problem because of this.
And maybe you could fix it if you were mayor?
I think if you have the right mayor, in New York and there's confidence, that's all it takes. Confidence that the right thing, that the common sense thing will be done. A common sense mayor will be able to fix it.
All right, we'll talk again in January and see if you're throwing a hat in the ring. John Catsimatidis, CEO of the Red Apple Group, thanks for being with us.
Thank you, Alexa.
All right, coming up next, we're going to deep dive into earnings season as we begin to wrap things up. We're back right after this. Welcome back to Yahoo Finance Live. Earnings season is starting to wind down, and if you've been keeping track, as of November 19th, 84% of S&P 500 companies reported actual earnings per share that were above estimates, albeit the bar was already lowered. Let's talk about it now with Jordan Stewart, Client Portfolio Manager at Federated Hermes. Jordan, good to see you. So we're almost done here with the plethora of earnings. How would you characterize earnings season this time around?
Yeah, so we're starting to see some improvement. The companies, the value companies, call them airlines and hotel companies that have been hit the hardest during the pandemic, are starting to show some improvements in the sense of cost controls, slowing the cash bleed. Businesses are less bad than they were as the third quarter showed, less and less lockdowns, and this economic recovery has been accelerating from here. However, our take is even today, you're starting to see the rotation shift back. Is longer term as we look into 2021. The shift is good for now, but does it continue if lockdowns, as we're seeing today, pick back up? Issues, as the last gentleman who was on talking about potential food shortages or issues in lines in grocery stores in New York. Companies that we own in the growth sectors have the visibility, have the sustainability for their earnings, and don't have to worry about so much of the macro environment, which is so uncertain, whether it's, again, DC or it could be, additional lockdowns, issues with the vaccine. And this thing's going to take some time to recover. And the outlook for the growth companies that have secular tailwinds just have kind of a longer, more sustainable trajectory.
Not every company is able to look out and offer guidance because things are so uncertain right now. But the companies that have been offering that guidance, it's been mostly positive. One would think they would only share guidance if it was positive. But do you think that they're being a little too optimistic, Jordan?
Yeah, that's a good point. So a lot of companies are beating earnings because they haven't provided guidance, and the estimates have been dropped lower and lower as the quarters have gone on, and a lot of companies still don't have guidance into 2021. I think that the bar is getting higher for companies that have that guidance. It's tough to beat a comp where you were up 100% last year if your business was open or you were online, right? But I think that the market is starting to price that in. The growth stocks are very expensive relative to value stocks because they can control, for the most part, their own destiny. And some of the value stocks, again, they have no visibility and very little visibility. So that I think that's caused a lot of investors to stay with the growth stocks that have that visibility, even if the guidance is aggressive. I'd rather grow at 90% versus 100% guidance next year versus negative or 0% flat earnings for the following year. So I think the market's interesting. It's very efficient, and that guidance could come down a little bit. But again, those companies are in a better situation than the other companies in the value side.
Mm-hmm. If companies come out and say, earnings, if we go into major lockdown across the country again, are analysts just going to have to, and companies alike, reassess these earnings estimates, and are things going to have to get a lot lowered?
Yeah, I think a lot of costs have been taken out. So I think this is kind of why we question the trajectory into 2021 is because they have not added that capacity back. Airlines are not adding planes, adding lanes and shifts. So I think the most of the cost that could be taken out has been taken out so far. So I think it's the companies that can grow during the work from home environment, that can benefit from the e-commerce, the pandemic stocks, if you will, are going to be well suited into 2021 and 2022 if this lingers and continues, which from our perspective, you talk to the average CFO, CEO, they're not interested in investing next year or hiring or picking up, adding additional capacity. And in that case, it's going to be software companies, biotech companies that have that trajectory.
What's your forecast for earnings? I don't know if you have an annual one for all of 21, or are you at least looking at Q1 of next year?
Look, we don't have a formal forecast, but we do expect the trajectory to continue to improve. But that all could change. If these lockdowns persist, if we have a weak holiday season this year, I think there's been a dispersion in economies, if you will. The online companies are going to continue to do really well. If you have a brick and mortar store, I think you're going to struggle. So I think everyone has earnings, but they have that eraser ready to go for the next year. Because if these persist, and as we look at the euphoria around the vaccine, now we're into a risky part of the distribution and execution. As your guest 2 guests ago said, there's still going to be a lot of people that aren't going to have access to this in the next 6 months. Some people will hesitate to take the vaccine. Right now we've seen it is effective at 95%, which is outstanding. But this could take some time. And again, it's just that hesitant march forward for investors and CFOs alike to continue to put capital to work. And that's going to cause the economy to have fits and starts.
Yep, and the eraser is not far behind. Jordan Stewart, Client Portfolio Manager at Federated Hermes, thanks for being with us.
Thanks, Alex.
Baristas at Starbucks are about to get a pay raise. Details coming up. Starbucks is raising wages for its baristas as the restaurant industry braces for a hike in the minimum wage. Yahoo Finance's Sabine Marcellus joins us now with the details. Hi, Sabine.
Hi, Alexis. So this is great news for Starbucks workers, baristas, supervisors. They're going to see a bump in pay of at least 10% starting on December 14th. Now, at Starbucks operated restaurants, they're actually going to receive a bump in pay of at least 11%. And those who are starting out wages, that's going to go up 5%. And this is really Starbucks' recognition, obviously, of the work of their employees, but also that President-elect Joe Biden's administration will likely raise the minimum wage. So in anticipation of that, we're seeing the company really support their workers and raise pay. And this is also about competing for the highly anticipated holiday season, which is going to be very challenged, obviously, with the rise in coronavirus cases and the new restrictions we're seeing on businesses.
And actually, Starbucks is one of those retailers who early on in the pandemic made that decision, you know what, we've got to take care of our employees. And I guess we saw other similar restaurant chains sort of take a page out of their book.
That's right. So Starbucks back in March, when we underwent the coronavirus shutdown, they were willing to offer catastrophe pay to their workers. Let's remember at that time, we were really praising, obviously, the doctors, the health officials that were on the front lines, but also those who were actually dealing with consumers, e-commerce, workers that still had to show up for work. So Starbucks did recognize them back in March, and Starbucks is one of those retailers that has been more generous than others in recognizing that it's a tough time and raising wages for their workers.
All right, Sybille Marcellus, thanks so much. And coming up in the next hour, we're going to be speaking with an economist at UBS about the latest economic reports today, existing home sales near a record high, and of course, jobless claims rising for the first time in 5 weeks. All three major indexes now in the green. They've turned positive, actually now near their best levels of the day, after some reports surfaced indicating that talks on Congress about a coronavirus aid package to help American businesses and workers might be back on. There are reports that Senate Majority Leader Mitch McConnell agreed to resume negotiations with Democrats over a potential aid package as cases surge around the country. That would certainly be welcome news. Quick check of the markets shows the NASDAQ, the big winner on the day, percentage-wise, up about 1% right now, a gain of 97 points. The Dow up about 23, and the S&P 500 gaining 11. Much more to come on Yahoo Finance Live. I'm Alexis Christoforous. Thanks for joining us.
The Dow turning positive here in just the last few minutes after Senator Schumer said that Leader Mitch McConnell has agreed to resume stimulus talks. Now, these developments coming as the labor market looks to be weakening. We got that jobless claims report out this morning showing that for the first time since October, we saw an increase in that. So, of course, we will keep on that story for you. Another grim milestone today, the U.S. surpassing 250,000 deaths. Now, this coming as the CDC urges people to stay home for Thanksgiving. Colgate Dean Paul McLaughlin, he's going to tell us how his university managed to keep its classrooms open all semester. And states are in crisis as the pandemic drags on with no stimulus deal in sight. Louisiana State Treasurer John Schroeder will weigh in on the dire budget projections. Welcome back to Yahoo Finance Live. I'm Shauna Smith.
And I'm Adam Shapiro. Good to have you here. Shauna, the sectors that are really surging again, energy is leading the way, but consumer discretionary is not far behind. And that's interesting to note, especially when you consider we got Macy's earnings today. Let's take a look at that stock because shares had been trading between negative and positive in the first half of the trading session, but then they've actually been going higher as we go towards the closing bell. You can see now they're up about 2%. Part of what's going on, same-store sales fell about 20% in the third quarter. Revenue came in at $3.99 billion. That was down year over year from $5.17 billion. Digital sales were up 27%. They still posted a net loss of $91 million. 52-week range on this stock is anywhere from about $4.30 to $18.60. Then there is Sonos. They blew it out of the water yesterday, and you can see that their stock today up almost 30%. What's going on there? Well, a lot of people need music in their lives, and the revenue increased year over year to $339.8 million. That was from $294 million. Their CEO, Patrick Spence, said that in fiscal 2020, we delivered a record 8.2% adjusted EBITDA margin. That's a 10.6% if you actually exclude the effects of tariffs that are imposed against importing goods from parts of the world like China. The total households increased as well to 20%, 10.9 million in fiscal 2020, on top of what had been a 22% increase last year. Shauna?
And two other movers here that we're keeping an eye on. First, we have Tesla with shares up just around 3%, hitting an all-time high today. Of course, this comes ahead of the stock joining the S&P in December. An upgrade from Morgan Stanley today, the analyst there, Adam Jonas, upgrading the stock to overweight from equal weight, raising its price target to $540. That's up from $360. In his note, Adam, he wrote that Tesla is on the verge of a profound model shift from selling cars to generating high-margin recurring software and services revenue. It's the first time in a while that Jonas has had a buy rating on this stock. Shares of Tesla have certainly been a winner this year, with the stock up nearly 500% since January 1st. And I'm also taking a look at L Brands. When you take a look at the S&P, that is the leader there today. We brought you the earnings after the bell yesterday. L Brands beating the street's expectations, posting a third quarter profit. Earnings per share of $1.13, revenue of $3 billion. Same-store sales were very strong during the quarter, up just around 28%. The CEO saying that L Brands is, quote, well-positioned heading into the holidays. He also said that he is encouraged by the response to his merchandise that he's seen over the last several months. Year to date, L Brands up just around 85%. Let's get to the latest on the pandemic, because the numbers that we have seen over the past week have been staggering. The CDC today holding a briefing, strongly recommending that people stay home for Thanksgiving this year instead of traveling. We want to bring in Anjali Kemlani. She joins us now with the latest on this. Anjali?
Thanks, Shauna. Yep, that's an interesting blanket statement we heard from the CDC advising that everyone in the country stay home. And that's probably the first time we've seen sort of this national advisory, if you will. Of course, it is up to the states and municipalities to follow suit. We already know that based on the rising case counts, there have been some areas that have taken some serious measures, whether it is increased restrictions or curfews, a lot of patchwork sort of strategies in place concerning states like South Dakota, Wyoming, and Iowa with higher than 50% positivity rates, very concerning there, and case counts, of course, rising along with hospitalizations. So really a really dark time, as has been anticipated, and really some concerns and questions about what the strategy is, for the rest of the year. There seems to be a lot still in question in terms of what hospitals are going to be able to receive. Of course, that stimulus package waiting in Congress is going to play a role in that. So waiting to hear more on that as well. Meanwhile, in the treatments and vaccine space, we at least got some updates today. Treatments, more importantly, as we know, hospitalizations are rising. A new result from Imperial College in London out today saying that the drug Actemra, which is a Roche drug, is showing some signs of positive effects on hospitalized patients. Now, this is interesting, especially because there was a study earlier this year that was ended by Roche itself that had shown that there was no significant improvement. And of course, in that study today, there is a sort of a footnote saying we're not quite sure exactly what the degree of effectiveness is, but there is some degree of effectiveness. So definitely waiting to see what that all ends up sorting out to, especially when they do get that study peer-reviewed. And AstraZeneca out today with an update on its phase 2 peer-reviewed study showing, of course, the positive results that were anticipated. And we're waiting for phase 3 to be revealed by Christmas. Shauna?
Actually, Angela, I had a quick question for you. This coronavirus task force, the National Task Force press conference that is supposed to take place in the 4 o'clock hour, have they said anything about what that's going to be about, or is this going to be a President Trump camera appearance?
Unclear right now. I do not have any details on that, but like you, I'm waiting to see what happens.
All right, Anjali Kamlani, as always, thanks so much. We want to bring in our next guest here to discuss the pandemic, and for that, we have Dr. Stephen McDonald. He's an emergency medicine physician with the University, with Columbia University. Dr. McDonald, great to have you on the program. Let's just start with the fact you're based in New York City, the city's positivity rate reaching that 3% threshold. New York City public schools going to remote learning. What have you been seeing just in the emergency room at Columbia over the last couple of weeks?
Absolutely. So first of all, thank you for having me. The emergency room where I work is definitely becoming busier and busier. We're by no means at the levels of critical patients that we were in March and April, but there is an uptick in volume. And I'm seeing a lot more incidental coronavirus patients who fell off a skateboard, get an x-ray, and it shows that, there's coronavirus there, and we test them, and lo and behold, it's positive. So it's definitely surprising. There's a notable uptick.
What has changed about the way that people are being treated today who might wind up in a coronavirus ward as opposed to March and April?
At least in the emergency department, I feel more comfortable giving drugs like dexamethasone, a steroid that was heralded as a treatment for coronavirus earlier on in the pandemic, whereas I would not have been comfortable giving that in March and April when it was thought to potentially be dangerous. Once patients reach the wards, we now have drugs like remdesivir, which, while they don't offer necessarily a benefit to mortality, they do decrease symptoms in the patients.
Dr. McDonald, what are you seeing just at your hospital, just in terms of the fact that we've been talking to so many doctors recently, and they've been mentioning staffing shortages, much of that happening out in the Midwest, but what is Columbia doing to prepare for that potential type of situation there?
So I'm not up in administration, but I can tell you that we've actually sent nurses and some doctors to the Midwest to help. Those people are now back. And I believe that we learned lessons from the spring, and we're mobilized and ready to tap into resources to bring doctors and nurses in to help us should we get to that need. But we're by no means there yet.
Understanding that you're not in the administration, but I'm curious, when you speak to your colleagues who might be at other medical facilities here in New York City in the 5 boroughs, is the city prepared for an uptake of coronavirus infections and a surge to the hospital?
Yes, absolutely. So, I think the lessons from March and April have gone relatively well learned, and many hospitals have an action plan, including mine, should things hit that crisis level again. But I do want to emphasize that the control of that lies with government, not with hospitals, and it involves shutting down indoor dining and et cetera.
Yeah, Dr. McDonald, do you think indoor dining and gyms, other areas where studies have shown that is where we see those high transmission rates, should those be closed right now in and around New York City?
I will say it does seem silly to me to close schools and not close indoor dining. Indoor dining, gyms, these are things that have been linked to high levels of transmission. Emphasis on indoor dining, which is 3-fold higher than the next highest competitor there. So I think, yes, I think we're heading that way.
When we talk about indoor dining, there are a lot of restaurants in New York City that have outdoor dining, but they've set up kind of tent scenarios where there are plastic walls to keep people warm on the inside of their outdoor seating areas. Doesn't that defeat the purpose, or is the air exchanged faster in that kind of setting than inside a brick and mortar opening?
I would say I guess every stall is probably a little bit different. I, like you, have raised an eyebrow at a couple of these outdoor dining situations that seem more indoor than outdoor. I think by law, there's supposed to be one open wall. So, if you see 4 enclosed walls, that's flouting the rules.
Dr. McDonald, where do, not only with Columbia, but from the colleagues that you're talking to, where do the PPE equipment, where does that stand? We talked about the fact that we saw so many shortages of that back in March and in April, even into May. Signs of that again in other areas of the country. What's your response to that?
It's an excellent question. And I think it varies a lot. We have a healthcare system that's fundamentally unequal. And so my hospital is very well prepared for the situation. And I feel very well prepared with PPE. That said, I don't know if my colleagues in the city hospital system, which struggles to get the same funding, would say the same thing.
Just out of curiosity, when you hear people in now parts of the country which are going through drastic, dire situations, refer to all of this as a hoax or that it's not really serious, What's that like for you, and what do you want to say to those people?
You know, this happened to me the other day where I was getting my hair cut and my barber asked me if I thought coronavirus was real. So I can tell you it's very much real. I know that many people can't necessarily see the inside of an emergency room because of HIPAA laws, et cetera. And you really only have the words of physicians and the words of patients to go on. And so I want to just paint the clearest picture I can that, yes, we're getting a lot of critical patients coming into the emergency department. Yes, people are still oxygen starved. And yes, this is very real. And I mean, as of today, it's killed 250,000 Americans. So yes, this is real. I don't know how to convey it any better than that.
Dr. McDonald, what is the feeling just amongst you and your colleagues going beyond people just calling it a hoax, but the fact that you've been dealing with that, particularly here in New York City, where we were hit so hard back in March and in April, we've been dealing with it for 8 months. How are they feeling right now when we see the cases rise by such a substantial amount?
Seeing the uptick at my hospital has definitely left me feeling a bit demoralized. When I see people walking around the street without a mask on, when I see people indoor dining, I have the thought of sort of like, what was it for? What is it all for that we worked so hard and tirelessly in the spring, and now we're looking at rising case counts again? And it pains me to read the accounts of these doctors in the Midwest who are reliving the trauma that we lived here in New York. It boggles the mind that the lesson went unlearned in the same year. And so I hope that we finally get it right this time.
Dr. McDonald, we use the very cheap, I guess you'd call it, basic blue mask that you can get at the drugstore. But I've seen online KN95, which I'm told is just the Chinese version of the N95. But if the N95 is in short supply, should those of us who want to get masks go with those drugstore, just basic blue hospital masks as opposed to the KN95s?
Yes, so the functions of the two masks are a bit different. So wearing the basic blue mask, or what we would call a surgical mask in the hospital, that actually does a lot to protect other people should you have coronavirus or if you're an asymptomatic carrier of coronavirus. The KN95 or N95 actually does a lot more to protect you yourself. It filters out those particles from the surroundings. So the best is for everyone to wear the blue masks. If you're in a situation where you can't socially distance and are maybe going to be in a high exposure situation, it's best for you to wear both eye protection and a KN95 or N95.
Dr. Stephen McDonald, emergency medicine physician at Columbia University. Thanks so much for taking the time to join us today. We wish you and your team all the best.
Thank you.
We've got about 45 minutes to go until the closing bell. All three of the major averages turning positive here. This, of course, coming after we got signs that stimulus talks may be restarting. Coming up, we're going to talk to financial analyst Meb Faber. He's going to join us to discuss how to position your portfolio into the end of the year. We're back with that in just 2 minutes.
Welcome back to Yahoo Finance Live. Investors still liking the Russell 2000. It's up over 8 points right now. The S&P 500 is up about 13 points. The Dow up 30 points. NASDAQ is up about 100 points as we head toward the closing bell. We're certainly going to talk about where investors are putting their money with our next guest. That's Meb Faber, CIO of Cambria Investments and PM of Cambria's ETFs. But want to talk to you about something because everyone likes getting some, I don't want to say free money, but easy money that you had in your latest blog, and that had to do with unclaimed assets. We hear about this from time to time and then forget that we might have a couple bucks sitting around in a bank account. So what do you want people to know about Go Get Your Cash?
Great to be here, guys. You know, we talk about a lot of stuff at year end. It's always a good time to reflect. Simply surviving 2020 is a big deal, but it's a good time to reflect on portfolios, your plan. Hopefully it's written down, but also to do the little things, not go for the second serving of turkey or dressing, but to have a little discipline. So we wrote a fun article where we said, here's some sidewalk money, meaning there's about 7 areas where there is literal money sitting on the sidewalk. And unless you're incredibly lazy, you need to take advantage of. And all 7 of these the requirement was they had to take less than an hour of your time. First one you mentioned was states have billions and billions of dollars of cash sitting around on their balance sheets of people when they move or simply can't find you. This is dividends, insurance, trusts, all sorts of things that you can claim. So you go to unclaimed.org. We've been writing about this for years. People get a little sick of it, but I don't care because we found millions of dollars for our followers. Type in your name, type in states you live in or used to live in, and it'll show you, hey, you may have $10, you may have $1,000. We found over 80,000 for single investors. This costs nothing. It's free. If anyone tries to charge you, say, I'm sorry. Fun part, you can search other people. You go into Thanksgiving, you search grandma. Turns out she may have a trust that's got $80,000 and doesn't even know about it. If you're a financial advisor, you could search your clients. There's nothing people like more than free money, except free money that comes from the government. Just be careful who you search. Ex-girlfriends, ex-boyfriends may not appreciate it, but there's nothing people like more than if you find them free money. We had one financial advisor who's found over 250 grand and counting for his clients.
So that's one, the unclaimed assets. What else do you have for us?
Oh, there's a bunch. A fun one is if you're a CEO, a founder, and you have your own company. So let's talk 5 to 500 employees. A lot of people don't know this, and many people don't have CFOs at their company at that size. There's a ton of tax credits that you qualify for. There's R&D tax credits, earned income tax credits. There's a new startup I invested in this year. It's called Main Street. If you go to Main Street, they will audit your financials for free and see if you qualify for any of these tax credits. The average company they find tax credit savings is 75 grand a year. Since I think Q2, they found over $40 million for companies. They take a small slice of whatever they find. And if you're an employee, you can send them the link to this video. You can go print out and say, hey, CFO, CEO, go check this out. And I guarantee you, if you save your company hundreds of thousands of dollars, you'll get a promotion, maybe a bonus. So that's a fun one. But again, they only have a few tax credits, but expanding into hundreds and hundreds of tax credits in the future too.
Meb, I want to talk to you about investors who are looking for yield, because you talk about something that some people don't realize, sometimes the wool getting pulled over their eyes. For instance, I think it's Chase Manhattan here has ads all over the city where they talk about if you deposit, if you're fortunate to have $250,000, put it in a savings account from them, they'll give you $2 grand, but then you got to pay $35 a month in fees and you got to hold it there for a while. And when you do the math, you're actually getting a smaller yield on that investment. That $2 grand doesn't work out to about anything. It's almost like Cartman in the cinema classic South Park when he says, you know, the F word 1,000,000 times. What the what is this about?
So it's a not a secret, but every brokerage on the planet, we're talking Schwab all the way down to Robinhood, makes a significant part of their money by you being too lazy and have your money sitting in cash. I'm a Bank of Rewards preferred, like top tier customer. That means instead of them paying me 0, they pay me 0.04% on my money. It's nothing, right? And all you have to do, there's plenty of places you can go that will pay you a higher percentage, not just with bank CDs, but places like Betterment, places like Max My Interest. And it's not crazy today, but it's around 0.8%. But again, that's better than 0. And so banks like Schwab, brokerages, make half their money from this interest spread. So, and then again, that's just laziness. And there's a short corollary, and this takes a little bit of a philosophical departure, so bear with me. A lot of people, however, think that bonds and cash are the safest investment, and that's actually not true. If you go back 100 years and you look at the after inflation return of T-bills or bonds, at some point you lose 20, 40, 50% of your real assets, okay? And so we ran through the simulation that showed it's actually less volatile and you have lower drawdowns if you invest, say, half, even a third, 2/3 of your safe cash into a global portfolio of stocks, again, bonds and real assets. That feels scary for a lot of people, but at least historically, you can empirically show that that's a safer portfolio over time, because the biggest drag on long-term asset returns, of course, is the deleterious effects of inflation gnawing away. So 2 parts to it. If you're going to do cash, make sure you're getting paid. And B, if you really want some yield, consider investing in global assets.
Talking about global assets, I know you're really stressing the importance here of international exposure. Are you seeing any opportunity in emerging markets? Because we've been talking about for the last couple of weeks, as we see the weaker dollar, that of course could be a tailwind for some of these emerging market plays. What's your read on that?
Oh, baby, I love emerging markets. I'm a romping, stomping bull, emerging market value. We have a fund that does this. I tend to trigger people on Twitter talking about how I put all of my 520, my kids' college fund, as well as my 401k, all into foreign markets. And the best place in the foreign markets is foreign emerging. And if you can even go past that, it's value. You know, a lot of these PE ratios on emerging markets value indices are in the low teens. In some countries, it's straight up single digits. That's relative to the US on a 10-year PE ratio of the low 30s. I think over the next 10 years, if you're willing to wait as value plays out in terms of years, wait a little while. I think it's going to be one of the best performing, if not best performing asset classes over the next decade.
Meb Faber is the CIO of Cambria Investments. Thank you for being here. Coming up, this COVID trade doesn't look like it's going away anytime soon. Why Target and Walmart's e-commerce success is just the beginning after this.
Target and Walmart, they were both out with earnings this week. And one thing that both retailers saw during the third quarter, a massive boost in their e-commerce business. We want to bring in Dan Roberts for a little bit more on this. And Dan, a strong e-commerce platform has been so critical for all retailers in order for them to be successful during the pandemic. When you take a look at the numbers that Target and Walmart put up, I guess how big of a role do you see this playing here in the future and really going beyond the pandemic?
Well, it's everything, Shauna, right? I mean, Walmart's e-commerce sales surged 79%, but Target's were up 155% in the quarter. Now, both had strong beats, not just thanks to e-commerce, but I think it's obvious where the puck is headed. Now, of course, this was already happening before the pandemic, but just to set the stage for you guys to my angle here, I feel like the most interesting story in a macro sense for all of business during the pandemic has been which trends that have accelerated because of the pandemic, because of stay at home, because of remote work, will actually remain after the pandemic, and which ones will go away and return to normal. So we saw that the second Moderna and Pfizer released encouraging vaccine news, a big hit to all the stay-at-home stocks, Peloton, Zoom, Slack. Now, I think some of those, it's silly to think that their growth won't continue after the pandemic. Zoom, Slack, work teams are going to continue to use those names. Peloton, we can debate. A lot of people think once there's a vaccine, goodbye to Peloton's rapid growth, people will return to gyms. But e-commerce, I mean, look at these numbers. This was a trend already happening. Clearly, it's not just going to reverse itself once the pandemic is over and we've got a vaccine. Sure, some people will return to physical retail stores, and that's actually why the share of overall U.S. retail that is represented by e-commerce dipped back a little bit in Q3 from 16.1% in Q2 after full lockdown to 14% in Q3. Now, that's not because e-commerce dipped. That's simply because the share of physical retail went back up in Q3 because stores reopened. But guys, look at the numbers. End of Q3 2019, e-commerce was just 10% of all U.S. retail spending. By Q2 2020, it was 16%. I've heard people say that something like what would have been 3 years of growth for e-commerce happened in the course of 1 quarter because of the pandemic.
Dan, does that hasten the demise of, for instance, Macy's? Because today they were touting e-commerce growth in the quarter of 27%, which in a normal year might have been yay, but now it's like wah, wah.
Right. Well, it's not a zero-sum game. I mean, I think these things can coexist, but you have to do it right. People have to have a reason to come in. So like many other industries, the overall death of brick and mortar has been somewhat exaggerated, but I don't think totally exaggerated. I think some chains that are seen as old and dusty and uninteresting and unchanging are going to die off. They're going to go away, or they're going to shift to complete e-commerce. Other companies are going to be able to have a brick and mortar presence, but also have e-commerce. I mean, Walmart and Target also saw rises in their physical store traffic because stores reopened. Of course, now with cases rising again, even despite the news of a forthcoming vaccine, I think for a while at least, you'll see brick and mortar foot traffic dip again as e-commerce just continues to plow ahead.
And Dan, speaking of retailers that have needed to shift their business models a little bit, it's interesting when you take a look at what Under Armour is doing, because that stock up about 2% today, but it's clearly been struggling this year. It's in the red since January 1st. When you take a look at some of the decisions that they've made to slim down their business, it seems like they're doubling down on that and trimming some more deals here today.
Absolutely. Look, this company is aggressively slimming down. And for a while, maybe the company was hesitant to confirm that or acknowledge that. But now clearly that is the strategy. And the CEO, Patrick Frisk, both on the earnings call and recently on Yahoo Finance's live shows, has basically said, yes, that's what we're doing. And by slimming, we mean A, getting out of some lucrative sponsorship deals that were probably a form of overspending. You know, they are trying to unravel some of those expensive contracts that were signed in the Kevin Plank era. And B, it also means pumping less volume of product into stores and raising prices to maximize profit at the cost of revenue. So stop trying to grow revenue and instead focus on profitability. The latest deal today, the Baltimore Business Journal reporting that Under Armour has agreed to a $10 million basically kill fee to get out of a $50 million sponsorship deal it has with the University of Cincinnati. That deal still had 5 years left on it. That's the third school deal that Under Armour has exited since June. So in the last 6 months, the other two big ones, much bigger than the Cincinnati deal, were UCLA and Berkeley. The company we know just a month ago also sold off its MyFitnessPal app at a loss from what it bought it for 5 years earlier. So this company is taking a lot of steps to try and get out of deals that, frankly, even when they were signed, looked a little risky and looked like Under Armour trying to compete with Nike and Adidas. Now Under Armour is trying to be more like a Lululemon, a premium brand. Less product, but higher price.
Well, we'll see if it works. Again, the stock off just around 25% this year. So maybe this is what Under Armour needs to do in order to turn things around. All right, Dan Roberts, as always, thank you. Coming up here on Yahoo Finance Live, it's a university that was able to bring students back to campus this year and keep them safe. We're going to talk to Colgate University Dean Paul McLaughlin. He's going to join us to tell us how they did it exactly. We're back with that in just 2 minutes.
Heading towards the closing bell. Markets are not necessarily flat, but the S&P 500 up 10 points, Dow's up barely 10 points, Nasdaq's up about 90 points. A lot of college students will be heading home in the middle of the pandemic spiking again in parts of the country. But one university is standing out in its ability to test students and protect its campus. We invite back into the stream Dr. Paul McLaughlin. He is Colgate University's dean. Good to have you here. And I opened up something, the numbers that you tout for some of the testing. Just in mid-September, you averaged in one day 1,529 tests. You have 2,500 students on campus. So put into perspective, that's not an easy task what you accomplished. The real question, though, is it working?
Yeah, thanks, Adam. Nice to be here. You're right. At the end of the day, there's a financial cost to opening a campus and remaining open as we have in-person instruction, but there's also a human cost. And our staff are tired. I will say that since I was last here, testing that many people that often has allowed us to stay safe and remain open, but also it is what's necessary. It's allowed us to sort of identify early. When I was here last, that was our plan. And in fact, that's what we ended up doing.
When we spoke last, it was back in September and students had just been on campus for a couple of weeks. I'm curious just how your testing and how some of your contact tracing efforts may have evolved here during the semester when we found out a little bit more about the virus, exactly how or the most likely places that it's transmitted, and then how you reacted to that.
Yeah, we have learned a lot as the semester's gone on, and that has influenced our activities this term, but also our plans for the spring of 21. And as you said, we've learned a lot about as the sort of nation has reopened lots of campuses, and we've had a chance to watch other people and also experience ourselves What I think we learned is that it wasn't just our testing, Sienna. I think it was testing as a part of a comprehensive plan. Surely we needed to be able to identify those cases early and isolate those, quarantine others that were identified through close contacts. But it was our students' commitment to community health, which is our sort of public health compact. They wore their mask on campus everywhere, into the village. They were good about not gathering in large groups. We also had a reopening plan that had them go through a series of gates, gate 1, gate 2, gate 3, each which had a little more flexibility and freedom. But for instance, we didn't until gate 3 allow students to visit one another in other residence halls. We stayed very close to things like direct family units or roommates, or indirect family units, people who shared a bathroom. And so I think what I want to suggest is that this plan, it really works when it's a network of particular elements, testing being a really important integral one, but not the only one. Otherwise, we would have likely run out of isolation and quarantine space, as some campuses did, and then need to go to remote.
You're also testing wastewater, and I was curious, I don't want to get too gross with this, but are the wastewater systems contained to each, say, dorm or building, or is it one system? Because if it's one system, I mean, in New York City, it all goes to the Hudson, so what good is testing the wastewater?
Yeah, I'll keep it clean, Adam. We do actually test by either building or by area, and it really does depend on sort of the way we can tap into the sewer system. We can actually collect about 24 hours of waste, a sample of that, and look at the prevalence of the virus in that wastewater. We had a baseline, of course, at the beginning before students arrived. We then were able to look throughout the semester, actually every week. That allowed us to do surveillance testing or random sampling testing of students, but we also did targeting testing. So when we would see the virus in a particular area, we would then oversample that particular residence hall in order to identify someone who maybe had the virus and is shedding it through waste, but not shedding it to a place where they are infecting their peers. That, again, is a really important piece of our testing plan.
One of the interesting, I guess, structural changes that have come of this, Colgate has now made the SAT and the ACT optional for applicants over the next 3 years. How will this change the traditional admission process and how you look at prospective students?
I think surely we've always looked at a student's application holistically and comprehensively, test being just one particular piece. In some ways, I think that the person who's going to look at the application differently perhaps is the student. That is, I think they'll look to us in ways maybe they wouldn't have. We know that standardized tests are not always the best predictor of overall success of a student. And we also know that standardized tests can particularly hurt some demographic groups. We think that this not only is necessary in terms of the pandemic, but I think it'll also bring applicants to Colgate. Our applications are up significantly this year. And I think it will bring people to us who otherwise wouldn't have maybe applied to us because of the standardized test requirement or the cost of that. So I'm actually looking forward to seeing a richer pool, and we'll continue with that pool looking holistically at the very best and brightest for us.
Among your peers, are any of them contacting you, one, about the decision you've made regarding what Shauna was just asking you about, but also about the testing? Are you sharing your insight and your policies with others?
Yeah, you know what? I meet often with my counterparts, my other vice president for student affairs, both in the New York Six and also in the Patriot League, which is our sort of athletic conference, and others around the country. This is a wonderfully collegial field, and we're all figuring it out together. So I've learned from other campuses, they're learning from us. I think at the end of the semester, as we look retrospectively at the semester, I think that it's a really wonderful opportunity for the academy to come together. I don't think anyone's trying to hold this close to the vest. I think we're all trying to do what we do well, which is residential liberal arts education. And we all recognize the value of that and want other students to have that across the country. They're not our students, after all, so there's no competition there. In terms of your other question about the standardized test decision, we're in good company on that. And again, we're seeing that it's really hard to get an SAT or ACT test even to begin with. So in some ways, it's a necessity for institutions like us to make this decision.
Dr. Paul McLaughlin is Colgate University's dean. Thank you for being here. Next time, we want to hit the proposals about some relief for student loan debt. But all the best to you and everybody at Colgate. Coming up, all right. Actor, activist, and now author Matthew McConaughey on his new book and how he thinks we can fix the growing wealth gap in the United States right after this.
We have stocks here trading to the upside with just around 15 minutes left in the trading day. Dow up around 68 points, S&P up just around 0.5%. The NASDAQ is outperforming there, led by big tech, with the NASDAQ up just over 100 points. We saw a little bit of a reversal earlier in the hour after we got some positive headlines coming out about stimulus. Apparently talks may be resuming. So that, of course, helping investor sentiment this afternoon. Well, we want to talk about this week's episode of Influencers. Yahoo Finance editor-in-chief Andy Serwer sat down with actor, activist, and now author Matthew McConaughey. They touched on a number of different issues, but here's what Matthew had to say just about social media and wealth inequality.
It sure seems like a lot of times when we break down the differences between us by our sex or color of skin or what have you, boy, everything seems to, the real pot or the real place that everything sort of finds its waterline is in that, is our socioeconomic level. You know, especially in America, the capitalist society, money's still king. You know, you need it to get what you want. It's what we tell. It's what America tells our children and ourselves what to be successful is: money and fame. I think, you know, we need to not necessarily have those always at the top. And also, I think what I mean by that is I'm all for making money. I have good money. I'm all for fame. I'm happy to be famous. But I'm inspired by looking at people like a John Mackey with Whole Foods or a Mark Benioff with Salesforce that go, hey, I have an idea that's really good to do, even if it was for nonprofit, but let's make profit off of it. So what are those things that we can ask ourselves? Hey, no, I want to sell this. I want to make money off of this. I want to get rich off of this. And how could it also be, can we parlay that to being something like, oh, and it's good for the most amount of people? Those two are interchangeable and they don't have to be a contradiction. And I hope that more of us invest in those kind of things, because you can make a really good living, a for-profit living, with a nonprofit idea. And your second half of your question was social media?
Yeah. What's your take on that these days?
I think it's a great tool. And look, I just got on Instagram, I think a year ago. My communication and that platform for me to share parts of myself out with have already been good for me valuably, because I have a direct line of communication and it's not through someone else's filter. It's a direct line. At the same time, it's been good for my business. You know, people check now. I didn't know this until I got on IG. Before you do a certain job, they go, well, let me check how many followers you have. Those followers matter even for business, for advertisers and things like that. What the scary part is that we have to really watch is, for the first time in our lives, we, especially children and millennials, are getting their entire sense of self based on something they put, a picture, a phrase, something that they poof, send out to the world. And they anxiously wait to see what all these strangers are going to say about it. And if the thumbs come back up, I'm going to have a great day. Look at me. I'm popular. If the thumbs come back down, I drop into a depression. Well, that's not healthy. And where's the responsibility lie? I mean, one, it lies with us parents of our children to say, hey, make sure you're not getting your sense of wealth and identity and significance based on just approval or disapproval of the rest of the world. Because understand that there's a lot of folks out there that are putting the thumb down or writing something negative, and they didn't even read or look at what you wrote. All right. So where are we allotting value, and where are we allotting what our kids do? I always say this, kiddos, millennials, all of us, that thing you type in there, that comment, what you say, it's gonna outlive you. It's gonna outlive all of us. So think about it before you press send and before you write it. And also this, it's short money to think that to put you down raises me up. It doesn't.
We can come together as a country again, Matthew.
I know we can, but we're not gonna, here's what I think we have to also watch. We're not gonna become a kumbaya. There's not gonna be perfect justice across society. We're not gonna have a utopia. And I think that it's irrational to think that we are. I think it's actually arrogant sometimes to think that this species, and you look at, we could go into the nominations, who voted what and where. We are evolving, but we're never gonna be our best. We're not gonna get there. And I think that's the point. If we could just do a little bit better, have a small ascension to the quality of our lives and who we are and how we treat ourselves and others in it, then there's a small ascension in our life and in society and in America. America is an aspiration, constantly chasing yet. But we got to realize we ain't never going to get to yet. But that's the point. Trying to get a little bit better is as good as it gets. So join the party in trying to be a little bit better and chasing yet.
You can catch Andy's full interview with Matthew McConaughey tonight on Influencers. It all starts at 5 p.m. Eastern time, right here on Yahoo Finance. We're going to take a quick break, but on the other side, Annandale Capital's George C. joins us on what he's buying in this choppy market. He's going to be here with a bunch of stock picks for you. We're back with that in just 2 minutes.
We've got about 10 minutes left in the trading session with everybody in the green right now. The Russell 2000 is actually up about 10 points, and that's the opening to bring in George C. He's Annandale Capital CEO, and the reason I mention that is you say that people should have exposure to small cap among other investments right now. Make the case as to why.
Well, it's a pretty simple case to make, actually, and thank you for having me on. There's been about a 12-year outperformance of mega cap growth over small cap, mid cap, value stocks, international developed stocks, and emerging market stocks. And one of the truisms and one of the futurisms of investing is that everything along a multi-decade historical norm reverts to the mean eventually. And we're going to see sometime in the next 5 years, and it may already be happening. I think it probably is a reversion to the mean in terms of performance from small caps vis-a-vis mega cap tech stocks. And I think we're starting to see that now. And I think investors would behoove themselves well right here at the end of the year to pivot 5 to 10% that direction in their portfolios so they're more balanced. Everyone has been so overweight mega cap tech for so long, and trades don't work forever. And you saw Warren Buffett reduce his Apple position, which is still gigantic, by about 5% in the third quarter. And that's a tip of the hat to reality that stock and its peers have rallied so hard for so long that gravity is going to take over at some point. And when it does, you're going to want to have some exposure to other things that are clearly undervalued on a historical basis.
So, George, you like small caps. I think in particular, is there a certain theme that you're looking for when you're identifying certain opportunities?
Well, that's the right question, Shauna, and I hope you're having a good day so far. I would really emphasize again the combination of small cap and value, both, because they've both been so out of favor for so long. And for someone with a lot of willingness to take on risk and take a little bit more high beta type exposure, I would look at upstream natural gas producers. The trade for natural gas started up a couple of months ago, and the price of natural gas doubled in 5 months. And it's given back about 23% recently as people bite their fingernails, so to speak, over slightly warmer winter weather than they're expecting. But we're going to have a historically significant gap between supply of natural gas and demand over the next year. And we're going to cut into our supply of that significantly. And I think investors are looking at about a 12-month bull run in those stocks. So I'd look specifically at that and more generally at just small cap value.
George, very quickly, in the natural gas call that you just made, would you include the oil producers? Because they're trading at levels we haven't seen, 50% off, for instance, like Royal Dutch Shell. I'm not asking you to pick a stock. But what about big gas, big oil?
Yeah, that's another good question. If you've got a 4-year time horizon, I would definitely include large petroleum stocks, especially the integrated, since they're safer, as well as the Permian Basin independents in that category. But I'm not as convicted in the short term. I think that oil's going to take longer to play out, and it still has an oversupply problem to some degree, with OPEC always being a wild card. So I'm much more convicted on the natural gas call. I think it's a really good one, and I think it's going to really play out strongly over the next 12 months.
George C. is Annandale Capital CEO. Thank you very much for being here. We're going to hit the closing bell right after this. Just under 3 minutes to the closing bell, and we invite into the stream Jack Ablin. He is Crescent Capital Chief Investment Officer. We also invite in Seth Carpenter, UBS's Chief U.S. Economist. Jared Blickery is on standby too. Let me start with you, Jack, because I'm taking a look at what some people would call the pandemic losers, the airlines. And right now, going into the close, American Airlines, Southwest, even Delta. Delta's off flat, but the other two are trading higher. Despite the spike in COVID-related cases, is now the time to start picking those losers as potential gainers next year?
Yeah, I mean, now that we have a vaccine and we've sort of at least put a pretty good sense of the timeline on the calendar, I think the vaccine has now taken up or addressed the biggest risk facing investing in these weak companies, and that is, okay, there's a deadline now that things will start getting back to normal. One of the issues with investing in these wildly cyclical companies that are bleeding cash is that we had no idea when things would start to turn around for them. And so in many respects, equity investors, particularly in these cyclicals, were looking at their equity portfolios like bond investors would look at their bond portfolios. Which ones are going to make it to the other side? Which ones won't? At least now that we have a time frame, a lot of the risk behind those investments is off the table.
Jared, we're just around a minute from the bell. We saw the Dow come back from negative territory, recovering from earlier losses. That coming in headlines that we got out about stimulus. But what led this rebound, and what are you watching here into the close?
Well, we are at session highs or near session highs for most of the indices, some decent price action today. I was focusing on a lot of the software names. We had some nice action there. I'll get to that heat map in a second, but let's take a look at the NASDAQ 100. And we can see the big guys to the left all gaining nicely. Tesla up 2.5% for another record high. And here is the software space as we're looking at it. And if we sort by performance, we can see some names at the top. Twilio up almost 6%, Teladoc 5%. Coupa up about 4.5%, and same for Slack here. And these software names have been a big part of the run-up since March, and kind of get lost in the shuffle here a lot of times because we talk about the mega caps or some of the flashy semiconductor names like NVIDIA, which, by the way, is closing the day up 15 basis points.
All right, it looks like we're going to settle with the major indexes in positive territory. The sectors are doing well. The only laggards seem to be utilities and healthcare. Want to throw this over to Seth Carpenter because there was news just before we came into the stream that the stimulus talks may live again in Washington, D.C. Is that having an impact, do you think, on the mindset of investors? Or are they saying that's in the rearview mirror, put a fork in it?
No, I think it is having an effect. There's still a fair amount of hope out there, at least among my clients, that something will happen. I think people have ratcheted back sort of the high probability event that it's going to happen sometime this year. We're not looking for it to happen until next year, but I guess I still think Congress is going to be able to come together and get a skinny down package together at some point.
So take a look at the data that we got this morning. Jobless claims rising for the first time since October. Is there any concern from you and your peers just in terms of this being the beginning of an upward trend?
Well, absolutely. Absolutely. There's a concern. And if you look across states, you can see a clear correlation. The states that have the highest COVID per capita cases also see the least progress in job creation, especially in services. And that sort of makes sense. Services is the sector that's been hit hardest by the pandemic. So I think there's absolutely a risk that if the COVID cases continue to rise, stay out of control, then sure, I think there is a real threat to the economy.
Jack, understanding there's a threat, but that 2021 could be a year of rebuilding in all kinds of sectors, not only in the United States, but the global economy. How would the average investor position for that?
Sure. So, our view is that we want to invest in a lot of the names that haven't participated in the rally. The fact is that large cap growth has really been a safe haven play in many respects because of their balance sheet, their pretty predictable earnings growth pattern, and the fact that their businesses have been largely insulated from the vagaries of COVID. But now that perhaps things are starting to free up, life ultimately getting back to normal in the second half of next year, other names should be able to participate. It's remarkable to me, Adam, that, for example, since March, Royal Caribbean Cruise Lines stock has outperformed Amazon stock. So I do think that, and there's still a lot more room to run for what we're calling value, but also quality value. We want to make sure balance sheets are solid enough and pricing power is strong enough to sustain themselves, into the next several quarters.
Seth, what do you make of this disconnect that we've seen? We've seen it now for quite some time, and it doesn't really seem to bother many people on the street, but the total disconnect between what's happening in the economy and what's happening in the stock market. So right now we're not sitting too far from all-time highs, yet the trend that we're seeing in COVID is so worrisome, and we're seeing that fall out, like we were just talking about, in the labor market. How are you kind of looking at this disconnect and I guess bringing it back to your expectations then for this quarter and then going ahead into 2021?
Yeah, I think a big part of the disconnect comes from the fact that this recession was a very, very, very unequally distributed recession. So we know that middle and lower income folks disproportionately were the ones who lost their jobs. The companies that ended up having the hardest time in closing were disproportionately the smaller ones, the ones that were directly relying on bank finance. If you look at the corporate bond market, spreads have tightened a lot, partly due to Fed action, and there have been lots of there's been lots of issuance of corporate debt. So the bigger, better capitalized companies are able to take advantage of basically free money. And I think that bifurcation in the economy explains a little bit of it, because the S&P, the equity market reflects the largest part of the economy. And then you add on top of that the monetary policy response, the Fed slashing interest rates, on track to keep the federal funds rate at zero, basically for as long as the eye can see, a 10-year yield well below, below 1%. I think all of that sets up for really high valuations for the ones who are doing well, and the ones who are doing well are disproportionately in the equity indexes.
Well, that brings
Can I add to that?
Go for it, Jack, because I have a question.
Yeah, so Seth brings up a great point, and that is a lot of the move that we've seen, particularly among high quality companies, has really been fueled by monetary policy. And that's been great. If you look at the total return of the S&P 500, for example, over the last 10 years, it's 260%. One of the things I found remarkable was that 160 percentage points of that gain was valuation expansion. And that was largely due to just Fed largesse. The fact is that, interest rates at all-time lows, Fed balance sheets at all-time highs. And the question now, Adam, is where do we go from here? Can we sustain this continued valuation expansion in a world where perhaps Fed ammunition, monetary policy ammunition is now running dry? And so one of the arguments for value is, if you look at earnings as a function of price, right? PE, just look, take the reciprocal, you're going to get a better deal. And especially if we're relying on a world where we now have to, look more closely at earnings, rely on earnings and dividends rather than valuation expansion going forward. So another argument, I believe, for quality value in a sector that just has really trailed the market for the last dozen years or so.
Jack, I'm going to take this to Seth on something you just said, because I think a lot of people feel that the only place they're going to get any kind of return, any kind of yield, is going to be in equities. And yet, coming into 2020, we were actually anticipating a slowdown, a potential recession. And that's been put off by the quantitative easing and the monetary policy you talk about. But Seth, you don't see any end to that. So why wouldn't equities continue this trajectory higher, even if it's forming a bubble? Why not?
Yeah, I mean, so I'm not going to make an explicit equities call, but I think there's a lot to that story. I mean, one of my clients, I love the way he phrased it. We went from late cycle to early cycle in a matter of 2 months, and the last expansion went on for a record long 10 years. And if we're at the beginning of a similarly long expansion, but starting that off with the 10-year below 1%, I mean, I think there's a lot of argument there for what is driving these prices.
Hey, Jack, when you take a look at what's already priced into the market, when it comes to a vaccine, we saw the massive rally after we got the Pfizer news, and then after we got Moderna. We didn't see quite the extent of the rally that we saw with Pfizer, but still significant gains. Once we get this emergency use authorization, if we do get it, what do you expect the market's reaction to be?
Yeah, I mean, it's remarkable to me how we're taking all bits of news, even if it's the same good news all over again, and pretending like we hadn't heard it before, and we're rallying on it again. Which, that's, I suppose, as an equity holder, that's fine. At some point, we will need to reconcile the economic underpinnings. There's going to be, call it 2 quarters plus another few months where we are going to have to rely on the underlying economy to kind of come along with our expectations. And where COVID is right now, it just is it looks like a pretty dire situation in the near term. And we'll see if policy, whether fiscal or monetary, can paper over those differences.
Jack, when you talk about the expensive market and having a difficult time expanding in excess of earnings and dividends, what happens to a lot of people who are really just passive investors through their 401k programs? What's going to happen to those people? Because usually over a 10-year horizon, they do okay, but this time around, what?
Well, one of the things, before I even answer that, I want to tell you, I was probably one of the biggest proponents of passive investing all along. I latched on to exchange-traded funds in 1997 when the SPY first came out, and have been one of the largest investors in ETFs all along. But I will say the beginning of this year really changed my view. Because of the winners and losers and what's going on underneath the surface, it does require individual security selection. And one of the things I point out is just take the Russell 2000, for example. Forget COVID, forget pandemic and the lockdowns. Even going into 2019, a good 30% of the Russell 2000 has not made a profit in 5 years consistently. So there are a lot of zombies out there. There are companies that should have been out of business a long time ago that are still hanging around thanks to easy financing and refinancing and so forth. And so for those investors who are, buying into the total market, ultimately they'll probably be fine because the winners will, cover up over the losers. But I do believe that individual security selection will likely pay off over the next certainly for the next few years.
Hey, Seth, real quick, when you kind of going off of what Jack was saying, but when you take a look at how the pandemic has accelerated certain trends, and we've seen a number of companies file for bankruptcy, but I also think there's going to be lasting economic effects from this pandemic. What lasting impacts do you see COVID having on the economy going forward?
Yeah, I think the place I look for the longest lasting adverse effect is in the labor market. So if we think back to the financial crisis, we had labor force participation. And it doesn't matter if you sort of adjust for demographic shifts or not. This is the same story from 2008 to 2015. Labor force participation just fell for those years. And it took until basically the beginning of this year, so a 10-year longest expansion on record, before we were able to recoup the losses that recession caused. We've seen a much sharper direct fall in labor force participation. And as more people become permanently unemployed, there's a real risk that gets worse. And so that just means people give up on the labor market. It means that the overall productive capacity of the United States economy is impaired if people are not participating. So I think that really is the kind of scar, whether it's permanent or not. I mean, once you get beyond 5 to 10 years, the difference between permanent and temporary starts to blur.
Seth Carpenter is UBS Chief U.S. Economist, and Jack Ablin is Crescent Capital Chief Investment Officer. And might I say, you've got the coolest piece of artwork we've seen in a long time behind you. Room rate would definitely give you a 10. Even the Russian judge would give you a 10. Thank you both for joining us right now. Coming up straight during crisis as the pandemic drags on with no stimulus deal in sight, Louisiana State Treasurer John Schroeder weighs in on the dire budget projections right after this.
states are in crisis as the pandemic drags on with no stimulus deal in sight. And for more on that, we want to bring in Yahoo Finance reporter R.T. Swaminathan. We're also joined by Louisiana State Treasurer John Schroeder. R.D., I'll turn it over to you first.
Hey, Treasurer. So I don't know if you've seen a Moody's report that recently predicted that there's going to be a sharp drop in revenues in your state between now and 2022. I spoke with S&P as well. They're also highlighting some longer term issues like pension obligations. But I want to take a step back and say, how has your economy been doing and what are some of the key challenges you've been facing?
Well, obviously, it's the same challenges that everybody faces with a pandemic. Have not gone through it before, although as long as it's been, you'd think we'd have some experience at it. It's coming up on a year. But, look, small businesses has taken a hard hit. But you know what's strange about it is that depending on who I talk to, a lot of municipalities' income is actually up, while the state overall, I mean, we're living on $1 billion one-time money from the feds for the CARES Act that was put into the budget, that we have to somehow grow our economy to get over that amount of money. It's not going to happen. They're thinking our deficit's going to be somewhere in the $750 million range. It could be higher, it could be lower next year, but we're battling several fronts. We seem to have every hurricane ever created wants to sit on the doorsteps of Louisiana. I think we had 7 this year. I'm 60 years old, and I mean, it's unbelievable. I've been in Louisiana my whole life. So we continue to have certain things that just seem to pick on the state. Obviously, everything going on negative in the oil and gas industry is having another major effect on the state. So there's a few things that we're facing that quite frankly, we're not going to overcome by ourselves.
So just a follow-up question on just pandemic and unemployment. Obviously, that has expired. So what does that mean for the state, with the sort of no stimulus package? Is that going to put even more pressure? And how are you seeing that play out with the trust fund and everything?
Well, that's a huge problem in itself. And if we don't figure out how to live with the pandemic, when I say live with the pandemic, if we don't figure out how to get people back to work, our trust fund is not in good shape, and we're borrowing money now to pay those unemployment claims. And it's just, look, there's nothing good about it. We just have to hope that somehow we can continue to work and limp along this economy to this pandemic. Either the vaccine comes out to where people have some confidence that they'll go back to doing what they're doing. It's really the bigger cities that are having a problem. Quite frankly, the suburbs seem to be doing okay. But our big cities in the state and the state coffer doesn't seem to be doing very well.
Mr. Schroeder, it's good to have you here. Adam Shapiro, New York City. And I wanted to ask you, I think all of us agree that this is one country. When those hurricanes hit you folk and our tax-supported FEMA goes in to assist, nobody in New York says, don't send that money. And yet, when New York got hit drastically economically by this pandemic, we had Mitch McConnell, Republican leader of the Senate, say, let them go bankrupt. What would you say to Mitch McConnell? Because now lots of states, whether they be Democratic controlled or Republican controlled, you're a Republican. What would you say to him?
Yeah, the hurricanes don't say, you know what, let's go get the Republicans today and let's go get the Democrats tomorrow, right? The good thing about these hurricanes spreading around, everybody's gotten a little taste now of what it's like to have Katrina in your backyard. So look, I might get it. I'm a businessman and entrepreneur. Hurricanes, although bring money in from the feds, it also spurs an economy. I was just down in Calcasieu Parish in Lake Charles yesterday, and to see it in person and feel it in person is altogether different than watching politics in Washington, D.C.
Mr. Schroeder, when you take a look at your current situation, and you're by far, like you're saying, not the only state in this situation, but states have been forced to make really tough decisions about what they need to cut. What are some of the decisions that you've already been forced to make, or that you might be on the verge of making if you don't get help soon?
Well, Sienna, that's a good question, and it's a debate that I often have here. I served on the budget committee for 10 years before I became state treasurer. We haven't had to do a lot because the federal government came in and bailed us out, and it continues. Louisiana has continued to be able to sort of sidestep fixing something because the federal government's so willing to come in and help. And at some point in time, that has to stop. I mean, we had a committee today on our bond commission, and our debt's rising, our debt per capita is rising while we're losing population. But because of stimulus packages, we're able to survive and not be forced to look at our spending problems.
Did I just hear you say that the federal government should stop assisting? And then are you saying also that people, on the coast should move inland and stop rebuilding in hurricane zones?
No, I don't think I said anything to the sort.
Can you clarify then what you just said? Because I thought you said we got to stop using this stimulus money.
No, I think Sienna's question was about the stimulus and when that runs out, what happens? We haven't had to make any drastic decisions because of stimulus money. We took a check of, I think, $1.8 billion from the federal government, and $1 billion of that shored up the state general fund. That forced the state, that allowed the state to sort of operate like everything was normal. Well, everything wasn't normal. When that runs out, and I was here after Katrina, we had this false economy. So when all that money ran out and we caught up with the economy, we crashed. Now, I can't predict what's going to happen tomorrow, but I know the economists are predicting we're going to be in a shortfall. I think their estimate is almost $680 million, I think. We're a small state. We only have 4.5 million people. I don't know how you all of a sudden just make that up in a $10 billion general fund. It's almost 10% of your money. I don't know about moving inland and what that all has to do with what I said.
All right, Louisiana State Treasurer John Schroeder, we thank you so much for taking the time to join us. We hope to have you back in the future, and we wish you and the state of Louisiana all the best. We'll be right back.
Thank you.
And welcome back to Yahoo Finance Live. Our correspondent Rick Newman had the chance to speak with New York Senator Kristen Gillibrand today. Quite a bit to talk about from the, I want to say the transition, but it's still not officially underway, Rick.
Right. So we're all tired of talking about this, but I had to ask her what is going to happen with another stimulus bill. Will we get it before the end of the year? Do we have to wait until Joe Biden takes office? Here is what you had to say about that.
Well, I certainly hope we can get back to the negotiating table. I've heard from a lot of New Yorkers, and they are truly struggling. People don't have enough food. They don't have any sense that they'll be able to provide for their families in the new year. Unemployment insurance runs out at the end of the year, and they're concerned about whether anything will change. And so we really need relief going to our state. We need money for state and local governments, for healthcare workers, for food stamps, for rental relief, for unemployment insurance, for small businesses, for our restaurants, for all the industries that have been crippled because of COVID. And we need it now. Unfortunately, we've not found that common ground yet. I'm hoping that Mitch McConnell hears from his constituents over the holidays. And so maybe that will be reason to get everyone back to the negotiating table.
So we have these two runoff Senate races in Georgia on January 5th. Those will determine the makeup of the Senate, which party controls it. Do we have to wait to get past those before Congress can do anything about another stimulus bill?
Well, no. I mean, we could start negotiating a stimulus bill right now. Speaker Pelosi has already passed 2 bills in the House on a bipartisan basis. She's lowered her number from $3 trillion to $2 trillion. Mnuchin got very close to that at 1.8, I think. But Mitch McConnell is stuck at about $500 billion. And so he's nowhere close to where the other 2 negotiators are. So I hope that perhaps after Thanksgiving, in a couple of weeks in December, that we could work on a common sense, bipartisan COVID relief package that meets the needs of the families of my state and across the country.
So if Republicans would happen to win those 2 races and retain a thin margin in the Senate, Mitch McConnell would have a lot of leverage. In that scenario, would Democrats just have to accept something like $500 billion, a lower number, which is around 1/4 of what Nancy Pelosi in the House wants?
I think if we just caved in to Mitch's demands, it would really harm the country. So one of the poison pills in Mitch's bill right now is blanket liability protection. And we remember what that looked like when meatpacking plants would be opened, where no one would have personal protective equipment, no masks, would be working shoulder to shoulder, and COVID ran through those meatpacking facilities like wildfire. So we don't want to see that again. And without any ability to hold an employer who doesn't take the lives of his workers seriously and care, then you're putting a lot of workers and a lot of Americans across the country at grave risk. So I think those kinds of poison pills are really harmful, and we don't like to be bullied into bad policy. I think the Democrats in the Senate would negotiate, would lower their total number, but not at the price of harming employees.
So guys, if there's a takeaway there, I think it is that she indicated Democrats could accept a much lower number than the $2.2 trillion the House is looking for. And there was a separate news report today saying Mitch McConnell is now interested in renegotiating a deal with Democrats. But look, we all know that's not going to happen fast.
All right. You can follow Rick Newman's interview as well as the stories Rick writes about the things that are transpiring in Washington, D.C. at the yahoofinance.com webpage. As the market settled, the Dow was up 44 points. S&P 500 was up 14 points. Just want to let you know that you want to stick around because in 2 minutes, our latest 2020 Time for Change special with a Thanksgiving theme is coming up next.
Welcome to Yahoo Finance's A Time for Change. I'm Kristen Myers here with Sabeel Marcellus. Jen Rogers is out today. We are a week away from the holiday of Thanksgiving, and we wanted to take this time to re-examine this American tradition by recognizing and discussing Native American perspectives. The disparities facing tribal communities have been brought into sharp relief by the coronavirus pandemic, with cases surging in tribal communities. Take the Navajo Nation, which spreads across parts of Arizona, New Mexico, and Utah. More than 13,000 residents have tested positive for the virus. That's all according to the Navajo Nation Department of Health. A 3-week shutdown began there on Monday. Here to talk to us about this crisis and more is President of the Navajo Nation, Jonathan Nez. Jonathan, thank you so much for joining us. We've been seeing alarming statistics of how badly the pandemic is impacting the Navajo Nation. You called it the invisible monster. We've talked often about how this pandemic is exposing existing disparities. And so I wanted to highlight one here, and this is on life expectancy. According to the Indian Health Service, life expectancy for American Indians and Alaska Natives is 5.5 years shorter than that of other Americans. How are you seeing these disparities impacting your community as we see these surges, these coronavirus cases spiking around the country?
Well, thank you, Kristen, for having us on your show. We are dealing with this monster that has snuck into our homes and our communities and our nation. And you can see that happening all across the country here with record-breaking numbers. And so if you're a small community, more like an island of this country, of course, you'll have some impact from what's happening off our nation. And let me just say, too, that there have been 8,011 people who have recovered from the virus, and that's what we've been tracking here on the Navajo Nation. But yes, we do have a large percentage of the most vulnerable population here. We have high rates of diabetes, heart disease, cancer, and with our elders having these types of illnesses, we're doing our very best to protect our most vulnerable and protect our way of life and our culture and tradition. And that's usually, our elders' wisdom. And we try to hand that down to our younger generation as well.
So I want to pick up on what you are saying about the future and passing on legacies, passing on traditions, because I have a couple other stats here about some of the inequities facing Native Americans. The unemployment rates and poverty rates are higher for Native Americans than their Black, white, and Hispanic counterparts. Median household income, just over $40,000. Now that's lower than that of Black, white, and Hispanic households. As you're mentioning it, the coronavirus clearly is one, but what are you seeing as some of, the biggest threats to the future and to the prosperity of not just the Navajo Nation, but other tribal nations as well?
Well, Kristen, there are 574 nations, distinct tribal communities throughout the United States of America. And we are the biggest nation, 27,000 square miles. New Mexico, Utah, and Arizona, and half of our population, the 350,000 Navajos, live off the Navajo Nation. So there's a lot of visiting happening, and our contact tracers have identified that the spread of the virus is coming from social and family gatherings, and I think that's the same throughout the country. And of course, we didn't make that poverty line. Somebody else made the poverty line. But there are a lot of our people that are content and are okay with the way of life. But of course, with the population not having water, I think 30-40% of our Navajo people don't have running water or electricity. Of course, this pandemic thrives on that type of statistic. And if you're getting information from CDC or NIH telling you to wash your hands with soap and water, and you don't have running water, it's going to be very difficult for taking care of yourself or personal hygiene.
You know, looking at the elections recently, Indigenous voters had a significant impact in delivering a victory for Biden in both Wisconsin and Arizona. What is it about his platform that really appealed to Indigenous voters?
Well, I think throughout the country, people wanted change. People wanted to move away from this divisive rhetoric and this type of encouragement of discrimination, and to really move forward in healing. I mean, we pride ourselves in this country for being the melting pot, but yet the first citizen of this land, of this country, has always been pushed aside since we got into these agreements with the federal government. And from then on, it's just been broken promises. But we did get a glimpse of the partnership, and a really good partnership that we've had with President-elect Biden when he was the vice president. When Obama and Biden administration was there, we were able to go to the White House, and the door was open about how we could collaborate and fulfill these commitments that were made. I think Native Americans have always fulfilled our promises that were made by these treaties. And if you know, the per capita Native Americans of any ethnic group throughout this country have served the armed forces. And there are some great stories of our people, such as the Navajo Code Talkers. And so I just want to also remind everybody, the 574 tribes throughout the country have contributed greatly to the freedoms of this country, and probably democracy all over the world.
And you mentioned that you actually worked with Biden back during Obama's administration. So what are your top priorities for Biden this time around?
No, I mean, the priorities are all across this country. I think we all want better infrastructure, right? We want water, we want electricity, telecommunication and broadband, better roads, rebuild some of these bridges. I mean, these are the commonalities that we can all, I think, agree upon in this country of ours. And I think more so, there needs to be a lot more attention in tribal communities. And I hope, the next 4 years will bring some positive change and to improve the quality of life for the first peoples of this country.
Jonathan, you just mentioned and you were highlighting all of the contributions that Native Americans have made to this country, and yet representation in Congress is still lacking. Although we have had a record number of Native Americans elected to Congress this year in the 2020 elections. But there is a treaty, not with the Cherokee Nation, essentially that they should have a delegate inside of Congress. I'm wondering if you think that the Navajo Nation, the Cherokee Nation, perhaps some other larger tribal communities should have direct representation in Congress with a delegate.
Well, not just a delegate, but I think there's going to be a time in the near future, just like Deb Haaland did, to where a Native American person, I'm hopeful that the Navajo Nation will one day see one of their own son or daughter in the halls of Congress and being elected by the people. And, we have a chance in this coming redistricting based on the 2020 census that occurred.
I want to ask you about something that we talk a lot about with the Black community, which is reparations. And it has a small amount of reparations was paid out to Native Americans, although it was paternalistic in its rollout, and the number was incredibly low. This is something that we have been discussing quite a bit, not just on this show, but we've heard Democratic presidential candidates talking about this. I'm wondering if you think that more needs to be done in terms of addressing the really cruel history that Native Americans have had to face inside of this country, and if that, addressing those issues needs to come with some financial compensation.
Well, I think just look at what happened with the reporting during the election with the exit polling with CNN calling other ethnic groups and nationalities in this country something else. And I think it's time for the something else category to bind together and to remind this country of ours that we are great contributors to this country. And I think, we just want, of course, our share of resources. And look at what happened during the CARES Act funding that was supposed to be approved or supposed to go out in relief funds to the people of this country. And the rest of the states, counties, and municipalities were able to utilize those CARES Act funds immediately, but 574 tribes had to wait months. And we even had to, petition a lawsuit into the federal government to get our share of resources. And I hope people understand that, and people do come and ask, how can we help? Right now, I think we can all let our congressional leaders know that this country should fulfill its promises to Indian country.
And obviously, getting a stimulus package is very important. And climate change has been named by Biden as one of his top priorities. How much of an impact would that have? And what do you hope to seek from Biden's administration on that issue?
Well, I think that there should be more Native Americans appointed to the offices in the federal government. I think people could benefit from our way of life teaching and some of the teaching that has been handed down from generation to generations, and utilize that to be better stewards of our land.
All right, well, we will leave that there. Thank you so much, Jonathan Nez, president of the Navajo Nation. Thanks so much for joining us today.
Thank you for having us.
Well, coming up after this break, the pandemic has also been impacting another group, Black restaurant owners. We'll be chatting with the famed chef Marcus Samuelson next.
Welcome back to A Time for Change. I'm Sabine Marcellus. The rise in coronavirus cases across the country has put in jeopardy the livelihood of restaurant owners across the country. 1 in 6 restaurants have already shut down because of the pandemic. And new restrictions are putting even more pressure on those who are trying to hang on. Joining us now is celebrity chef and restaurant owner Marcus Samuelson, a member of the Independent Restaurant Coalition. Now, Marcus, you moved to New York with just $300 in your pocket and now own 13 restaurants. What impact would another shutdown have on your business?
So this is by far the hardest time that I've ever been and our industry is going through, right? So there's all types of restaurants, but independent restaurant and Black and BIPOC restaurant are, the ones that are hit the most. This will be a very, very difficult winter, but safety is number one. So that's the most important thing. And we just got to navigate. We just got to hold on and navigate.
Well, your restaurants are in some of the hardest hit communities. So how have you been helping to address the uptick in food insecurity?
Well, I was lucky enough to partner with Jose Andres, our dear friend Jose Andres in World Center Kitchen. And we collectively in Red Rooster here in Harlem, we served 220,000 meals together with World Center Kitchen. We served a big number in Miami as well, in Overtown in our restaurant, and also out of our Newark location, where we work with Newark Working Kitchen. And I do think this idea between private and public partnership is the only way our community is going to be able to navigate through, but also support the neediest. Because heading into winter, it's very challenging, very difficult on so many different levels. And when our restaurants are gone, which is really the soul and the heart and soul of communities, so is small businesses, so is retail.
So Marcus, speaking of that fact that restaurants are the heart and soul of a community, I'm wondering what you're seeing throughout this pandemic. We've talked, Sabeel and I, to several restaurant owners that have really highlighted some of the difficulties throughout this pandemic. I'm wondering if you can kind of highlight for us specifically what that impact is on Black chefs, Black restaurant owners at a time like this, and what do you think the impact is going to be on the community when those restaurants go away?
Well, I mean, starting a restaurant is expensive, and African Americans and Black and brown people have always had this harder time to get financing. We don't have access to generational wealth. We also have a harder time to get finance from institutions, right? And then if you then add the lack of healthcare and other services, right? So we're really being hit on two fronts. So during the pandemic, there's one aspect, but coming out of the pandemic, we also know that Black and BIPOC communities are hit harder in terms of death rates and infection rates in its community. So this is not something that's going to go away only with the vaccine. It will get obviously better, but this is something that is going to define our communities for the next 5 to 10 to maybe 15 years. This is the most, and that's one of the reasons, for example, why I want to write The Rise, where I want to highlight Black chefs in this country and how we can support Black chefs in times like this. We list about 200 Black and brown chefs in the book, where this is not a New York issue or Los Angeles or San Francisco. Black chefs are across the country is going to need your support, whether you do it as an individual through takeout or whether you do catering for your company or a cook along, whatever it might be. These chefs going to need you more than ever.
Absolutely. It's a national issue. So that brings us to Washington. I know that as a member of the Independent Restaurant Coalition, you've been part of efforts to try to get these lawmakers to understand just how dire and how much of a crisis this is for restaurants. So what is the latest on talks for more stimulus?
Well, I think there's several pushes. Right? We thought we would have the second stimulus package done for restaurant community, but then, because of the election and because of the Supreme Court vote, we had to take a step back. And we were almost there. We had it in front of Congress. We thought we would get passed in mid-October. Now it might be December or it might be in January. But, these 6 to 8 to 10 weeks delay is a difference between those mom and pops that we love in our communities, that coffee shop, that bar, that diner to stay alive. And what's been clear throughout this is that the Trump administration and Congress as a whole don't fundamentally understand restaurants. There's a difference between chain restaurants and independent restaurants. And what we made the case for as Independent Restaurant Coalition was to explain that between 11 and 16 million people work in independent restaurants in America. And the hardest hit section in this economy is the service section, which we represent. So we are getting hit the hardest. And so we just have to make our case, keep pushing, and hopefully we can get the stimulus package done.
Definitely important to keep pushing. But Marcus, don't go anywhere because we're going to take a quick break. And when we come back, we're going to talk about the importance of equity in the American food landscape.
Thank you.
Welcome back to A Time for Change. I'm Sabeel Marcellus. Obviously, the pandemic has been a major setback for so many restaurant owners, but some are offering hope because they're beating the odds. Back with us now is celebrity chef Marcus Samuelsson. He's the author of the new book, The Rise, Black Cooks and the Soul of American Food. Marcus, why was it important for you to write this book, and why now?
I think storytelling and content and highlight the incredible contribution that African-American chefs have done to American food was important when I started the book, when Osei and I started 4 years ago, but it's even more important when you go through a pandemic like this, because the chefs and the restaurants and the people in our industry that's going to have the hardest time to start again is Black and brown chefs that has a harder time to get access to capital, and it's also less generational wealth. So this was a very important time to tell these stories, to highlight them, to broadcast them. And yeah, I'm super happy that we could tell the story of The Rise.
And you've written,
sorry, go ahead, Sabeel.
You've written about the blessing of being both an immigrant and a Black man, and that has given you the lens internally to be able to ask yourself, given the challenges I've been through, how do I deal with today or this issue in life? And you said that when it comes to America, some of the biggest issues are post-incarceration rehabilitation and employment. So how are you addressing that through your restaurants?
Well, first of all, restaurants are some of the biggest employers, independent restaurants in the country, right? And it was important for me to first show in the book that Black chefs, restaurateurs, and craftsmen are across the country. We at Red Rooster pre-pandemic, we employed 180 people. We served about 4,000 people a week. We also was employment for about 70 musicians. So it's about job creation, right? And these job creations in my community, in our communities, are game changing. You know, they're on a path to healthcare, they're on a path to middle class if you work at a Red Rooster. So for me, it's about the authorship of the Black experience in terms of food. It's about creating memories for all of Americans to understand that we have contributed. And then aspirations, so people want to go, the next generation wants to go to the industry. Yes, it's tough right now, but we're going to come out of this, and it's a fantastic industry to be part of.
So Marcus, I've got about a minute left with you here, and I want to ask you about something that you wrote about in your book. You said that the rise stands on 3 pillars, and I want to pick up on this piece about authorship, where you say that Black Americans have contributed so much to this country's food and culture without proper acknowledgement, a pattern of erasure that continues to this day. The book then goes on to say we have to name it so we can claim it. So I want to ask you, what does claiming authorship look like for you, and what would the impact be? I know that's hard to answer in about 60 seconds, but let's try.
Well, thank you for asking. I do think the authorship is important, right? Because, for example, Mr. Nearest Green that came up with a recipe for Jack Daniels, if he could have claimed it and had the authorship for that, he didn't make $1 in coming up the recipe for one of the most iconic brown liquors in the world, right? That is a massive change in terms of his family and great grandkids trajectory. You know, Black people came up with the starting point of 4 cuisines in America: Southern, which we sometimes call a soul food, Low Country from the Carolinas, Creole cooking, and barbecue. These are all cuisines that African Americans experience and chefs has really contributed to. And the way we know about Italian cuisine or French cuisine, that's changed everything, the way we tourist, the way we interact with those countries. It's time for us as Americans to give the authorship to the people who created it. And then also this creates a conversation during the holiday season of appreciation of Black culture. The more we appreciate each other as a country through food, through music, we're going to have a better dialogue about race and identity. We have to get a better place. If we learn something from 2020, and we're going to have a new start, is that we have to have a better conversation, more delicious conversation around race, culture, and identity as Americans.
Well, we'll have to have you back on. Marcus Samuelsson, thanks so much.
Thank you so much. Happy holidays, guys.
Happy holidays to you as well. And happy holidays to everyone at home. Thank you all for joining us and watching for this week's episode. We are actually taking a break next week for the holiday, but we will see you back again the week after Thanksgiving.
Thanks. Thank you, guys.